Hi friends, so I'm recording a separate video for the theory component. So though in the regular classes what we have been doing, we have been covering the practical areas. I do discuss a little bit about the theory part, but in detail discussion of the theory wouldn't happen as part of our regular video. So what I had planned, which I mentioned during my regular classes videos itself, is that I'll give you a separate video for the theory areas. Before we start with discussing every topic or discussing a chapter, let's first understand why theory is critical as far as SFM new syllabus is concerned. Now, in your exam, you will have 6 questions of 20 marks. So, question 1, totally there will be 6 questions. And what happens since this is mandatory for you to attend, and this 4 out of 5 for the balance question, you will have to do 4 out of 5 questions you need to cover. Now every question will have something like this: practical part, theory part. There's no specific pattern, but broadly you can say this can be 14 marks, this can be 6 marks, or this can be 16, this can be 4 marks, the theory component and the practical component. So let me just put a broad breakup which ideally can happen in an exam scenario. 16 4. A rare question can be full practical as well. That's a rare scenario. So what will happen is you will be forced to answer this short you will have to do 4 marks of theory, and maybe if you go for this question saying that I want to do more of practical, so you do this, then you do this, then you do this, then you do this. If you see this also, you are forced to answer 20 marks of theory, even if you're focusing on the practical area question. And it is not necessary that entire 20 marks be a practical area. It could be again 16 and 4. In the end, when you're answering 5 questions, you can understand that you will be forced to answer 20 marks of theory in exam. So that makes it very clear that theory is very critical from an exam point of view. SFM new syllabus, theory is something you cannot ignore. Now when you look at your chapters, of the 14 chapters which are there are few chapters which are dedicated theory based chapters. So what are the most important chapters for theory from an exam point of view? Most important chapters which you need to pay more attention is chapter 1, fully theory based, chapter 2, again predominantly theory based, chapter 3, predominantly theory based. Some part of problem will be there in 2 and 3, but it's predominantly theory based, chapter 6 and chapter 14. I think these 5 chapters, if you are confident, I'm not saying not to read the balance ones, but if you are confident about these 5 chapters, 1, 2, 3, 6 and 14, high probability that of this 20 marks of theory which you attend, 14 or 16 marks could be from these chapters only. 12 to 16 marks broadly could be from these chapters. So the most important chapters for theory is chapter 1, which is your introduction chapter, financial policy and corporate strategy, chapter 2, which is on risk management, chapter 3, which is on security analysis, where you have fundamental technical analysis, many things are there, chapter 6, securitization is there, and chapter 14, startup finance is there. My past experience does indicate that questions coming from these areas 1, 2, 3, 6 and 14 will be the most important areas from a theory point of view. Now today I'm going to start with recording of chapter 1, which is on financial policy and corporate strategy. Before I discuss the specific set of question, what this chapter is basically going to talk about is the impact of a financial policy on a company. What is financial policy? The financial policy can indicate certain items, like a financial policy may say that the dividend policy could be described in the financial policy, which will say how much dividends a company is likely to pay. a company financial policy may indicate what is the likely debt equity ratio they want to operate with, what is the comfortable current ratio they want to operate with, what are the liquidity ratios they are targeting, what kind of cash and cash equivalents they want to maintain. So the policy is basically going to give a broad framework to the company, which will decide how the balance sheet of the company will be structured. So it can have an impact on how much dividends, it can have an impact on the dividends which a company pays, it can have an impact on the borrowings which a company is going to take, it can have an impact on expansion. So it is basically, the policy is going to decide how much money can you take it from your shareholder, or how much money can you take it from your lenders, the bank and other places, so that you can use that money for investment purpose or for the expansion purpose. And strategy is basically something which is well planned. Strategy is nothing but something which is well planned by an organization. Whatever you plan to do, if you have, whatever you are doing, if you have a plan and a strategy in place, it will ensure that you get the desired result. So this chapter is on financial policy and corporate strategy. Now the first question is, what are the essential elements of any business? See, I'm not going to read out the entire answer. That's not how the theory would be recorded. You can read out the theory part, but I'll focus on something which is critical. Now, what is essential for an organization to succeed? See, if you want to succeed, you need money or the financial resources. Without financial resources being in place, it's not possible for an organization to grow, for an organization to be set up, for an organization to acquire other resources like men, material, machine. All those resources needs to be acquired. For all of that, money is needed. So somewhere financial resources are needed. So for the financial resources to be well controlled, there are a set of people who are going to control this money flow, who are going to manage this money flow, who are going to invest this money flow, who are going to ensure that money is utilized properly. Effective utilization of money is needed. So for that effective utilization, you need a team, and that team is called management. Management is needed to ensure that the money which is available is properly utilized. That is one segment. Management is like an enabler. They will use this money and try to put it to a proper use. And for that proper usage to happen, somewhere you need a good strategy, a clear and a realistic strategy. So the three essential elements of a business is, you need financial resources. Who are going to manage the financial resources? The management is going to do it, and they will take a help of a clear and a realistic strategy. So you need a clear and realistic strategy, financial resources, controls and systems to see it through, right management team and processes to make it happen. The next question is, what is a strategy? We learned that one of the fundamental of a business is a strategy. So what is this strategy all about? There are different types of strategy also. There's a corporate level strategy, there's a mid-level strategy, there's a lower level strategy. See, basically you need a direction. If you don't have a direction, see, there's something called as, and there are a lot of people who don't plan as to what needs to be done. If an organization is not planning or is failing to plan, if an organization is failing to plan, it is indirectly planning itself for a failure. That's what they say. If you fail to plan, you are planning yourself for a failure. So strategy is basically something which is going to provide a long-term direction to an organization. It will provide you long-term direction. It will help you as to how you need to run your business, how you need to manage your business, how you can achieve competitive advantage, how you can use your resources properly, how you can meet the competition which is there, so that you fulfill the aspiration of all stakeholders. There are different stakeholders in a business. You have shareholders, you have customers, you have employees, you have government. So you need to meet their expectation. In order to meet the expectation of these people, you need to ensure that resources are properly utilized. What are resources? Men, men, material, machine and money, and also you are able to meet the competition. So for all this to happen properly, you need a long-term direction, and that comes from the strategy. What are the key decisions falling within the scope of financial strategy? Now I was saying that uh, the fundamentals of a business, is financial resources, management and a strategy. Now that financial policy, the initial part I said there is a financial policy. The financial policy will decide how much dividends a company has to pay, how much borrowings it can take, whether they want to expand or not to expand. All these are the decisions, which fall within the scope of financial strategy. What are the key decisions falling within the scope of financial strategy? The financial policy, the decisions are financing decision. This basically tells how much money do you want to take it from the providers of money. The money needs to be taken from in few forms. It could be equity capital, it could be debt capital, it could be preference capital. So what mode of financing and how much money do you want to take? That's called financing decision. Then you have investment decision, that is you need to use this money, whatever money you have taken, you need to use this money for proper purpose. It is to be used for expansion purpose, it is to be used for diversification purpose, it is to be used for setting up a new unit. It is sometimes you may even decide that certain projects you will not take up because they may not give you the required return commensurate with the risk which is being taken. So for investment decision, what matters is risk, return and a trade-off which you need to do between these. Risk, return and a trade-off, you need to balance them. Next is dividend decision, that is, see what happens is there's a business, you are the business. What you do is you take money from people. So you take money from people by giving them financial assets. What are the financial assets you will give them? You will give them equity capital, equity shares, you will give them debt, debentures, you will give them preference share, and the business invests this money in real assets. What are real assets? Land, building, plant and machinery. So you use this, and at the end of the year you earn profits, and based on this profits you need to decide whether you want to give dividends or not. There are a lot of factors which influence dividends to be paid, and if you have future projects which are likely to happen, then in that case maybe you may not declare that much dividend. So that's a call you will have to take, how much dividends you want to pay. You may pay a higher amount of dividend, you may pay a lower amount of dividend. You need to decide what form of dividends or how much dividends a company has to pay. And the last part is portfolio decision. This is another chapter for us as far as this subject is concerned. So what happens in a portfolio decision is you are trying to when you are analyzing any expansion project, or when you are analyzing any financial investment also, you need to see that what is the combined strength of the project. For example, I have set up a plant in Chennai. Now this plant needs some raw material. This raw material project is best if you set it up in north. If you set up this project in north, because the cost is going to be lower. So you may plan to set up this project in north because from a cost point of view. But what happens is after the manufacturing, this raw material from north has to come to Chennai. When it comes the transaction, the logistics cost increases the overall cost. So if you look at from an overall point of view, rather than the isolated characteristics, if you look at from an overall point of view, you may decide to set up that project in Chennai itself, because you may save on the logistics cost. Sometimes you may set up you may want to do certain projects for the purpose of diversification. Today I am in a coffee business. I may want to diversify and set up a project in automobile. I may want to diversify and set up an IT business. On an individual basis, maybe they may not look that good, because in few years they may do well, few years they may not do well. But when you look at an overall point of view, because of diversification benefit, it may look like a good project. So the key decisions which you need to take is, one is financing decision, there's an investment decision, there is a dividend decision and portfolio decision. All these will fall within within the scope of financial strategy. The fundamentals, strategy, financial resources clubbed together is financial strategy. What is the interface between financial policy and strategic management? Now, what does strategic management is? Basically managing the business of a company with knowing lot of management models in place. For example, in your SCMP you will learn about lot of models, like some organizations will use TQM, some organizations will use Six Sigma. So basically the strategic management is a tool for an organization to compete well with its competitors. In order to do that competition, you very well know that there are certain strategies which an organization may adopt, like a cost leadership strategy or a product differentiation strategy. Now what we are trying to link is, what is this linkage between strategic management and financial policy? What is the linkage? So for this, what they are saying is, you need to understand the starting point. The starting point of any organization is money, and the ending point of an organization is also money. That is, when you want to start the business, you need financial money to come in. You need money to come in from your investors. You give them financial assets and take money. So that's a starting point. You invest that money in. At the end of the year, you earn profits. That's also in money. And then you declare dividend. So the starting point of any business is money, and the ending point is also money. So it is very critical that you have a proper link between the financial policy and the strategic management, because your starting point of an organization is money, and you need to ensure that you raise that money in a proper manner. That's your financing decision. Sources of finance and capital structure, that is part of financing decision. Once this money is raised, you also need to ensure that this money is properly utilized. So when you raise money, whenever you're raising money, that is your financing decision, you need to take care of source, cost, that is at what cost of equity, what cost of debt, what cost of preference you want to pay, source, from where you want to raise money, mix, what mix you want to maintain, the debt equity mix, the debt preference and equity mix. So an organization will have to decide the capital structure, which is the mix of debt and equity. Once that is decided, you will have to now use this money for some proper purpose. Whenever you're utilizing or whenever you're investing in assets, you need to ensure that you take care of the risk element. The risk element should not be very high. So somewhere you will have to take care of the risk element and ensure that this money is utilized properly. And at the end of the year, you may have to decide the dividend policy. See, whenever you're deciding your dividend policy, somewhere one aspect which you need to keep in mind is, this whatever investments you are doing or whatever money you are investing in, the profits which are generated by them can be declared as dividend or can be used for further expansion, because you may get few more projects. So when you're getting additional projects, you may want to use this money for additional projects. That additional projects evaluation happens through the strategic goal of an organization. What is the strategic goal of an organization? Do they want to become a market leader? Do they want to expand in these areas? So what you need to do is, you need to ensure that what is your goal, which comes out of your strategic management, and then decide on the dividend. So net you cannot isolate dividend policy separately, financing policy separately, your investment policy separately, and separately the other functions work, which is your R&D function. Separately you have a goal of becoming market leader. So you will have to ensure that there is a closer fit. There's a closer fit between the financial policy and the overall organizational performance and what kind of growth they want to have. The next question is on what are the different types of strategy. As I was talking about, there's a corporate level strategy, there's a mid-level strategy, and there's a lower level strategy. So you have three types of strategy: corporate level, the mid-level strategy, and then you have a lower level strategy. Corporate level strategy is basically going to decide the overall framework of a company, or the overall guidance of a company. It may help you in deciding what kind of businesses you want to participate in, or what kind of businesses you want to compete in. It may also decide that whether you want to make a big expansion or not. So it will basically talk about the corporate level strategy, is also called as top level strategy. This is basically going to give you a guidance as to what an organization wants to achieve. This will help in achieving the mission and vision of an organization. It will somewhere help in achieving the mission and vision of an organization based on the corporate level strategy. That is, I want to compete in such businesses, I want to become a market leader, I want to be known as a person who is very ethical, I want to be known as a sustainable organization. So after your corporate level strategy is decided, you will then decide the strategy for individual businesses. So the first strategy is corporate level. Based on corporate level, you will decide business level strategy. So business level 1, business level 2, for example, ITC will decide the overall corporate strategy, saying that they want to become they want to earn profit of 5,000 crores, they want to earn a return on capital employed of 20%, they want to contribute 2% of their profits for the society, they want to provide 5 lakh employment opportunities. So their overall broad strategy they will decide. Then they'll decide the strategy for FMCG business, for the tobacco business, for the hotels business. So they may decide the strategy for individual businesses which are either a profit center or an investment center. So strategic business units may be any profit center that can be planned independently. At the business level, the strategic issues are about practical coordination of operating and developing a sustaining a competitive advantage. So you will decide a strategy in such a manner that you achieve your overall goal, which is your corporate goal. And based on business level, you will decide the functional level strategy. Functions, what are the different functions? Production is a function, sales is a function, R&D is a function, marketing is a function. So you will decide strategy for the different functions of an organization. Is the level of the operating divisions, R&D, operations, manufacturing, marketing, finance, and you will have to ensure that these strategies work in such a manner that overall, so from corporate level you decide the business level strategy, and from business level you decide the functional level strategy, and these functional level strategy will contribute to the overall strategy of the company. They're going to contribute to the overall strategy of the company. Next is, what is financial planning and what are the components of financial planning? See, strategy or the word planning is sometimes can be used interchangeably also. Basic thing is, financial planning will again provide you a guidance. It will provide you a guidance. It will help you in knowing what exactly are you going to do over the next 3 months, 6 months, 9 months, 12 months. It could be a long-term planning, it could be a short-term planning. Basic thing, it is going to tell you exactly what is going to happen over the shorter period of time and over the longer period of time. So why financial planning? For example, in your chartered accountancy, some of you have started classes now, but your exams could be November 23 or May 24, November 24. So some of your exams could be 2 years. I'm recording this in 21, December 21, and your exams could be 2 years down the line, but you have started your classes now. Why did you start? Because you have planned in such a manner that next 6 months you will cover 2 subjects, another 6 months you will cover maybe 3 subjects, then you will cover. So once you come closer to your study holiday, you would have done with your classes, so then you can start with your revision and other things. So you have a plan in place. Similarly, an organization will have a plan in place. The plan is basically going to tell you the feasible area of operation for the company. Financial planning is a systematic approach whereby the financial planner helps the customer to maximize his existing resources. That is, I have a capital of 40 lakhs as of now. I want to keep maximizing it. How do I maximize it? By investing in mutual funds, by investing in equity shares, by investing in fixed deposits, so making certain investments, or by doing some other project. So you want to maximize your financial resources by utilizing some of the financial tools which are available, by utilizing some of the financial tools which are available, which will finally help you in achieving your financial goals. So the financial resources plus the financial tools will help you in achieving your financial goals. The next part, what makes an organizational financially sustainable? Sustainable, the word sustainable is very, very critical. In CF Final SCMP, you will keep hearing this word financial sustainable. You need to build a sustainable organization. We want our performance to sustain over a longer period of time. You learn business excellence model, where your focus is to ensure that your organization is sustainable. What is sustainable is the performance which you make in the current year needs to be sustainable over a longer period of time. You need to ensure that this performance continues for a longer period of time. It's not that you just make, for example, what I can do is I can cheat my customers. I can cheat my customers. If I cheat my customers and do something of cheating, this year my turnover from 100 lakhs can go to 1000 lakhs. I'll cheat my customers by giving some offers and all, but give some bad quality product. So great, 100 has become 1000, but suddenly this 1000 will drop down to 20 or 30, or maybe you will down to 50 lakhs, because you tried to doing something which is not sustainable. Also, what you did is you provided a lot of discounts. You wanted to increase your turnover, you provided a lot of discounts, and in that process you have used all your financial resources now, so you don't have money to run your business. So what a sustainable organization is basically something which ensures that they balance their financial resources and ensure that you are not growing at a very healthy rate immediately. So you need to ensure that, okay, whatever I'm talking about is going to be discussed, how financial goals can be balanced with sustainable growth, because you cannot have a very high growth and then keep crashing downwards. So to be financially sustainable, if you want to be sustainable in a practical world, you need to have multiple sources of income, have more than one source of income. So if one source of income doesn't work during COVID scenario, some other source of income, have more than one way of generating income, have a proper financial plan in place, have good financial systems in place, good public image, don't compromise on your values, don't try to cheat your customers, and have that financial independence. In fact, in a practical world, there's a movement which is happening, which is called FIRE. What is this FIRE movement? Financial independence and retire early. It's not linked to this area. Financial independence and retire early. That is, when you are earning, you try to save your money and invest them at a aggressive manner, invest the money in an aggressive manner, so that you are able to retire early and then enjoy your post-retirement life. You will keep having some fixed income like dividend income, interest income, and ensure that you are able to sustain your life over for the balance period. So financially sustainable, and an organization can be sustainable if they have more than one source of income, or they're able to find more than one way of generating income. They are ethically well known in the market, they have good financial systems, good public image, they worry about their values. All this will ensure that an organization become financially sustainable. Now, how financial goals can be balanced with sustainable growth? Now, just to give an example, fuel companies, oil and marketing companies, these oil and marketing companies, the petrol companies, the fuel companies, they say that you need to save fuel. Electricity companies say that please save electricity. Now they are selling fuel, they are selling electricity, but they are telling customers to save that. Why are they saying this? Because if you don't save and spend more, their incomes will go up. But fuel, it's not a renewable source of energy, so non-renewable. So there is a fixed amount of life. If you keep utilizing or if you keep exploiting the resources, you may run out of resources. So that is why you will have to ensure that you don't exploit your resources in such a manner that you run out of them. So the concept of sustainable growth can be helpful for planning healthy corporate growth. You will have to think what is the financial consequences of sales increase. If you keep growing at a very high rate, it may not be possible for you to sustain that growth rate over a longer period. So if you grow at a very healthy rate, what will indirectly happen is you may break down. For example, when you are in a car, you run at an optimum speed. You cannot keep driving at a speed of 200 kilometers or 250 kilometers or 150 kilometers. There's an optimum speed which could be 80 kilometers. So you try to balance it. If you run at a very rapid pace, you will break it down. That is where this example is given. To take an illustration, let us refer to fuel industry, whose resources are limited in quantity, and a judicial use of resources is needed to cater to the need of future customers along with the need of the present customers. So one may have noticed that save fuel campaign, it's a demarketing campaign. I am telling my customers not to use fuel that much. That deviates from the usual approach of sales growth strategy and preaches for conservation of fuel, because this is necessary that if they conserve usage, this could be used for future. And what you are trying to do is you are ensuring that you have a stable growth. Too fast or too slow growth will go against the enterprise growth and development. If you grow at a very rapid pace, you need more and more money. If you grow at a very low pace, it may not be possible for the companies to meet the expectation of their stakeholders. So you need to balance growth and ensure that you run at a normal growth. In your dividend policies, we have something called as dividend growth rate model, Gordon's growth rate model, where some companies will grow at a very high rate of 20% for few years, but after that the growth will stabilize at some 7% or 8%. So sustainable growth rate is basically the growth rate where you can manage, or the growth rate which can be managed with the available resources. In fact, you know how to calculate this also. Sustainable growth rate is equal to return on equity into retention ratio. The growth rate formula, return on equity into retention ratio. So you will have to ensure that whatever the available resources are there, based on that you target a growth rate. If you don't have resources, then please don't target a very high growth rate. Your ROE is only 15% and you are able to retain only 12%. If that are 12% or 40% or 50% or 60%, you're able to retain some number. Based on that, you decide your growth rate. You cannot have a very high growth rate. Okay, that's what this calculation. Maximum rate of growth in sales that can be achieved with the available resources, with the current profitability, asset utilization, payout or retention ratio. So whatever available resources you have, with the available resources, how much can you grow? Don't try to grow beyond your limit. ROE into retention ratio. Sustainable growth rate is equal to return on equity into 1 minus dividend payment ratio, or the retention ratio. Basically the growth which you can achieve without any fresh borrowing. You want to grow with the available current resources. So in this chapter we have learnt about financial policy and its linking with the corporate strategy or the other strategies. We started with 3 essential elements of business, which is strategy, finance and management. Then what is a strategy? It provides a long-term direction to a company. What are the key decision? Financing decision, investment decision, dividend decision and portfolio decision. Then we saw what is the interface between a financial policy and strategic management. The interface is simple. The starting point of any organization is money. The ending point is also money. So if you have to do well somewhere, there is a need for financial resources and there is a need for linking or the interface. You will have to link the financial policy along with the strategic management. They cannot work in isolation. Your financing decision, your investment decision, your dividend decision has to work in line with the strategic goal of an organization. Different types of a strategy. Corporate level strategy are the top level strategy, the mid level strategy are the business unit level strategy, and the lower level strategy are the functional level strategy. What are the components of financial planning? Financial planning is basically providing your direction. The components is three things: financial resources, that is the available existing resources, the tools which are available. Financial resources plus financial tools will make it financial goals. What makes an organization financially sustainable? An organization will be financially sustainable if they have more than one source of income, if they can generate, if they are well known in the market, there is a goodwill for them, they are following ethical principles, they are not cheating their customers, they are following their values. All this can make an organization financially sustainable. How are you going to balance your financial goals with the sustainable growth? Because it's very critical that you don't have a goal saying that I want to grow at the rate of 40%. That's not possible, because with the available resources there is a sustainable growth. So you will have to balance. You may have to do a demarketing campaigning. You may tell your customers not to use your product if there is a risk of that product becoming, or the resources going out of extinction, like fuel or electricity. There they do a demarketing campaigning. I don't want a too faster growth, I don't want a too slower growth also. I'll have to balance them together. And what is sustainable growth rate? Is the rate at which you can grow with the available resources. I don't want to borrow anything additionally. With the available resources, the available profits, the available retention I do, at what rate can I grow? So the sustainable growth rate is ROE into retention ratio, or ROE into 1 minus payout ratio. With this I'm done with chapter 1. I'll keep recording other chapters and keep giving it to you. Hi friends, so let's start the recording of theory lectures for chapter 2, risk management. We've done the theory recording for chapter 1 earlier. Today let's do chapter 2 recording, which is on risk management. Let's first understand the word risk. Risk is something which you would have heard at multiple places. You would have heard as part of portfolio management. You would have heard as part of in your normal discussion also. Whenever any discussion happens, we normally use this word risk. See, return is possibility of earning money. Risk is basically how much can you deviate, how much can you deviate from the given returns, or indirectly it can also mean possibility of losing money. Risk can also be understood as a possibility of losing money, because it's not that always you will earn money, or in other words, risk is basically what can go wrong. What can go wrong? A business gets exposed to multiple risks. Some of the examples of risk a business gets exposed: currency risk. That is, if dollar versus INR exchange rate fluctuates a lot, it can also lead to some impact on me. Interest rate risk. If interest rates go up or come down significantly, it can have an impact on my company. Compliance risk. If I'm not complying with the rules and regulations, it can impact my company. Counterparty risk. I give credit to some customer and is not supplying the product, that can also impact me. Commodity risk. The raw material which I use, the prices fluctuate a lot. So if they fluctuate a lot, that can also impact me. That's called commodity risk. Political risk. Basic impact which can happen on my, because of some political uncertainty. In any place, if there's a political uncertainty, how can it impact my company? So there are multiple risks a business is likely to face. I've just mentioned few names. I can keep adding more and more names. There are internal risk, there are default risk, frauds. So multiple risks a business gets exposed to. Somewhere you will have to understand what are the risks there. First thing is knowing that there are so many risks in a business, and there are ways to manage the risk. So this chapter is going to focus on how do you manage those risks. One, you need to understand, for example, currency risk, which you would have learnt in foreign exchange chapter. Currency risk is variation in my cash flows due to variation in exchange rate. I am a business who does not have export, no imports, no foreign currency loan, no foreign currency investment. I am not bothered about currency risk then. I'm not bothered about currency risk in that scenario. So first we'll have to check whether there is a currency risk or not. And if there is a currency risk, then there are ways to manage them. Forward contract, leading and lagging, netting, your money market hedge. So many tools were there: currency futures, currency options, money market. So many tools are possible. So first you need to know, are you exposed to any kind of a risk? So in this chapter we are going to find how do you check whether you are exposed to some risk and how do you manage that. So first is, are you exposed to a risk, and then are you managing that properly or not. So let's look at this. First, what are the different types of risks faced by an organization? I kept on telling so many risks. Now these risks have been clubbed into 4 categories. The risks which I was talking about is being clubbed into 4 categories. One is strategic risk. What is strategic risk? Is every organization has a strategy in place. So when it comes to strategy, you have a top level or a corporate level, you have a middle level, you have a lower level strategy. We are now looking at more at a high level. The goal of a strategy, or the objective of a strategy, is to achieve something. For example, Tata Consultancy Services can have a strategy which wants in itself to become the market leader. They want to have the highest market share in IT industry. Or Tata Motors can have a strategy of able to reach multiple places. They want to reach everywhere in India. So different businesses have different strategies in place, and those strategy is required to achieve a goal. What is strategic risk? Is your strategy is becoming ineffective. Classic example, before Reliance Jio came in, Idea had its strategy, Vodafone had its strategy, so Airtel had its strategy, but suddenly because this new competitor entered the market, their strategy was not giving the required result. The strategy of Idea or your Airtel was not giving them the required result, because the strategy is to undergo a change now. If it doesn't undergo a change, it will not be able to compete in the market and face the likes of the competition which has come in. Technological changes. Technology changed significantly. Example, Nokia. Nokia was a mobile phone brand. It continues to be there, but it was more popular in non-smartphone category. Non-smart basic phones, it was very good. But they did not anticipate such a technology change to happen, and they did not change with that. And because of that, they have a huge impact. So technology change, new competitor entering the market, shift in customer demand. The technology change in the Nokia example led to a shift in customer demand to smartphones, increase in the cost of raw material. Some product, if the raw material cost goes up significantly, maybe people will start getting into other product. That can lead to a shift in customer demand, or any number of other large scale changes. So strategic risk is, my strategy has become ineffective. Second is compliance risk. Compliance risk is, you are required to comply with multiple rules and regulations. If you're a business, you're required to comply with Companies Act, Income Tax Act, GST, SEBI rules, SEBI regulations, listing regulations. So many rules and regulations are there which a business has to comply with. If you are not complying with any of the rules and regulations, it can lead to severe penalties. Sometimes the penalty and fine can be that huge that there is a threat for the survival of this business. There's a threat for the survival of this business. We are not sure whether this business will even continue operating in future. If the company fails to comply with the laws relating to new area or industry or sector, it will pose a serious threat to its survival. Now you are not very sure whether you will be able to continue operating. So it is extremely critical that you comply with all rules and regulation. Comply with all rules and regulations. You cannot say that I am not aware of XYZ rule and regulation. If you're not aware, you take help of external professionals, but you are required to comply with the rules. Operational risk is basically something internal. It is related to people, processes. In fact, during my audit, during my articleship experience, we were just working on one internal audit, and during the internal audit, when we did a bank reconciliation, it was just a simple thing. In a bank reconciliation, we could find that two checks were missing. Basically, they got encashed, but the company did not issue those checks. So those two checks were signed by the CFO or the finance manager, and he had forged the signature of managing director, and this risk was exposed. Later on, they brought in a control that the checkbook will be in some safe custody. So that control was not there. Because of that, the checkbook was taken by a junior level officer. He put the signature of the managing director, gave the check, encashed the money, and moved out of the company also. Operational risk is also known as internal risk. Reports on the failure on the part of the company to cope up with day-to-day operational problem. So day-to-day multiple problems can be faced. One of the example is the fraud part, which I was indicating, which was because processes were not right and people also wanted to cheat. And processes were not efficient. Financial risk is any variation. I can put it in simple words. Any variation in my profitability, or cash flows, or financial position. Any variation in my profitability, or my cash flows, or my financial strength, because of external changes like raw material prices going up or coming down, FG prices going up or coming down, exchange rate, currency risk, commodity risk, interest rate risk, credit rating risk, default risk. So anything which is happening because of changes in financial condition. Some of the examples they have given is interest rate. We learned this as part of one of the chapter, interest rate risk management. Exchange rate, we learned this part of foreign exchange exposure risk management. Prices, this is something we don't learn as a chapter, but basically the purchase team would keep track of this and try to control risks. Credit rating, if credit rating comes down, the interest rates can go up. So different type of risks which I was talking about can get clubbed into four. Strategic risk, this is basically the top level risk which leads to my strategies becoming ineffective. Compliance risk, this is non-compliance with rules and regulations. Then we also have something called as financial risk. This is changes in the financial conditions like your interest rates, currencies, all those undergo a change. Because of that, there is an impact. And operational risk. This is mostly internal to the company, and because you have not been able to control it properly, your processes or people are not proper, that has led to this risk. What are the various types of financial risk? So various types of financial risk, some of the example is already there. Exchange rate risk is there, commodity risk is there, interest rate risk is there. Apart from that, there are other categories are also there. See, one major risk which any businessman faces is when I'm doing business with any customer, an external customer, there is sometimes a need to give credit. When I give credit and the other person does not make that payment, I face the risk of bad debt. That bad debt is part of a counterparty risk. That bad debt which you say is part of a counterparty risk. What is counterparty risk? Is non-honoring of obligations by the counterparty. Non-honoring of obligations by the counterparty. It's not only we from a customer side, it can be even from a supplier side also. You have made advance payment, supplier did not deliver the material, or you did not make the payment but supplier was to give you the material and you were to use it and supply to a customer. He did not do it, because of which you are being penalized by your customer. So counterparty risk is non-honoring of obligation by the counterparty. The counterparty can be a customer, can be a supplier, can be a borrower, can be a lender, can be any party. This risk occurs due to non-honoring of obligations by the counterparty, which can be failure to deliver the goods for the payment already made, or vice versa. That is, you made an advance payment, repayment of borrowings and interest. Bank is not able to collect interest and principal from the customer. This risk has credit risk, which is the default by the counterparty. Default by the counterparty, it's not only the money not being paid. Apart from money also, there are other things which are needed. So if the obligations are not met, you will have this risk. The second risk is political risk. Political risk, this is mostly faced by overseas investor. It is not faced by within the country, but it is faced by overseas investor, as the adverse action by the government of host country may lead to huge losses. For example, during the current scenario, if I have invested money in a Russian company, if I have invested money in Russian company, or I have put money in Russian market, because the Russian government is going on a war at this point of time, what is happening is I am going to face huge losses. It can be that my property can be confiscated by them, or it can be destroyed. I think there was some restriction which they announced, saying that you cannot make payment outside. There was some restriction which the Russian government brought in: rationing of remittance, restriction on borrowing, invalidation of patent, price control, restriction on conversion. So many things can be brought in, and I am going to face this. This is an extremely critical risk, because it is not very easy for a person to ideally find this risk. It is not a easy risk to find. It's not a easy risk to find. So you may struggle to exactly understand this risk. So we may take help of some local company or local agency to understand how is the political risk in a country. There are certain countries where investments are not made by some businesses, because you consider the political risk to be on the higher side. Interest rate risk, this is basically what is the variation in my cash flow or my balance sheet due to changes in interest rate. This risk is applicable to all companies, but very important for banking companies. Very important for banking companies, because for banking company, their assets earn interest, their liabilities you pay interest. So you are basically earning, by the difference in the interest income. You're basically earning by the difference in the interest income. So for banking companies, any change in interest rate can have a huge impact. Currency risk, variation in the cash flow due to the changes in exchange rate, applicable for a business which has import, export, which has foreign currency borrowing or foreign currency investment. So if you have all that, it will affect those companies. So the financial risk is being looked up in 4 different ways. Counterparty risk, that is default by the counterparty. The customer or the supplier or the borrower or the lender does not fulfill the obligation. Political risk, that is basically faced by the overseas investor. Interest rate risk, that is basically the variation in asset and liability or cash flows due to changes in interest rate. We know tools to manage interest rate risk, which we learnt in interest rate risk management. Interest rate futures, options, swaps, all that is there. Currency risk, which is basically the variation in cash flows due to exchange rate. Again, there are tools to tackle this. We had tools like your leading and lagging, netting, forward contract, money market hedge, all that is going to come. What is financial risk? Also, the financial risk can be viewed from different perspective. A question which is tested multiple times. I've seen that coming multiple times. I think recently it came in one of the exam also. It did come in one of the exam also. Financial risk is basically what we saw here. What we have seen here. Unexpected changes in financial condition. Unexpected changes in financial condition such as prices, exchange rate, credit rating, interest rate. Political risk is also part of financial risk only. Directly it's not applicable, but it's indirectly part of that, because political risk, what happens is, if there is a political instability in a country, that is going to lead to ultimately huge losses. Ultimately huge losses will be looked at. Now Thus financial risk can be viewed from different perspective. You can view it from stakeholders point of view, from the company's point of view, from the government's point of view. So it can be looked from different perspective. This is one of the critical exam question. How is the financial risk viewed from a stakeholder's point of view? How is it viewed from a company's point of view? How is it viewed from a government's point of view? Stakeholder, there are multiple stakeholder, but the major stakeholder is equity shareholder and the lenders, the people who are providing money. Apart from that, you have customer, you have employees, all of them. For the equity shareholder, your financial risk, for the equity shareholder, your financial risk is calculated with debt equity ratio. Debt equity ratio. If you have a very high debt equity, it is a danger sign. It is a danger sign for the debt equity shareholders. It's a danger sign for the equity shareholder. The lenders, the debt holders, they also view gearing as an extremely important risk, because if you have very high gearing, it means high borrowing. High borrowing can lead to risk in default of payment of interest and principal payment. Certain businesses which have huge borrowings have suffered a lot. Then is from the company's point of view. From a company's point of view, also the same element only. What they are saying is, if you borrow excessively, you may go out of business. If you borrow excessively, you may go out of business. And the other thing is, if you lend excessively to someone who is defaulting, if you lend excessively to someone who is going to default, again you are gone. So both ways you can be gone. If you borrow excessively or also lending. Government point of view, at least in India's context, we have seen this risk to some extent, but it has not impacted so much. For example, I think there was Yes Bank. In Yes Bank, there was some moratorium which was announced and they had put restriction. Apart from that, there was PMC Bank. So if any big financial institution, fails, the financial risk can be viewed as failure of, from a government point of view. Any bank or big financial institution like Lehman Brothers, if this happens, what will happen is, I do remember this, when the Yes Bank event happened, few of my relatives did call me. They did not have a loan FD with Yes Bank, but they had FDs with other bank. They were asking, is it safe to keep it in banks, or do I move out money? Because it had led to distrust among society. So if any big just imagine if in India, State Bank of India goes into liquidation, major customers, major set of people will get impacted. SBI is too bigger a bank for India to afford a failure. You cannot afford any kind of a failure for a bank like SBI. So financial risk is basically unexpected changes in financial condition. Examples are prices, exchange rate. Political risk is also part of it. It can be viewed from stakeholders point of view, from companies point of view, and from government's point of view. Okay, what is value at risk, and explain its features and application. Value at risk is basically a topic. You will also do a problem solving, but value at risk is basically trying to evaluate what is the possible maximum loss in value. See, when you're investing in equity share, you do know that there is possibility of you losing money. Value at risk will say, with 95% confidence, there are confidence intervals also, with 95% confidence I am saying that loss will not be more than this, or with 99%. So VAR is a measure of risk of investment. It is basically trying to tell what is the worst case scenario, what can the worst scenario be in, and how much loss are you going to face. If the worst case scenario happens, what is the maximum loss likely to be faced. So that is what value at risk is going to tell. The maximum loss you can face in case the worst case scenario happens. So VAR is dependent on primarily standard deviation, historical standard deviation. It is primarily dependent on historical standard deviation. It is primarily dependent on historical standard deviation. How much is the historically standard deviation of a business? So based on that, you can try to get to know how much risk or how much is the maximum loss which can happen in a business. VAR is based on time period. That is, you can calculate what is the maximum loss for 1 day, maximum loss for 10 days, maximum loss for 30 days. Maximum is put together that period. So that is based on time period. Confidence level, we normally follow 95% and 99%. You will understand it in problem solving. And what is the loss which is likely to happen? It is based on standard deviation. Historical data based on standard deviation. You look at the past information, based on that you calculate. Again, I said time horizon is critical. It can be done for 1 day, 1 week, 1 month, 2 months, 3 months. It can be calculated for a specific time period. There is this confidence level. So for a 95% confidence, I will get a possible Z value. Z value is basically normal distribution. So using normal distribution, you want a 95% confidence that the loss will be so much. So you will get to know something called as what is the possible maximum loss, and for a confidence level of 95 or 99%, you will get a Z score. Now why should I do this? See, there are multiple reasons why I do. For example, in a bank or in a foreign exchange dealing institution, there are people who would be dealing in foreign currency. You will tell them to do trading. So when they are doing trading, they may face losses also. So you want to put a limit. So that can be done using this to fix limit for individuals dealing in front office of a treasury department. See, my maximum loss I can afford is 10 lakh. You will reverse work and calculate how much investment you can make. It can help you in finding out maximum possible loss which is possible in a business. Decide your trading strategies. Benchmark for performance measurement. That is for a trading division. When I say trading, is not the business trading. It's basically the trading of equities, trading of foreign currencies. So VAR is basically something which is going to tell maximum possible loss for a specific time period with a specific confidence limit, either 95 or 99. Now, what are the various hints indicating counterparty risk? So as I was indicating, this chapter we first understand what are the risks. Then we are also going to understand how do I assess whether that risk is going to happen in a business or not, whether that risk is really there or not there. So I will get certain hints to understand whether there is a risk. What are the hints suggesting a counterparty risk? What are the hints for an interest rate risk? What are the hints for an exchange rate risk? And how do you manage it? Counterparty is basically your customer, your supplier. These people are not fulfilling the obligations. So when can a counterparty risk arise? Failure to obtain necessary resources to complete the project or transaction undertaken. So I'll give you an example. Certain businesses are into toll road construction. So if you have to do toll road construction, government will give you a contract and tell that please start road construction. But if you have to do the road construction, you need the land to be acquired. The land has to be acquired. Many times they face difficulty in acquiring the land because you will have protest coming in from people. So if you have not got the adequate resources to complete the project, you may not be in a position to complete this. If the land acquisition is being taken up by the government, you will not face an issue. But you take up that responsibility and give it to an external party and they don't do it, you will be penalized by the government for not completing the project. Any restrictions which the government brings in, this can also lead to counterparty risk because the other party may not fulfill or you may not even fulfill. Hostile action of foreign government. Example, Russia, let down by third party, or the other party has become insolvent. Now, how do I manage? See, if I come and ask you that give me a loan of 10 crores, you don't give me a loan immediately. You do some checks and balances. So do a proper due diligence before dealing with me. Do a proper due diligence. If you do a proper due diligence of my past performance, my past dealings, have I done any defaults in the past? Today nobody will give a loan to Vijay Mallya, because you know that in the past he has defaulted. So that Vijay Mallya is a name known, but there are certain people who would have done past defaults. So do a proper check of that. Second, do not overcommit. We have this risk which we normally use. I was in a credit rating industry. We normally use a word called as customer concentration risk or supplier concentration risk. You cannot have your business majorly from a single customer. If 90% or 80% of your business comes from one customer or one supplier, and suddenly that customer becomes bankrupt or supplier becomes bankrupt, your business will have a significant impact. So don't try to overcommit to a single entity. Try to put some limits. Try to put certain limits. Know your exposure limit. What is exposure limit? Is when you're dealing with a customer, put some limits saying that you will not give credit beyond this. And for that also take adequate approval. Take adequate approval, have a system in place, and once that is in place, then things can be better. You get to know that a default has happened. You get to know a default has happened. See, you have done everything possible, but still a default has happened. If a default has happened, please take immediate action. Take immediate action. If you're going to sit at that point of time and not take proper action, again you are going to have an impact. So take immediate action in case a person has defaulted. This is something which a lot of people do. When you're dealing with a foreign company, foreign customer, we get letter of credit. Letter of credit is basically a guarantee given by the customer's bank saying that he will make the payment if this customer does not make the payment. So I get letter of credit, I get performance guarantee, I go for ECGC cover. ECGC cover, which is for export, this cover is there. So that will help me in case there is a default from. So I can use such tools, take insurance, take a credit cover, or bring in a letter of credit, bring in a performance guarantee, bring in normal bank guarantee. So all this can help in managing my counterparty risk. Counterparty risk is basically non-honoring of obligations by your counterparty. How to assess political risk and manage the same. Explain how an organization interested in making an investment in foreign risk can assess country risk and mitigate the risk. Now, political risk is something which is very difficult to assess, but you can try to at least assess to some extent. For example, in India's context, the government 5 years back and the current government continues to be the same, but every maybe 1 year some local elections will happen, some results will be some surveys will be undertaken. So all that will at least give you a sense, how favorable is the current government, or how likely is the current government to continue. What is expectation of anybody is they wouldn't want a government change. Any investor wouldn't want a government change to happen unless the existing government is extremely bad. They wouldn't want it. So if you believe that a government change is likely to happen, because the new government may bring in a lot of changes, so that can contribute to the risk. By analyzing the popularity of current government and assess their stability. Is this stable or not? Is this stable or not? By evaluating countries' macroeconomic condition. Macroeconomic condition is GDP growth, inflation, interest rates. So all that, if per capita income is going down, inflation is going up, unemployment is going down, so then somewhere government will be under a lot of pressure. This you can also understand through credit rating of that country. There is a sovereign rating which is being provided by certain rating agencies like Standard and Poor, Moody's. So you take that rating and understand political ranking or rating, and I can also take advice from the embassy, which is the home country in that host country. So if a USA investor wants to invest in India, he can take an advice from the embassy of USA and understand how do you manage it. The first point is something which is not which is feasible always. Basically they are saying you cut down, you technically cut down, that's all. Do local sourcing of raw material and labor, do local financing. So this is something which, if feasible, this risk itself is not there. But if it's not feasible, then only you get faced to this risk. So 2-3 ways they have talked about. One is entering into joint venture. What joint venture does is, an Indian partner will have a better understanding of the conditions in India. So if you see, some of the foreign MNCs, when they want to enter into India, they form a joint venture and enter here, because an Indian partner will have a better understanding of the conditions here, and he'll be able to better appreciate the changes which happen in this country. So you bring in an Indian partner. So entering into joint venture, prior negotiation, you try to enter into prior negotiations, and at least also do some discussions with the governments if possible, or at least have a discussion to understand if are you exposed to this risk or not. Interest rate risk is, again, I have told you, interest rate risk is going to occur when there are changes in interest rates. High reason for changes in interest rate is inflation, growth rate. If the macroeconomic conditions are bad, if the growth rates are bad in a country, you may have to reduce interest rates. If growth is not there, because once you reduce interest rates, borrowing will be there, investments will be there, growth will be there. So monetary policy of RBI, wherein RBI may change the interest rates, and that interest rate change is likely to come. From government side. It is likely to come because of the inflation. Monetary policy of the government, economic growth, release of industrial data, both are interlinked. So economic growth, your industrial data is IIP, whatever the IIP data indicates, that will have an effect on the growth side. So if growth is not there, government would be pushed to change interest rates. So that is one thing. If foreign currency money is coming in, how is the stock market performing? And suddenly government takes some adverse actions like demonetization, or some radical measure like this is taken, it can impact interest rates. How do I manage interest? Okay, that's not there in this chapter. How do you manage it is you learn there. You manage it through those tools were there. You have your interest rate futures, interest rate options, interest rate swaps, cap, floors, collars. So all of that can be done to manage it. So they have just talked about identification. Maybe there is a chapter on interest rate risk management. There you will understand about how do you manage the interest rate risk. Next is currency risk. Again, the question is only talking about identification. It is not talking about an area called as maintenance of this or managing the risk. That is learnt as part of foreign currency chapter. Now, identification of currency risk. See, you would have learnt this in your forex chapter. Exchange rates is primarily forecasted using IRPT. IRPT basically says interest rates in a country, high interest rates in a country will be offset by depreciation of currency of that country. Interest rates is dependent on inflation. So these are two major factors. Apart from that, you can have demand and supply, you can have some government action, you can have some wars coming in. So all those issues can be there. But the two major factors is interest rates and inflation. As per IRPT theory, depends on the nominal interest rate. Purchasing power parity theory depends on the your inflation. So these two will impact the exchange rates. Any action taken by the government through RBI, try to control or try to stabilize exchange rate to some extent. War, natural calamities, war and all. If you look at, I think now the Russian currency had a significant depreciation. So that got impacted. Change of government. A change of government can lead to a change in kind of policy, and that can also have an impact on the exchange rate. There's one case study kind of a question. I'll just revise what we have done till now and then we do that case study. So first what we saw is, what are the different types of risks faced by an organization? Strategic risk, which is my strategy becoming ineffective.
compliance risk, non-compliance with local rules and regulation, operational risk, which is internal risk related to people and processes, financial risk, changes in financial conditions like prices, exchange rate, commodities, credit rating, interest rates. Different types of financial risk: counterparty risk, failure by the counterparty; political risk, changes faced by overseas investor where any adverse action is taken by the government; interest rate risk, variation in cash flow due to changes in interest rate; currency risk, changes in cash flow due to changes in exchange rate. Financial risk is changes in financial condition. How is it viewed? It is viewed differently from different set. There is a stakeholder point of view who view the existing gearing. There is a company point of view if they do excessive borrowing or if they do lending and that party fails, or from government's point of view if there is a big financial institution which fails like Lehman Brothers. Value at risk is basically going to tell how much is the maximum loss that can happen in case the worst case scenario happens, and we attach this VAR for a specific period. It could be for a day, could be for a month, could be for a week, and also we attach a confidence level, either a 95% or a 99% confidence level is attached to this. Counterparty risk is your counterparty is not fulfilling the obligation, so there are certain hints which indicate it. Your past dealings, he becomes insolvent, he's not taken the necessary approval, any hostile action. You have certain techniques to manage them where you do a proper due diligence, you take some insurance cover, you take some ECGC cover, you take some performance guarantees. All this can help you in managing your counterparty risk to some extent. You don't commit yourself too much to a single customer. Political risk is you understand how stable the current government is likely to be in that country. How is the macroeconomic condition? Is the macroeconomic condition going to push this government to take some adverse action? How do I manage this risk? I can do local sourcing, local financing, this risk itself is not there, or enter into some joint ventures and other things. Interest rate risk is basically the variation in interest rates, primarily dependent on the macroeconomic condition, or basically the inflation, growth rate, industrial production, some government actions which can be taken up. So all this will impact your interest rate risk. And currency risk is there are multiple parameters which impact currency risk. Predominantly is interest rate parity theory, interest rates, purchasing power parity theory, your inflation, and apart from that you have your wars and other things which can be brought in. Wars are some rebellious action taken by the government, some natural calamity which happens there, or any some changes in the government which happens. Let's look at question 9. It's more like a case study kind of a question. You go through this, you just read through this. You read through the question. TRC Cables, an Indian company, is in the business of manufacturing electrical cables and data cables, including fiber optics cable. While mainly it exports to other country, it has also established its production facility at some African countries due to availability of raw material and cheap labor there. Major raw material copper, aluminium are also imported. Hence, there are frequent receipts and expenditure which is in non-INR. So TRC makes use of long-term debt and equity to meet its long-term fund requirement, but to finance its operation it also takes use of short-term financial instrument, money market instruments such as commercial paper, bank credit and term loans. If any surplus cash is left, it also invests in interest yielding security. Recently, due to stiff competition, it has also relaxed its policy for granting credit. Further, to hedge itself, it has entered into various OTC derivatives settled outside the exchange. Major risks to which TRC is exposed to. Now, one is currency risk, because you have frequent receipts and payments which are in non-INR, so you are exposed to currency risk. You're also exposed to political risk because you have your manufacturing facility in African country. So if the African government takes up some strict action or takes up some decision, it can impact me. So there is a political risk also I see. This raw material, copper, aluminium, the prices of this are normally volatile in nature. Prices are volatile in nature, so you're also exposed to price risk. You're also exposed to price risk. We are also exposed to interest rate risk because we have borrowing, long-term debt is there, your commercial paper is there, bank credit is there, so you are also exposed to interest rate risk. You are also exposed to counterparty or default risk because you have started giving more credit to your customer. So there is a counterparty risk or a default risk which is also there. Further to hedge itself against the various risks, OTC derivative. So derivative is a tool to hedge yourself, but the problem is these are settled outside the exchange. So this can, again, counterparty risk is there. The counterparty is if that other party does not fulfill the obligation. There's a counterparty risk. Currency risk, commodity risk or the price risk, interest rate risk, counterparty risk, you have extended higher credits. Okay, liquidity risk, because you have certain commercial papers and all. Commercial papers you will have to repay in short period of time. So in case you do not have adequate inflows, you have made certain investments. Those investments may have to be sold at a lower price. So liquidity risk, your inability to pay short term borrowing, so at that time you can do. Political risk is also there. And okay, this is, they have used the word settlement risk, but this is basically like a counterparty risk. This is like a counterparty risk. The technical name could be the settlement risk. That is, you have entered into an agreement and there's a possibility that the other party may not fulfill the obligation. The other party may not fulfill the obligation. With this, I've done with the chapter 2 theory recording.
Hi friends, so let's now do the recording of chapter 3. We have already done recording for 2 chapters, so let's move to chapter 3, which is on security analysis. Let's first understand what are we doing in security analysis. It's a very simple thing. In security analysis, I am basically trying to find what is the right price for any financial security. It could be equity share, it could be a bond, it could be a debenture. What is the right price for a share? Once you determine what is the right price for a share or for a bond or for a debenture, then you can do comparison. You can do comparison with the actual price and understand whether it's undervalued or overvalued. We have done significant analysis on this when we did security valuation topic, where we have tried to find out a fair value of a product. So in security analysis, we are basically trying to find what is the right price for a security. What is the right price for a security? And there are 2 techniques to do them. We have something called as fundamental analysis and technical analysis. These are the 2 ways of doing security analysis. So objective of security analysis is basically trying to find what is the right price for a share. Security analysis involves a systematic analysis of the risk return profile. That is, the items which are impacting the risk and return of a security. Historical data, risk can be measured through standard deviation, risk can be measured through beta. So you look at all this information which can help a rational investor. A rational investor is one who does not go by emotions, he goes by facts. Rational investor to estimate what is the value for a company, what is the value of the company from all the price sensitive information. So whatever data points you have, based on those data points, for example, a share price can be impacted by multiple factors. So this price sensitive information, a budget is announced or a budget is likely to be announced by the government, that is likely to have a favorable announcement for Maruti Suzuki, or interest rates are likely to come down. If interest rates come down, the demand for car can go because people can now afford to take loans because the rates of interest are coming down. So basic objective is to look at all information which can help a rational investor to say Maruti Suzuki's fair value is 1000 rupees, and so that I can make my purchases when the share is undervalued
and I can sell it when it is overvalued so that I earn a reasonable rate of return. In fact, it is superior rate of return. When you are making a purchase, when you are buying something when it is undervalued and selling something when it is overvalued, you are going to make significant returns. You are going to make healthy returns. There are two ways of doing security analysis. One is called fundamental analysis and second is called technical analysis. We'll discuss these two approaches as we proceed. So security analysis is basically trying to find what is a fair value for a product, a fair value for a security. If you are going to buy a laptop, you decide that laptop should be worth so much. You are buying a car, you decide that the car should be worth so much. You are buying a garment, you are buying a shirt, you are buying a trouser. Everywhere, any product you buy, somewhere when you look at the product, you decide that this is the fair value of the product, and when it is lower than that, you say let's buy it. When it is more than that, you will say let's avoid it. So technically in a security, what you can do is you can do a buying and selling. So if it is undervalued, you end up buying it, and if it's overvalued, you end up selling it. Now what is fundamental analysis? Fundamental analysis is basically trying to find those factors which are impacting. Fundamental analysis is also called as EIC analysis. Fundamental analysis is also known as EIC analysis. So this looks at factors which impact economy, industry and company. So first you understand the economy in which, for example, if any companies in Russia or Ukraine at this point of time, they are going to go through tough time at this point of time, irrespective of how good the company can do. So the major part is first understanding the economy, then you go to the specific industry, and then you drill down on the company level. So fundamental analysis is based on risk return characteristics of security. Is based on the assumption that share price depend upon the future dividends expected by the shareholder. So what it says is the value of a share is not influenced by demand and supply. Value of a share is not influenced by past price movements. You will understand about past price movements when we touch upon technical analysis. But the value of the share is dependent on what the share can give. What the share can give, that is basically the future dividends. So fundamental analysis basically says share price depend upon the future dividends. The value of the future dividend, when you discount the future dividends, you get something called as intrinsic value of the share. We have done this as part of Walter's model, Gordon's model, FCFE model. So multiple models were there in which discounting of future cash flows and arriving at intrinsic values basically technically like a Gordon's model. We used to calculate the dividends till the end of the stabilization phase and calculate the price at the beginning of the stabilization phase and then try to discount them, and once we have discounted them, we used to calculate what is the fair price of the share. You will buy a share which is priced below the intrinsic value, and you will sell a share which is priced above the intrinsic value, which is basically this point which you saw in question number 1. And there are multiple factors which go into fundamental analysis, but basically it is something which involves economic analysis, industrial analysis and company analysis. Understand what are the factors which are impacting the economy, then go to the specific industry, and then come to company. For example, if you want to analyze Tata Consultancy Services, you will have to look at Indian economy. You may also have to look at US economy. You may also have to look at European Union economy, because Tata Consultancy Services gets a significant revenue from exports. So look at the economy in which they are operating, then look at the industry, that is how is the IT industry performing, then go to the specific company and then look at the performance of the specific company, because your performance is highly dependent on the industry and the economy. There's a high dependence on the industry and the economy. Economy will plays a big part, because suddenly if Indian government says because of COVID they want to close down all industries, and IT industry can try to do work from home, but that leads to some challenges. Maybe other industries are not working. When other industries don't work, the requirement for IT consulting or IT work comes down, and that can impact Tata Consultancy Services. So economy plays a big part. After the economy, industry matters, and then finally drills down to the company. What is economic analysis? What are the factors affecting the same? What is economic analysis is very simple. Trying to find out the likely growth pattern of the economy, trying to find out how the economy is likely to perform over the medium term, what are the challenges the economy is likely to face, what are the positives for the economy, what are the headwinds, what are the tailwinds, what are the problems the economy is likely to face. And economy is impacted by a lot of things. It is impacted by GDP growth, it is impacted by IIP, industrial production, it is impacted by per capita incomes, it is impacted by inflation, it is impacted by interest rates. I think there are so many factors which can impact an economy. So economic analysis is used to forecast the national income with its various components. National income is basically trying to understand how the growth is likely to be, what is the likely growth of the economy to be. So it's used to forecast the national income with its various components that have a bearing on the concerned industry. From there, go to the concerned industry and the company in particular. Now there are multiple factors which go into it. Historical performance of the economy, expectation for the future. Last 2 years, because of COVID, Indian economy has suffered. In fact, it even contracted in the previous year. This year the expectation is the GDP growth will be very high because there's a base effect. The base is on the lower side because last year there was a degrowth. Growth of different sectors, any signs of stagnation, degradation, people's per capita income, inflation, interest rate. So these are the factors which affect your economic analysis. Growth rates of national income and related measure. What is growth rate? Is basically the GDP growth or the GNP growth. So the GDP growth or the GNP growth, basically that is derived from how my agriculture sector is performing, how my industrial sector is performing, how my service sector is performing, because these are the three components of economy for India: agriculture, services and manufacturing. So how all the three are performing, that will lead to the likely growth rate of GNP or GDP, the estimated growth rate of the economy. That will also be a pointer for how the industrial sector is going to perform. It is in fact a cause and effect. If economy is growing at a rapid rate, it is because the industries are growing. When economy grows at a rapid rate, people's income grow because there are more employment opportunity, more money is available, because of which demand picks up. When demand picks up, indirectly it can lead to further growth. So it's a cyclical scenario. Economy grows, industry grows, industry grows, economy grows. Because economy grows, employment grows, demand grows, and indirectly industry start growing. So economic growth in India's context, the economic growth is likely to be very healthy because we have a lower base, and on base of that the growth is likely to be very healthy for the next, at least for the next 12 months or so. The only thing is, in case another wave of COVID comes in, that can lead to some challenges. Growth rate of industrial sector. So from the economic growth, you find out how the growth rate is likely for the industrial sector, that is different industries. And I am interested in the industry in which, if I am Maruti Suzuki, I am interested in automobile sector. If I am Tata Consultancy, I am interested in IT sector. If I am Reliance Industries, I am interested in oil and gas. So how the growth is likely to be for my industry, so that I can get to know how the demand is going to be for my product. Inflation. Inflation is very critical because inflation, if there is a continuous inflation, you will see RBI coming into picture and trying to control inflation. Because when inflation goes up, the purchasing power of money comes down. And when that comes down, you will see a demand effect. So inflation is also one factor which people try to control, because if inflation goes up significantly, it can lead to a lot of challenges. And that can have a demand effect. So inflation is something which needs to be controlled. You need to control it with flow of money and try to ensure that inflation is within check. Monsoon is also one more factor which can impact, because a bad monsoon will have effect on agri sector. If there is a bad impact, the entire rural economy will suffer. And in India, rural economy also is a significant part of the overall economy. So many companies may be deriving a significant proportion of their revenue from rural sector. So monsoon can impact their income, which can in the end end up impacting the demand of the various companies. Now, what are the techniques used for economic analysis? What is economic analysis? Is I want to know what is the likely growth rate. What is the likely growth rate? That is the basic requirement of doing economic analysis. I want to know what is the likely growth rate of the economy. Now, in order to find the likely growth rate of the economy, we have multiple techniques. I think there is an anticipatory survey method, there is an indicator approach, there's an economic model building approach. So multiple approaches are there. I think we have something called as survey, anticipatory survey, indicator based, economic model building. The end result is simple. I want to know what is the likely growth rate. So what I do in anticipatory survey is I look at certain experts and I am trying to get an opinion from them about the future state of the economy. Basically, I'm going to do a survey with them. With set of questions which I want to ask. Once the survey results come in, I aggregate, and based on the aggregate, I can get to know what is the likely growth rate. They help investors to form an opinion about the future state of the economy. It incorporates expert opinion. You try to get opinion on construction industry, capex, level of inventory. You will get an opinion on IT industry, automobile industry, rural economy, urban economy. Try to get opinion from them. After getting the opinion, you can get to know what is the final result. Now, in a practical world, there are certain drawbacks which are there in the survey method. One, once you do a survey, it's not necessary that the final result materialize exactly as per the survey. The materialization can be different. So it may not exactly materialize as per the survey. And sometimes what can happen is when you're trying to achieve a survey result, there's a possibility that you are trying to arrive at a consensus approach. That is, you're trying to arrive at the same opinion by multiple people, and because of which this may not be regarded as a proper forecast, because you're just trying to get opinion of multiple people and arriving at a single opinion which may not give the proper opinion about the future. Now, in order to avoid this drawback, what they say is you will have to continuously monitor. You'll have to do a continuous monitoring of survey results. Once you do a continuous feedback or continuous result, if you are taking survey results from some 1,000 people or from 500 people, if you can continuously get it periodically, maybe once in a month or once in 3 months, if you can continuously get results from there, I think the survey results can be better. Next is indicator approach. Now, indicator approaches, today I can look at certain indicators and say how the economy is likely to perform in future. One of the indicators called leading indicator, which is capital investments. If lot of people are doing capital expenditure, today, it's an indication that economy is likely to grow at a healthy rate in future. So there is a leading indicator. They lead the economic activity in terms of their outcome. They relate to the time series data of the variable that reach higher low points in advance of economic activity. If industry is performing bad now, but still the leading indicator may say that there is huge capital expenditure happening. During COVID time, or once the COVID recovery started coming in, you still were seeing that the economy is not growing that much, but people started doing capital expenditure, because the understanding is that once you do capex, there is a hope for a recovery, and once that recovery happens, you will be able to get the benefit of that. So investments being done by company, government investments, private sector investments, the capital expenditure is a perfect example of a leading indicator. Coincidental indicator is when economy is performing well, this will also do well. These indicators will also indicate that things are going well. Example is per capita income. if economy is performing well, the incomes of the people would also be going up at the same time. It's not in advance. So certain indicators happen in advance, like capital expenditure. Certain indicators happen along with the activity. Example is per capita growth, and certain are lagging indicators. Lagging indicators is, you may be in the bull run as of now, and the indicator will show the effect of bull run after some time. The indicator will show the effect of bull run or growing economy after some time. Example, unemployment rates. Example, unemployment rates. Unemployment rates, the effect of unemployment rates come little. There's a lag effect. You will not see immediately the unemployment effect. If economy is shrinking, immediately jobs will not be lost. You will see the effect of that maybe in 2-3 months or maybe in 6 months time. And when economy is reviving back, you will not see immediately employment rates going up. That also takes a little bit of a time. So there are leading indicators, there are coincidental indicators, there are lagging indicators. Once you monitor these three indicators, it will help you in understanding. In which side all these approaches suggest direction of change, whether it is going up or coming down. It is not going to tell you exactly the growth rate and all, but it can tell you whether the economy is likely to grow or the economy is likely to have a downfall. The next approach is economic model building approach. Now, what economic model building approach is basically saying is, the economic growth which happens is dependent on multiple variables. So the GDP growth is dependent on agri growth, is dependent on industrial growth, is dependent on services growth. Agri growth is dependent on rural economy or maybe monsoon. Industrial growth is dependent on incomes of the people. So there are multiple factors which impact every industry, and all these industries will finally lead to the growth of the economy. So what they say is, if you want to forecast the growth, please start forecasting the components. Of GNP rather than trying to forecast the economy as a whole. What is the consumption expenditure, private investment, government investment, exports, imports? Try to forecast each of these activity. Once you forecast all of this, you can add them together and get to know what is the forecasted GNP. So this will help you in understanding the growth. Also, what we do is, you will compare this GNP growth with the growth rate which is being released by some of the agencies or some of the other indicator, like your anticipatory survey may give a result. So you will compare it with an independent agency, and based on that comparison, you will be in a position to tell whether the growth rate is likely to be healthy or whatever is the growth rate likely to be. So economic analysis basically tries to find what is the likely growth rate of the economy. It is dependent on multiple factors like growth rate of national income, industrial sector, inflation, monsoon. I can add also interest rates, services sector, industrial production. So multiple factors are there. 4 factors have been given in your material, and there are techniques to do this economic analysis. The techniques to do economic analysis is anticipatory surveys, which is basically trying to get an expert feedback on multiple factors which affect the economy and do an aggregate analysis. Your barometer indicator approach, where you have a leading indicator, coincidental indicator and a lagging indicator. And the third approach is economic model building approach, where you split the economy into multiple segments, try to forecast them, add them together and get to know the aggregate growth, and do a comparison with the growth rate which is released by some other independent agency. So we have done with economic analysis. In the fundamental analysis, the first segment is economic analysis. The second segment is industrial analysis. Now what is industrial analysis? Is trying to find out the likely growth rate of the industry, in which I am operating. and this is impacted by multiple factors. Okay, the industry or the prospects of the industry. In fact, you can think about Porter's 5 forces model. How is the bargaining power of the buyers? How is the bargaining power of suppliers? What is the intensity of competition? What are the likely future growth? So multiple factors are likely to impact an industry. So industrial analysis basically is trying to find out how the growth rate of that industry is going to be. Is concerned with analyzing the expected performance of the specific industry to which the product belongs. You will have to assess demand, cost structure of the industry, other factors which can have, because suddenly an industry prospects can change. Suddenly an industry prospects can change by even a government decision. Government can suddenly announce something in the budget which can lead to a favorable demand scenario for some industry, or which can be a favorable announcement for an industry. Now, factors affecting industrial analysis. The first part they're saying is product life cycle. You will have to check the product which you are selling. Is it in the initial stage or in the maturity or decline stage? The product which you are selling, or the product, for example, let's take a classic example, camera. Camera is currently more or less in the decline phase, because many people are not buying camera. I had bought a camera some 15-20 years back and used to take a photo and take a printout of that. But now mobile phone is what does that. So an industry usually exhibits high profitability if you are in the initial or growth phase. But if you reach the maturity and decline phase, you will start showing deteriorating profitability. Demand supply gap. Also, you need to check how is the demand supply scenario. If the demand for a product is more than the supply, if the demand for any product is more than the supply, it will contribute to very high profitability. On the contrary, if supply is higher, it will reduce the profitability of the industry. It is going to reduce the profitability significantly. Next factor is barriers to entry. This is one of the factor of Porter's 5 forces model. So somewhere Porter's 5 forces model factors will come here. Barriers to entry has an impact on your demand supply gap indirectly. If many people are not coming in, you will not see a significant increase in supply. And if supply is not going up, significantly, you will see a demand supply gap that can contribute to profitability. So if there are barriers to entry, it will be good for the existing companies. They'll keep performing well. Barriers can be technology barriers, experience barriers, size barriers, human resource barrier, land availability. It could be anything. An industry with high profitability would attract fresh investments. The potential entrant, however, face different barriers to entry. So the barriers can be based on technology, based on customers, based on product, based on patents. So all that can impact. Government attitude. Government would be favorable for certain industries, and government may have a negative view on certain industries. So for example, the plastic covers or plastic spoons, plastic bottles. Government currently has a negative view. They want to remove the single-use plastics whichever is possible, the plastic glass and other thing. So gradually that industry will suffer. So and government wants to promote certain industry. So what is the impact? What is the view of the government on that industry? That is also likely to impact. The industry in which I am operating in. State of competition of the industry. This is one of the factor of your Porter's 5 forces model. How is the competition in the industry? Are there many players? Is there growth rate? How can you differentiate yourself from others? Is it possible for you to charge a premium pricing? So factors to be noted: leadership capability, nature of competition. Homogeneous means similar product. Differentiated means one product can be differentiated with others. Type of industry the firm is placed. So all these factors are likely to impact the state of competition in the industry. Cost conditions and profitability. What is cost conditions and profitabilities? The cost of a product is dependent on material, labor and overheads. So now you need to see how the likely effect of that is going to be there over the medium term. Is the cost likely to go up significantly? Is the labor cost likely to move up significantly? Are the overheads likely to increase significantly? Because if they increase, if there's a significant increase on the cost side, is there a flexibility to increase prices? If you don't have a flexibility to increase prices but cost goes up, you have to do capital expenditure, you have some idle capacity, all this will lead to weaker profitability. All this will lead to weaker profitability. All these factors is at an industry level. I'm not trying to analyze anything at an entity level. I'll analyze everything at an industry level. Research and technology. Now technology is one factor which impacts every industry. There's nothing like an industry which is not impacted by technology. So technology can give you some competitive advantages also, and technology will also tell what is the need for the new products, how are the new products likely to come in, how can technological developments be done, whether my product can sustain in relation to the technological changes which are happening, whether I'll be able to grow or not grow. Because a product which I have today, Nokia mobile phone, the basic feature phones which Nokia had are not being bought by people at this point of time, because smartphones is the current scenario. And you also need to do a lot of research and development, because with R&D you can come with new products. So these are the factors which are likely to impact the industry. Basically the Porter's 5 forces model, somewhere relation to that: product life cycle, demand supply gap, barriers to entry, government view, the competition which is there, cost structure which is there, the profitability impact because of the cost structure, whether the prices can be increased or not, research and technology. So all these points are likely to impact the industry. Now, like we have approaches to do economic analysis, where we have your anticipatory surveys, economic model building approach, we have your leading indicators, lagging indicators, coincidental indicators. There are certain techniques to do industry analysis. There are certain techniques to do industry analysis. One of the technique is regression and correlation. Regression and correlation is kind of interchangeably used. What is correlation? Correlation is trying to find out the relationship between one security's return and another security's return, or one factor and another factor. Regression analysis can be a single factor regression analysis or multi-factor regression analysis. Now what basically is a single, see what is regression analysis is it tries to establish something called as cause and effect relationship. For example, the demand in rural economy is highly dependent on monsoon. The demand in rural economy is highly dependent on monsoon. So monsoon and demand in rural economy. So you see, the cause is monsoon, the effect is demand in rural economy. So you will try to find out, investor analyzes the various factors which affect the demand of a product. Factors to be considered: GNP, disposable income, per capita consumption, price elasticity of demand. Multiple factors which are likely to affect the demand. If it's a single factor regression analysis. Multiple factor, for example, the rural demand which I was talking about, it's dependent on monsoon plus employment rates plus the incomes there. So considering all of this, you decide what is the likely scenario. Next is input output analysis. Now what is input output analysis? Is basically tracking the raw material stage till the finished goods stage, flow of goods and services through the economy, intermediate stage in production process as goods proceed from raw material stage to final consumption. Once you keep detecting this, if there is a reduction in the raw material flow to an industry, it is going to indicate that that industry is going to have suffering, because the raw material demand is coming down, which is indirectly going to indicate that the FG demand is weakened out, or the FG demand is weakened because of which the raw material demand is weakening. So it could be an indicator. So input output analysis can help me in understanding what are the changing patterns or trends in the raw material or in the finished goods demand, and that can help me in analyzing the industry analysis. So regression analysis or correlation analysis. Regression correlation is not used in your material, but correlation analysis can also be done. So single factor regression analysis, multiple factor regression analysis, and input output analysis. So these are the two ways of doing industry analysis. Hi friends, so let's now continue with your chapter 3 theory discussion. In the previous video you have seen question number 1 to 6. Basically you would have learned what is security valuation. That is basically security valuation is an exercise in knowing what is the fair value of a company, and there were two approaches to do it. One is fundamental analysis and technical analysis. In fundamental analysis we have covered economic analysis, industry analysis, and now we come to company analysis. Your fundamental analysis is otherwise called as EIC analysis. In that, economic analysis and industry analysis is done. Let's come to company analysis. Now what is company analysis? Is analyzing the specific factors which is related to that company. There can be multiple factors which you can take for the company. For example, you can take net worth, book value, EPS growth, dividend payout. All these are specific to the company. Quality of management, patents, new products, new customers. So all these are specific to company. We are going to analyze what is the factor which can impact at an individual company level. So the first factor is net worth and book value. What is net worth? Is basically the book value of equity. Net worth is equal to share capital plus reserves and surplus minus your fictitious asset. So that's the net worth of the company. You divide by the number of share and get to know the book value. Once the book value is ascertained, the book value can be compared with market price. The book value can be compared with the market price, and based on that, it is possible for you to arrive at two different conclusions. Sometimes the book value is 100, market value is 500. It may indicate that the market is valuing this company very high. The book value is only 100, market is putting a value of 500, so maybe the share is overvalued. That's one way of looking at the market price. The other way of looking at this, you may understand that okay, the market is valuing at 500, maybe there is huge potential in this company. There's huge potential in the company, and this company is likely to grow significantly. So that ratio will be looked at. You compare the book value with market value, and based on that you can arrive at different conclusion. Net worth is the sum of equity share capital, preference share capital, and free reserves, less intangible assets and any carry forward of losses. So you remove all fictitious asset. The total net worth is divided by the number of shares, is the much talked about book value per share. So book value is basically an indication of the intrinsic worth of the share, the intrinsic value of the share. But there can be the intrinsic value based on market price. If you look at Tata Consultancy Services, the book value will be very less, whereas the market price will be very high. The market price reflects the future earning potential, and therefore it may not have any relationship with the value of the assets. In my books of accounts, I may have to record, I may not be in a position to record certain items like patents or the goodwill of the company. All that cannot be recorded, but that is leading to huge revenue growth for the company. Second, the book value is based on historical cost. So your land and building, which you could have acquired some 50 years back, you will have it a very low value. The current market price is on the higher side. So book value may not really reflect the intrinsic value of the company. Sources and uses of funds. Now what is sources and uses of funds? Is a company has long-term sources, short-term sources. Long-term application, short-term application. What is long-term application? Is investment in fixed assets. What is short-term application? Is investment in current assets. The rule is simple. Long-term assets needs to be funded with long-term funds. Short-term assets need to be funded with short-term sources. Sometimes what companies end up doing is some of the long-term investments like fixed assets, you may buy it with short-term liabilities. if you are buying with short-term liabilities, it can lead to liquidity crunch. It can lead to liquidity crunch. The identification is also known as fund flow analysis, is to find out whether the firm has used any short-term sources of funds to finance the long-term investment. Can lead to liquidity crunch because your long-term investments take longer time to earn the return, whereas the short-term liabilities need to be disposed of immediately. You need to pay them within a shorter period of time. Cross-sectional and time series analysis. What is cross-sectional and time series analysis? Is you can compare your performance with some other company. You can compare your performance with some other company. Tata Consultancy Services profitability performance can be compared with Infosys, who is another player in the industry. So one of the purpose of examining financial statement is to compare two firms, compare my performance with another company, or compare with the benchmark, industry benchmarks. If you look at I think in moneycontrol.com you will be able to find the industry averages also. Different industry, the averages are available. So you can compare your performance with peer, you can compare your performance with other industry, with the industry. You can also do your own comparison with your performance 2 years back, 3 years back. So it can be compared over a period of time. It can also be compared with other peers in the industry for the same period of time. We also call it as common size statement or financial ratio analysis. Size and ranking. Now what is size and ranking? Is an idea as to what is the ranking of my company, what is the ranking of my company in the economy or in the industry. Whether I'm a big player, I'm a small player, I'm a moderate size player, what is my performance? This is done not by the company themselves. If I'm trying to invest in a company, I may do this. So I want to understand what is the size and ranking of this company in the overall economy and in particular in the industry. So if it's a bigger company, if something it has a better market share, it will be able to have pricing power also. So when it has pricing power, it may not get impacted by some small issues which happen in the industry, or even it will be able to withstand some bigger pressure. So you can do this calculation. Normal way of calculating the size and ranking is my revenue divided by the total revenues of the industry or the economy. They are saying other way also you can do it. Net capital employed, net profit, return on investment, sales figure can be compared with similar data. Next item is growth record. Growth record is your EPS growth as well as dividend growth. You will look at EPS growth and dividend growth and see how the company is growing and whether this growth is sustainable. Because when a company grows at a healthy rate, market does provide a premium for those companies. So it is essential that you need to understand whether this growth can sustain or not. Growth in sales, mostly profits or earnings is what I look at. Net income, which is profits, earnings per share, capital employed should be examined. Why do you do this? This will help you in knowing what is the growth rate of the earnings, what is the growth rate of net block. Net block is my fixed assets, and the P multiple. If you look at Gordon's model, P naught is equal to D1 by KE minus G. Moment you change the growth rate, you will see a significant impact on the price of the share. Growth rate per se has a significant impact on the price of the share as far as your Gordon's model is concerned. Next is financial analysis. See, whatever you have seen earlier, we had done an area called as cross-sectional analysis and time series analysis that can also be extended to financial analysis. Financial analysis, basic ratio analysis. You compare your performance over years. You also compare your performance with others in the industry. You can look at ratio like EPS, price earning multiple, book value, intrinsic value, ROI, capital turnover ratio, cost structure ratio. You can look at profitability ratio. You can look at liquidity ratios. You can look at your return ratios, ROI, ROE, return on capital employed. So multiple ratios can be looked at, and these ratio comparison will help us in understanding how is this company performing as compared to others in the industry. Competitive advantage. One of the area I was talking about is patents, trademarks, when I said initially. So competitive advantage is basically my unique strength which cannot be copied by others. So I will have to understand what is my unique strength, which cannot be copied by others in the industry. So when others cannot copy that in the industry, I'll be able to put in superior performance. So any company I'm investing, if you are planning to invest in Tata Consultancy Services, understand what is their competitive advantage, whether that advantage can get lost. Maybe they have operations in multiple countries, they have some of the bigger clients, they have a huge employee force. So all these competitive advantage, will it sustain, or is it possible for someone to enter the industry and give competition? Few years back, before Reliance Jio entry, you were seeing Airtel, Vodafone, they had a lot of advantage in the industry, and they were also charging a higher price. When I say higher price, for example, there used to be a price for every call which was to be made. The internet was costlier. Now everything has undergone a change because of the competition which came in, and maybe the competitive advantage which Airtel and Vodafone was having, that got lost. Quality of management, this is the most difficult to compare. Quality of management or corporate governance. There will be 2 points, I think, quality of management and corporate governance. This is something which is an intangible factor, but has the most important bearing on the value of the share. If a company is with Tata Group, it has a different value in the market. If a company is with some other group, it has a different value. So quality of management is very, very critical, because sometimes management may try to act in unethical way. They may try to cheat the minority investor. So it is very critical that you are running a business, and that business is run by a quality management. They are competent enough. They have integrity. Integrity is very, very critical. Competence is there. They are able to manage risk. They are also taking risk. So this is an intangible factor, has a very important bearing on the value of the company. Every investment manager knows that shares of certain business houses command a higher premium. Tatas have a better premium than those of similar companies managed by other business houses, because quality provides confidence to the investor. Confidence to the investor. If a company has a very good quality management, you will be okay with paying a premium for that company. Corporate governance is very much linked to the quality of management. So the basic thing is, in corporate governance, you have your SEBI guidelines which talks about certain restriction. You need some independent directors to be there. How are you dealing with your minority shareholder? Are you providing proper disclosures? So all that is very critical. Regulation is basically complying with laws and regulations of the country. So there are labor regulations, there are SEBI guidelines, there are income tax guidelines, there are your Companies Act guidelines. So it is essential that you comply with all these guidelines, because any violation of this can have a significant effect on the goodwill of the company, which will end up impacting the price. Labor management relations. Labor management, one is you'll have to comply with labor laws, and labor management relation is when you have a manufacturing setup, you employ people. There are trade unions which will be there, labor unions which will be there, and sometimes what can happen is, if your relationship with the labor union is not good, it can lead to strike. And if it leads to strike, what can happen is, because of the strike, you will not be able to continue the process, continue manufacturing. So your customers will get impacted, market will see this as a negative point. So one is location. Location is where you are located, because that will ensure that whether you have adequate availability of men, material, machine, money. You'll have to see men, material, machine, money, all are available. Pattern of existing stock holding is, who is holding the company, how much is the promoter holding, how much is the public holding, are there any ace investors in the company, do we have mutual funds investing in the company, do we have foreign institutional investors investing in the company? Because if any mutual fund invests in a company, it kind of reflects that they are very confident about this company. So mutual fund will have a lot of due diligence done. So because of that, if you feel that there are, if you see that mutual funds are holding, normally those companies are viewed positively in the market. Marketability of the share. Now what is marketability of the share? Is saleability of the share. The shares which are being the shares of the company, are they trading or not? Are there people interested in getting the share or not? So how marketable is the shares of the company? How marketable is the shares of the company? Are people ready to ready to buy the shares of the company? Do we see trade happening? If trade is not happening, if it's an illiquid share, then how will you move out of the company? So that can also become a challenge. So there are qualitative factors and there are quantitative factors. Quantitative factors are basically the ratios. Qualitative factors like quality of management, corporate governance, relationship with labor, location of the company, compliance with rules and regulation, competitive advantage. And you look at multiple ratios like your book value, intrinsic value, ROI, ROC, cross-sectional analysis, time series analysis. Doing all of this, you will be able to analyze the company. What are the techniques used in company analysis? Again, I'm going to do this correlation and regression analysis. So correlation, as I said, in regression analysis, you can do a regression of two variable. You can also do a regression of multiple variable. So what are the different factors which impact the performance of the company, and based on that you try to analyze the company's performance and understand whether this company is likely to report a healthy performance over the medium term. So when you do this analysis, you will be able to understand what kind of performance this company is going to put in. When performance of this company is likely to be better, you will see people entering into or people buying the shares of this company. Trend analysis is testing the performance of one variable or multiple variable over a period of time. How is the book value moving over a period of time? How is the ROE over a period of time? How is the revenue growth over a period of time? How is the market price over a period of time? How are the dividends over a period of time? How is the dividend payout ratio? Decision tree analysis is, your decision tree is something drawn like this. So there's a base. The revenue can grow by 10%, the revenue can grow by 15%. This can happen. If it grows by 10%, two things can happen in the next year. You grow by 30%, you grow by 50%. This can happen 70%. So you are trying to look at what possible things can happen, and then you estimate probability for each branch which comes out of it. We have done this in binomial model. In derivatives, you would have covered this. So you look at information relating to the probability of occurrence of the forecast values considered useful. A range of values, it segments into 2, then again becomes 4, again becomes 8. So range of values with probability is taken up. The decision is taken sequentially with probability attached to each sequence, and then you multiply and then sum it up. The final answer is the weighted average of the various possibilities, with probability being the assigned weight. This is as far as the fundamental analysis part is concerned. So in fundamental analysis, we have covered EIC analysis, economic analysis, industrial analysis, and company analysis. Hi friends, let's now start with technical analysis. In technical analysis, it works exactly the opposite of what fundamental analysis is. Fundamental analysis basically say the value of a company is dependent on the earning ability of a company, growth rate of the company, quality of the management, economy growth, industrial growth, the company's prospects, company's core competence, company's competitive advantage. Technical analysis basically says the share price of a company is dependent on demand and supply of the share, and the price moves in a set pattern. You look at the historical pattern of price movement, a similar pattern is likely to happen even in future. Basically what technical analysis indirectly says that price moves in some trend. So trend could be something like this. The same trend may continue in future. If the trend is like this, the same trend may continue in future, and there is a psychology effect. That is, for example, if you buy a share and the price of the share crashes by some 10-20%, and it's not because of some weak news or some issue with the company, but general market sentiment. War has happened in Russia and Ukraine. Because of that, the share price of many companies have crashed. What fundamental analysis will say is you should go ahead and buy the share now, because the value of the share has come down in the market. The intrinsic value would continue to remain high, but because of the market sentiment, the price has fallen. But If you look at human psychology, when share price crashes down, many people move out of the share. Many people move out of the share. Instead of buying the share at that point of time, they liquidate their holding. They liquidate their holding. So lot of decision in the normal practical world are influenced by emotions, and technical analysis basically say that whatever trends and prices have happened in the past, same trends will continue in future. Is a method of share price movement based on study of price graph or charts, the historical price graph or chart, on the assumption that share price trends are repetitive. The trend which you see in the past, similar trends will continue in future, because investor psychology, the psychology follows a certain pattern. The emotions play a part, and same pattern will continue. So what does a technical analyst tries to do? He tries to find, is there a trend in the prices? Is he able to find a trend in the prices, and when is the trend likely to reverse? So he tries to answer this. In order to do this, he uses a series of visual tools and statistical tools. Visual tools are charts which are prepared, the historical price graph, and statistical tool is you are trying to calculate certain statistical data like exponential moving average, 5-day moving average, 10-day moving average, 30-day moving average. So using these averages and the charts, you arrive at some decision, and based on that decision, based on that understanding, you decide whether the share is likely to move up or come down. In fact, technical analysis is only for a short term period. Basically, you are predicting what is going to happen over the next one day, or it could be even few hours. So you are trying to predict what is likely to happen looking at the chart. What is a likely scenario, and based on that you arrive at a decision. Whether to buy a share or sell a share. The methods used to answer is visual and statistical. The visual methods are based on examination of variety of charts. Statistical analyze the price and return data. You look at the historical data, and based on that you decide. Now, there are certain assumptions of technical analysis. One of the assumption is the market price of the share is dependent on supply and demand of the stock. Fundamental analysis also indirectly has the same point, but the supply and demand is influenced by fundamental factors like earnings growth, dividend growth, management quality. So here they are saying it depends on the supply and demand, which can be influenced by several factors, but then they went ahead and said it will move in some trend. Stock prices generally moves in trend which continues for a substantial period of time. So the objective of technical analysis is to look at charts, look at past trends, look at statistical tools, and then decide how the share is likely to perform over the medium term, rather than looking at the information which is there in the financial statement. It does not rely on information of financial statement, or it does not rely on earning ability of the company. It does not rely on future growth ability of the company. It looks at the price chart, and based on that you arrive at a decision. Now there are certain principles of technical analysis. The first principle is market discounts everything. Now what is market discounts everything is, according to technical analysis, you are likely to ignore all fundamental factors. What are fundamental factors? We have seen many things: economy, industry, and company. You will ignore everything. And it only considers price movement. Now people are not okay with some assumption like this, because you cannot ignore the fundamentals of the company. So for this, there is another point which is called as efficient market hypothesis, which you will see in this chapter. According to efficient market hypothesis, a market is said to be having strong form of efficiency, and when it has strong form of efficiency, the share price basically considers all the fundamental information which is there in the economy, or which is there in the public sources. The entire set of information is automatically considered in the share price. So when it is automatically considered in the share price, now what is other fundamentals to be considered? So fundamentals is already factored in the share price. So you are now likely to look at only the price charts, and based on the price charts you find the trend, because price moves in trend. It is possible to find a trend. Once you find a past trend, past trend, the share price will mostly move in that trend. Sometimes reversal will happen. There are certain theories like Elliott wave theory, which you'll learn in some time. There are reversals which will happen. So price will move in trend. And another principle, I think history repeats it. History is going to repeat itself. History tends to repeat itself. So whatever has happened in the past, similar trends are likely to happen in future. So looking at the past price movements, it is possible for you to forecast, and based on the forecast, it is possible for you to tell what is the likely result. What is the likely result, or how the share price is likely to go up or come down. So that is something which is possible. So this is as far as technical analysis is concerned. Now for technical analysis, there are multiple theory. I think there is a Dow theory, there's a random walk sorry, there's a Dow theory, not random walk. Dow theory is there. Elliott wave theory is there. So multiple theories there. Now coming to Dow theory. Now Dow theory was given by this person called Charles Dow. He basically said there are two indices are available. One is Dow Jones Industrial Average and Dow Jones Transportation Average. There are two indices there in the market. Both of them can move up. One of them can move up, one of them can come down. So what basically happens is, if the industrial performance is improving, it will lead to an effect on the transportation average. The transportation will also start showing improvement, because the industry is going to have an effect on the transportation demand. The industry is going to have an effect on the transportation demand. So Dow Jones Industrial Average and Dow Jones Transportation Average, you look at these two indices, and based on these two indices, you have three types of movements or three classification. There's a primary movement, there's a secondary movement, and there's a daily fluctuation. There's a primary movement, there's a secondary movement, and there's a daily fluctuation. Primary movement is for a longer period of time, maybe 3 years, 5 years, or maybe 2-3 years. Either it's a bull run or a bear run. So if you look at how share price moves, Nifty, if it's it'll keep moving up, but it normally doesn't move up continuously. So it is not that it will move up like this. It will continuously have movements like this. Up, down, up, down, up, down will be there. But overall, successively, you will keep seeing it moving up. Successively, you will see it keep moving up. The successive tops will be higher than the earlier top. The successive top or the successive bottom will be better than the earlier bottom. So it will keep moving up like this. It will keep moving up like this. This longer period, this cycle is called as primary movement. Then we have secondary movement, which is going to be opposite of your primary movement. It doesn't keep moving up. You see this down. There's a down movement which happens. There's a down movement which keeps happening. That down movement is called secondary movement. Primary movement is the main trend of the market, which lasts for 1 year to 36 months or even longer. This will help you knowing bear or bull market. The diagram which I've drawn is for the bull market. It is continuously moving up. The successive top are better than the earlier top. Secondary movement is shorter in duration and it's opposite. It is opposite. Daily fluctuation is, I have drawn a graph like this, but daily, within a day, it can keep moving up, moving down. So it's not that the market only keep moving up. So this daily fluctuations may not be that critical, because these are narrow movements on a day-to-day basis. But once you study it over a longer period of time, because this daily movements only make up the secondary movements or the primary movement. Now, based on this, you can interpret whether it's a bull market or a bear market. If your successive highs, the theory in practice states that cyclical swings will happen. If your stock market averages are successively higher and the successive lows are higher, that is, this is better than this, 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 this is better, this is better, this is better. Your successive ups and downs are better than the earlier ups and downs. It is basically a bull market. Basically a bull market. Otherwise, it's a bear market. Bull market is going up. Bear market is coming down. And even in the bull market or a bear market, there are three types of investor. Three moves they say, but there are three types of investor. For example, during COVID time or during this war, market is shrinking now. Market is shrinking now. Some people may see this is an opportunity to buy. Those set of people are far-sighted, knowledgeable investor. Far-sighted, knowledgeable investor. They are buying today when market is extremely weak. Now the expectation is market may even further crash, because if war intensifies, the market may crash. So people are buying at this point of time. Far-sighted, knowledgeable investors are buying at this point of time. The second move is if a lot of people are buying in, the expectation is this knowledgeable investors are buying because the company is likely to do well. So the company starts doing well. Their quarterly results show that better performance, report of financial well-being. So it starts showing performance. It starts showing performance. Once it starts showing performance, then next set of investors come, and then the third set of investors come who start speculating, because the company would have moved up significantly. People are not ready to buy a share at 100, but when it has moved to 400, they are ready to buy because it was continuously moving up. So what the theory says is the knowledgeable investors will enter at the first stage and will move out of the company at the third stage. Towards the end of the third stage, the far-sighted investor, realizing that high earning levels may not be sustained, would start selling, and they will understand that this is the first move of a downtrend. Then the second move will happen, and the third move will happen. So always three moves will happen. So the theory said there are two types of indices. One is Dow Jones Industrial Average and Dow Jones Transportation Average. Your transportation average demand is dependent on how the industrial averages are doing. There are three classifications. There's a primary movement, there's a secondary movement, there's a daily fluctuation. Primary movement is for a longer period of time, which basically explains the bull market or the bear market. The secondary movement is opposite of the primary movement, and daily fluctuation is small fluctuations which will keep happening. If you consider this over a longer period of time, it will make up the primary movement or the secondary movement. How can you interpret bull or bear market? Is looking at those successive highs or successive low. If your successive highs are better than the earlier highs, or successive lows are better than the earlier lows, it's a bull market. Otherwise it's a bear market. There are three types of people. Far-sighted, knowledgeable investors will enter at the first stage. Company will start doing well, and then the speculators will enter into the company. Next is Elliott wave theory. Again, the Elliott wave theory is basically saying that the price movements which happen, the price movement of a share which happen, it will exhibit certain repeated patterns or wave. Certain repeated patterns or wave is likely to be there. Now what is this repeated pattern or wave is? The chart which I had earlier said. This is a repeated pattern or repeated wave which is happening. The price movements are likely to be like this. There are patterns like this, and because of this pattern you will be able to understand how the share price is likely to move up or come down, and there are going to be reversals also. It's not that the patterns will continuously keep moving up. As per the theory, wave is a movement of market price from one change in the direction to the next change in the same direction. These waves are resulted from buying and selling impulses from the demand and supply pressure. There are two types of waves: impulsive patterns and corrective pattern. Whatever I have drawn as impulsive pattern, corrective pattern is it will reverse now. At some stage it will end up reversing. That is called corrective patterns. The reversal will happen at some stage. That's called corrective pattern. Again, impulsive patterns will happen. It will start going up. Correction will happen, or it will start going down. The pattern could be like this also. This is impulsive, and then it reverses. So initially it keep moving down, and then it repeats, and then it starts going up. It starts going up. So there will be 3 or 5 waves in a given direction. It could be going upward or downward, and this is basically the basic movement, and this indicates whether it's a bull phase or a bear phase. I'll show you a diagram, proper diagram. It is there in your study material. So this is wave 1, wave 2, wave 3, wave 4, wave 5, and after this the correction move will also happen. The correction move will happen. See, basic rule is your successive up. 3 is better than 1, 5 is better than 3, 4 is better than 2, the successive low, the successive high, and then the reversal has happened now. The reversal has happened. This is corrective, impulsive and corrective, impulsive patterns and corrective patterns. Your corrective patterns are against the basic direction, so it will show a fall in the bull market and show up in the bear market. What you should do is you should look at this complete cycle and then considering the complete cycle, you can decide whether it's a bull market or a bear market, and you can plan your entry and exit. You can plan your entry and exit. The next part is your random walk theory. This is another theory which is part of your technical analysis. So according to random walk theory, what they ended saying is, it is technically impossible for anyone to predict stock market prices. In fact, he went ahead and said, for example, you throw a dice. When you throw a dice, it's impossible to say whether you'll get number 1, number 2, number 3, number 4, or number 5, or number 6. Or there is a roulette wheel. So when you do a roulette wheel, when you do that, what number will turn out of the roulette wheel, you don't know. What number will turn out of the roulette wheel. Similarly, they have said stock prices are unpredictable. It is difficult for anyone to predict what is the likely movement. So many investment managers, stock market analysts believe that stock market prices can never be predicted, because there are a lot of factors which impact it. Hence it is unpredictable and it is impossible to find any relationship. So it is the changes in the security prices which happen is behave as if you have a roulette wheel. So every time when you do this, the number can turn out to be different. The only thing is, again, it says you can ignore your fundamental factors. The only thing is price trends can be there. Prices of the shares can never be predicted. Price trends are not the result of any underlying factor, but they represent the statistical expression of past data. The only thing is, looking at the past price movement, it is possible for you to find the trend. There can be periodic ups or downs, but no connection can be established between two successive peaks and trough. So technically, in simple words, they have said stock market is more like a lottery. It's more like a lottery. It is impossible for you to predict what is likely to happen. So there are three theories. One is your Dow theory, which talks about your two indices and three classification. Then you have your Elliott wave theory, which has your impulsive patterns and corrective patterns, and then random walk theory is there, where they basically said that stock prices are not predictable, your movements are unpredictable. It's like a roulette wheel where anything can happen when you do it. So it is impossible for anyone to predict. You can look at the trends may repeat, but it is still impossible to find a link between the earlier trend and the current trend. Various market indicator. Now the question will not be on, the exam question will not be various market indicator. The question may ask what is breadth index or what is volume of transaction. Now let's first understand what is breadth index. Now breadth index is basically looking at so many securities in the market. So you have some 1,000 securities, or in fact some 5,000 shares will be there in the market. So what you do is net advances or declines in the market by the number of issues traded. So you will try to calculate this. Once you calculate this, you'll be able to understand what is the movement in the market. The breadth index can either support or contradict what happened in Dow Jones averages. Dow Jones average may say it's a bull market. Breadth index may also say bull market, or Dow Jones may say it's a bear market and breadth index may say it's a bull market. So it can either support it or contradict it. If it supports, it's technical strength. If it contradicts, it is a technical weakness. So it can be added in along with the Dow theory, and based on that you can interpret whether it's a bull market or a bear market. Volume of transactions is basically how many shares are traded in the market, the number of shares traded in the market, how many people are interested in a company. So if your share price is going up and volumes are also going up, it is basically an indication of technical strength or bullish scenario. When share prices go up and volumes are going up, it is a buy signal. When share prices are coming down but volumes are going up, volumes have to go up in both, okay? Volumes have to go up and share prices go up, bull market. Volumes have to go up, share prices are coming down, bear market. Basically what it means is volumes are going up but still share prices are coming down, which means so many people see a volume will happen only when there is a buyer and seller. So if there are many buyers and many sellers, and share prices are going up, it is a strength. Share prices are coming down, it's a weakness. Next is a confidence index. Now confidence index is basically calculated by comparing two things. One is high grade bond yield and low grade bond yield. High grade bond yield is a better bond, a company which is good in the market, maybe a AAA rated bond. A low grade bond yield is something which is a weaker bond. So high grade bond may have 8% rate of interest. Low grade bond may have a 12% rate of interest. So you will calculate like this. It is supposed to reveal how willing the investors are to take a chance. Ratio of high grade bond yield to low grade bond yield. If this is moving up, the confidence index is moving up, if you see this ratio moving up, it is likely to precede a rising stock market, and if it's moving down, it's likely to precede a drop in the stock price. So you can look at the confidence index and then decide how the performance is likely to happen at the entire industry level. Relative strength analysis is basically when there is a bull market, expectation is our share will also go up. When there's a bear market, the expectation is our share will also come down. But what you will see, some of the shares, when it's bull market, it will go up. Market is going up by 2%, but this will go up by some 5-6%. It will go up by 5-6%. I'm not talking about the beta. Beta is a concept which says if market goes up, our security can go up at a higher level because of the implicit beta, the risk which it carries. Market goes up by 2%, our share also goes up. Market comes down by 2%, our share comes down by only 1%. When it goes up at a better pace. When it comes down, it falls at a lower pace. The relative strength says that price of some securities rise relatively faster in the bull market, decline more slowly in a bear market than other security. This basically indicate that you are exhibiting better strength as compared to others in the industry. When you compare other securities, you are performing better. If you are able to find such companies who have demonstrated relative strength in the past, then this is likely to continue in future, and if you are able to invest in such companies, you will be able to generate high average returns. So you will have to find such companies and who perform better in the bull market, who perform better even in the bear market. When I say better in the bear market, the fall is lower than what is happening at the industry level. Odd lot theory. What is odd lot theory? Is basically going against the popular opinion. The popular opinion, if you look at this point of time, because a war is going on, many people say avoid equities, or many people may come out saying that Nifty can fall. If you act opposite to the popular opinion, this theory is contrary opinion theory. It assumes that average person is usually wrong, and wise course of action is to pursue strategy contrary to popular opinion. So when you act contrary to popular opinion, when market is continuously going up, you will act opposite to the popular opinion because you are predicting that you have reached the top of the bull market. So it is better now to move out. So these are the indicators which are there. One is breadth index, which is basically covers all the securities traded. It measures your net advances or declines. Volume of transactions, whether the price is moving up or coming down, you will have to check, along with rising volume. It has to be with rising volume. Confidence index is yield of high grade bond divided by yield of low grade bond. If this index is moving up, it is likely to signal a rising stock market, and if this index is coming down, it is likely to signal a drop in stock price. Relative strength is how is this company performing as compared to others in the industry or as compared to others in the market. Odd lot theory is acting opposite to the popular opinion. Support and resistance level. Now support and resistance level, again I'll explain with one of the graph which can be there in your material. Now this is some price movements of some two companies. Okay, this is there in your study material. This price movement, and based on that a graph would be drawn. So this graph is drawn. Now once you see there are company A and company B. If I look at company A, this is the highest point, and maybe this is the lowest point. There is a highest point and there is a lowest point. Similarly, there is some highest point, there is some lowest point. The highest point is basically called as resistance. You are not able to move beyond that. You are not able to move beyond that. And the lowest point is technically called a support level. Technically called a support level. You are not falling. Your share is finding support at that level. It is not falling below that. Share is finding support at that level. It is not falling below that. And share is not moving above a resistance level. There's a resistance level beyond which it is not moving up. There's a support level beyond which it is not falling down. So in this case, 100 and 125 for company A. 100 is the support level, 125 is the resistance level. So when you look at the chart, you will understand. Now why this is critical is, moment you are coming closer to resistance level, you can understand that the price may fall because it is finding it difficult to go above that. So it may fall. And if you are closer to the support level, it may indicate that price is likely to go up. But there is practical possibility that your support and resistance level can be broken and a new support and resistance level will come. New support. When the index or price goes down from a peak, the peak becomes the resistance level. The peak, the top. When the index rebounds after reaching a trough, trough is the lowest point, the lowest value becomes the support level. The price is then expected to move beyond the level. So whenever the price approaches the resistance, when you touch the resistance level, there is going to be selling pressure. There's going to be selling pressure. All investors who fail to sell at the high would be keen to liquidate. When it reaches the support level, there is going to be buying pressure. There's going to be buying pressure. Now what are the tools to interpret price pattern? I am not an expert in technical analysis, so I'm not covering this because these are technical tools. These are technical tools to interpret price pattern. I don't see them getting tested in exam because it is slightly difficult for you to understand these tools. But for every tool, you can look at a chart. There will be a chart in your study material. It's not there in my book, but in your study material there will be a chart, and basically these are price graph. Price graph can something be like this, the share price of a price of a share, or it can be something like this. So based on this, you will arrive at some technical analysis and say when to enter. These are patterns. These are patterns. So similar patterns will happen in future. And basically, you may want to buy here, you may want to sell here, something like this. You can decide. So technical analysis part, the tools is something I'm not covering as part of class. In fact, in my material, I've not even covered one area called this, maybe because theory is critical. You can also look at the charting techniques. This is not there in the theory. Line chart, bar chart, Japanese candlestick chart, and point and figure chart. So these are 4 types of charts which can be prepared. The charts form the basis for doing any technical analysis. This is part of the study material, so just cover them as well. The 4 types of charts and the tools to interpret price patterns. How to identify buy and sell signal provided by moving average. Now what is moving average analysis is, you will look at the historical data. So you can get data for the last 3 years also. Then you can prepare 5-day moving average, 10-day moving average, 15-day moving average, 20-day moving average, 30 days moving average. So let's look at one example which is there in your study material. So these are the prices which are given. Sum of the 5 recent closings. So this is summation of 1, 2, 3, 4, 5. This is 2 to 6, 3 to 7, 4 to 8. So summation of 5. And then you're adding 2 periods here. So technically it's 10-day total. This is technically a 10-day total, and you have divided by 10. You have divided by 10, and this is the moving average. This is the moving average. So moving average compare with the closing price. Moving average is 25.5. This is at 26. 25.65. This is at 26.5. 25.8. This is at 26.5. So you look at the moving average. Calculate. It can be 5 days. It can be 10 days. It can be 30 days. It can be even 200-day moving average. So you look at those data points, and based on that, based on your stock price line rise through the moving average line. The stock price line is rising through the moving average line. When graph of the moving average line is flattening out is it is flattening. That's a buy signal. Your stock prices are better than the moving average. It is basically a buy signal. Or the stock price line is falling. The stock is falling maybe, but the moving averages are going up. Which is why moving averages are going up, because historically over the last 10-15 days you saw continuous movement, and now suddenly there is a dip. So again it's a buy signal. Please go ahead and buy. Please go ahead and buy. Stock price line which is above the moving average line. stock price which is above falls, but again begins to rise. So when it begins to rise, you start. So whenever your stock price line is showing some up movement, as compared to the moving line averages, there can be a buy signal, or the stock price line is falling below the moving average line, This is exactly opposite. The stock price is falling, so below your moving average, the stock price is falling. And one scenario is stock prices line rises above moving average. See, when your moving average line is coming down, or when your moving average line is going up, moving average going up indicates that historically the price movements have been better, but stock is falling down, so buy it. Or your moving average lines is continuously falling, but the stock price is showing an up movement, again it indicates a buy signal, sell signal. So there are buy signals which can be indicated by moving average, there are sell signals which can be indicated by moving averages. Arguments in favor and against technical analysis are describe the concept of evaluation. There's another name. Or in an efficient market, technical analysis may not work perfectly. However, with imperfection, inefficiency and irrationality, technical analysis may be helpful. See, there are certain people who are in favor of technical analysis. There are certain people who are against technical analysis, because technical analysis basically says you ignore everything fundamental. So there are people who are supporters, there are people who are not supporting, they are against this, they are against technical analysis. Now what supporters are saying is, there is a crowd psychology. What is crowd psychology is, when share markets are going up, you will see more people coming into the market. When stock markets are going up. Doesn't make sense, but that's what has happened. Under the influence of crowd psychology, trends persist for some time. And technical analysis can help you in finding these trends early and help in decision making. When reversal happens, that is up movement becoming down movement, that reversal are going to be gradually that reversal is going to happen. See, the market will start moving down, again it will move up, moving down, move up. So the trend will start reversing, and technical analysis can help you in finding the shift early. And because of this, you will be able to earn better return. Next part is, we have this efficient market. Which basically says any information about the company is considered in the share price. So fundamental information about a company is observed and assimilated by the market over a period of time. So what will happen is, your price movements, which you are seeing, those up movements or down movements, will continue to be there. Those trends will continue to be there unless there is some big news which comes about the company. These trends will continue to be there, and because of the trend, you are going to see that the share price will more or less move in the same direction. The reversal through fundamental information can happen only if some big news is there. Now people who do not agree to this, if you ask a technical analyst why will share price go up or why will share price come down, they will not have any convincing explanation. They're not going to have any convincing explanation as to why the share price is. If you ask him why will the share price go up, he'll say, yeah, share price will go up. What is the reason for that? He will not be in a position to give a proper reason. Most technical analysts are not able to offer a convincing explanation, for the tools employed by them. So they are not able to give a convincing explanation. Whereas if you ask the fundamental analyst why will the share price go up, he'll say Indian economy is likely to grow 10%. This industry is likely to grow at 15%. Our company, which is a market leader, is likely to grow 25%. And this growth is likely to continue, because of which cash flows will be better, because of which the present value of cash flows will be better, because of which the share price is likely to be better. Also, you are having this theory called as random walk theory. Now, random walk theory said that share prices cannot be predicted. If you're going to tell share prices cannot be predicted, then technical analysis also cannot find the share prices. You are talking about trends which are likely to repeat, but if you're adopting random walk theory, indirectly you're also saying that it is impossible for you to predict, because it's like a roulette wheel. So it is like a luck factor. Anything can happen in a technical, anything can happen in a share market. And another thing is, if more and more people try to adopt technical analysis, more and more people try to adopt technical analysis, the value of such analysis, because if everybody finds that trend and people start following that trend, because you will say that market is likely to go up and you find that trend and many people enter in, so the share price, instead of gradually increasing, would have increased significantly. Then it will get reversed. And if somebody understands technical analysis, if at all you're interested in technical analysis and you try to go through the graph, you will be trying to catch up with the trend, but before that itself the trend would have happened. The trend would have happened and you will not be able to earn returns out of it. You'll not be able to earn returns. So there are people who support it, because there is a crowd psychology which will persist for some period of time. So you will be able to find the trend and earn returns out of it. There is going to be reversal of the trend, which is going to be gradual, so you will be able to early find this and earn better returns, and your fundamental information will get gradually factored into the share price. As and when the information comes in, it will get factored in the share price. So the share price will keep factoring in this. But during this period, those trend which you have seen will continue to be there. It will continue to move in the same direction unless some big news comes in, which is going to be significantly negative. And there are people who are against technical analysis. One is you don't have a convincing explanation. There is random walk theory, which says it is difficult to predict. More and more people adopt it, the worth of this technique will come down. Efficient market theory. Now, efficient market theory, there are something called as weak form of efficiency, semi-strong form of efficiency, strong form of efficiency. So what this efficient market theory basically says is, the share price should consider, as per theory, at any given time, all available price sensitive information. Whatever information is there should be reflected in the securities prices. The share price should reflect the information which is available in the market, So once the share price factors in this information, because as and when information, suddenly you announce a merger, the share price will immediately factor that. Or you expect budget to have some favorable announcement, the market would have predicted it earlier itself, and the market would have started moving up. The share price would have started moving up. So the market keeps track of every information, because it's a trade by so many people. So many people keep track of information, and because of which the share price will factor in this. Practically it may not be feasible, because many people, when they buy the share, they are not aware of the company itself. Many people buy share without even knowing what the company is doing. So in the practical world, there are a lot of trades which happen who are not even aware of what the company is doing. They keep buying it because somebody would have told, please buy this share. So this theory practically may not be feasible, because according to this theory, every person is fully knowledgeable. Information is freely and instantaneously available. Information is available, but I need to process that information. Processing the information is very difficult. Because certain people may not have adequate knowledge to process the information. This is in fact one of the issues of the efficient market theory. I need to have the knowledge. I need to be aware of how the stock markets work. I need to be aware of certain fundamental factors. I need to be aware of certain qualitative factors. So I may not be aware. Even if I'm aware, it is difficult for me to understand how is the quality of this management. So keen competition will be there. Keen competition is there are a lot of buyers and sellers, because of which the market will be at the market price will reflect the intrinsic value, and price change will happen only in response to any new information. New information is basically new quarterly results, new capital expenditure, or government giving some incentive. So anything new happens, that will get reflected in the share price. There are certain misconceptions about the theory. Efficient market theory implies that market prices factor in all available information. All available information is going to be factored in the market price, and it is kind of impossible for anyone to consistently outperform, because everybody has the information. Everybody knows when to buy, when to sell. So it is there, but the market has some uncertainty element. Also, price will fluctuate. It is not that consistently it will go up or consistently it will come down, or it will remain stable, because when somebody is buying, somebody else is also selling the share. If everybody is aware how exactly the market is going to do, how well the company is going to do, everyone will buy or everyone will sell. So market will keep giving surprises. Market will keep giving surprises. And other thing is irrationality. Randomness and irrationality are two things which will continue to be there. Randomness is the moment you will not have any logic. There's zero logic as to why share price fell down. There's zero logic as to why share price went up. One day suddenly share price will go up, one day suddenly share price will come down. If you try to find a reason for that, you will not get to know, because there are irrational people who are buying it. They are not even aware what the company is doing. They're just buying it because somebody has said. So market can have three forms of efficiency: weak form, semi-strong form, strong form. Strong form is basically the price will reflect all available information, publicly available information and some privately available information also. Weak form of efficiency is price is not even factoring any information which is available. So you just look at the past prices, past volume, and based on that the price keep changing. Nobody is aware of what the company exactly does, what are the future plans of the company. Very few people are aware of it. So that's a weak form of market. That's a weak form of market. Semi-strong form of market is price not only reflect the past data, it will also reflect the publicly available data. In India's context, many times it's weak form of efficiency or semi-strong form of efficiency. Weak form of efficiency or semi-strong form of efficiency. Now, what are the challenges to the efficient market theory? See, if markets have to be efficient, everybody should be able to understand certain things. So, a company says, I'm going to do a merger. Is the merger favorable or unfavorable? Only few top investment banks or some brokers will be able to tell, or maybe some finance professionals will be able to tell. A person who doesn't have any knowledge about the financial statement analysis, the balance sheets, P&L, will not be able to analyze this information, but he still will buy and sell. So human information processing capabilities are sharply limited. So because of anxiety and uncertainty, you may end up buying a share, you may end up selling a share. Irrational behavior is when markets are coming down, you should buy a share. When markets are going up, you should sell a share. But exactly people do opposite, and they go by hit or miss tactic. What is hit or miss tactic? Let me buy the share. If I earn healthy returns, great. If I don't earn the returns also, it is fine. So that is a hit or miss tactic. And you don't go by informed belief. Monopolistic influence is not a big issue. Monopolistic influences, sometimes if it's a small company, if it's something like 50 crore market capitalization or 10 crore market capitalization, a single person can influence the price by buying a huge quantity. So as market is highly competitive, normally single person cannot do, but some powerful institution, big operators can have control on the market, and because of which the prices can move up or come down significantly, and that will not be reflected because of the information. Efficient market is one which goes on the basis of information. Okay, co-location and proximity hosting, it was in fact not there in your study material, but ICI asked in one of the RTP. So let's just discuss this. This is basically a facility provided by the stock exchange to the brokers. Brokers are the people who are the member of the stock exchange, and if I have to trade in any company, I should create my demat account with a broker and then do the trading. So when I have to do this trading, I need quick information. Whenever share prices is going up, coming down, it should quickly get reflected in when I'm doing my demat, when I'm operating my demat account. And if I want to buy, when I put a buy order, it should automatically go to the stock exchange, because there will be mapping of buy and sell orders. So co-location or proximity hosting is basically a facility which is given by the stock exchange. Basically what you are telling the brokers is they can locate the trading platform. Brokers, whereby the trading or data vending systems of the brokers can be in the close proximity of the premises of the stock exchange. Why should it be in the close proximity? So that the information can move faster between the stock market to the broker to the final demat holder, because even a second delay can become a problem. And this is as per SEBI guidelines. It is necessary for the stock exchange to provide co-location facility, and There should also be a connectivity, because see, a broker can be a member of BSE, he can also be a member of NSE, both are stock exchanges, Bombay Stock Exchange and National Stock Exchange. So you need to be giving this co-location facility, and you should also allow for connectivity between the co-location facility. There should be a connectivity between the servers of a stockbroker placed in co-location facility of a recognized stock exchange and server. The basic objective of this is to ensure quick connectivity in a fair and equitable manner. Now, for getting this co-location facility, the stock exchange can put in certain restriction. They can say that you should have certain certain rules will be there. It can say that you need to qualify for certain minimum qualification criteria can be set in. Maybe net worth should be so much, you should have so many demat accounts. So some conditions can be put in. Basic objective is this condition should be given to all eligible, this facility should be given to all eligible vendors. Because of that, the market data can quickly be disseminated and quickly the trade buy and sell can happen. So with this we cover your entire chapter 3. We had fundamental analysis, then we have technical analysis. These are two ways: fundamental analysis for long term period, technical analysis is for the short term period. Fundamental analysis is also known as EIC, economy, industry and company. In technical analysis we had multiple approaches. We had Doe theory, we had Elliott wave theory, we had random walk theory. We also looked at certain indicators like breadth index, confidence index. So we saw that. We also looked at moving averages. We also looked at efficient market theory, where there are three types of markets: weak form of efficiency, semi-strong form of efficiency, strong form of efficiency. There are few problems in this chapter which would be covered separately. I would be sharing that separately to you. So with this, my chapter 3 theory gets over.
Hi friends, let's now move to chapter 4 recording, which is on security valuation. Now, as far as exam point of view, the weightage may not be that much from this area, because this is more of a problem based chapter, but still theory questions can get tested from any chapter, and it's a very simple chapter. Very limited set of questions are there. As far as security valuation is concerned, you would have learned that we learn about equity valuation, debt valuation, and we also learn about money market instruments. So broad areas were equity valuation, in which we had different methods of valuation. We also had an area on rights issue, buyback. Then we saw bond valuation being there, convertible instruments being there, money market instruments being there. So let's get into some of the questions which are there in this area. Differentiate between expected return and required rate of return. Now, what is the required rate of return? Is the return which a security should generate. The return which a security should generate is called as required rate of return. This is also known as opportunity cost of capital, and in fact we use this as cost of equity or cost of capital. What return a security should generate? If you are calculating the required return for a debt, it's called as cost of debt. If you are calculating it for an equity, it's called as cost of equity. So required return is basically the return which a security should generate, is the minimum rate of return that the investor is expected to receive while making an investment in an asset over a specified period of time. It is also known as opportunity cost of capital, because this is the risk level of return which you are foregoing, because you could have invested this somewhere else. When you had invested somewhere else, you would earn some return. So similar returns you expect from this security also. What is expected return? Is basically the return which the security is likely to give. In some problems when we solve, we do use these terms interchangeably also. Depends on the context of the question. But expected return is basically what the investor expects you will achieve. So for example, expected return is 14. Required return is 12. It means I am likely to earn a return which is higher than the required return. This is indirectly means security is undervalued and buy it. Because you are able to generate
you're able to generate a return which is higher than what is needed. If both are same, security is correctly valued, and sometimes if the expected return is lesser than required return, then please stop it. There is no point in trying to do this business. Expected return reflects, or no point in buying that security, reflects the perception of investor. If the investor expects a return of particular security higher than the required return, if your expected return is higher than the required return, the share is undervalued. Please go ahead and buy it. Please go ahead and buy it. If the investors expect a return which is lower than the required return, if the expected return is lower, share is overvalued. So you have an undervalued security, also have an overvalued security, and the difference between this is called as alpha, which can be positive or negative. In fact, in portfolio management, you will learn that the required return can be calculated using multiple approaches. You have a CAPM based approach, you have a characteristic line based approach, you also have a CML based approach. So multiple approaches are possible to calculate the required return. The difference between the required return and the expected return is called as alpha. Second question, what is equity risk premium? A simple thing. When you invest in equity share, it does have extra risk. When you have any extra risk, you need extra returns. See, I can go ahead and invest my money in treasury bills, bank fixed deposit. They carry very less risk. Treasury bills of government do not carry any risk. So they do not carry any risk. But if you invest in stock market, there are going to be risk which is involved in that. Equity risk premium is the excess return that investment in equity share provide over a risk-free rate. Why does it provide? That is because of the extra risk which is associated. This excess return compensates investor for taking on the relatively higher risk, of investing in equity shares of a company. And this risk premium will go up further if you are highly risky, which is understood through a formula called as beta, or understood a concept called as beta. If the beta of security is higher, you would need a higher equity risk premium. Beta of security is lower, you need a lower. So your formula RF plus beta into RM minus RF. The second segment, beta into RM minus RF, is called equity risk premium. Beta into RM minus RF is called as equity risk premium. Concept of nominal cash flow and real cash flow. Nominal cash flow means normal cash flow which includes inflation. You could have seen this in international capital budgeting. Real cash flow means remove the effect of inflation. In a practical world, whatever cash flows or interest rates are there, they will be nominal in nature. But in case you want the real cash flow, then you'll have to remove the effect of inflation. If the inflation rate is very low, both will be almost similar, nominal cash flow and real cash flow. But if the inflation rate is very high, so nominal cash flow is the amount of future revenues the company expects, revenues alone, not be it expenses also, which the company expects to receive, and expenses it expects to pay out without any adjustment for inflation. Real cash flow, you adjust the inflation and bring it down. In the short term, and if you have low inflation, your nominal and real cash flow will almost be identical. Nominal and real cash flow will almost be identical. But if there are high inflation, your nominal cash flow will be higher. Worth is same, but the nominal cash flow will be higher than the real cash flow. Next concept is enterprise value. Enterprise value is basically the value of a company, which includes equity, which includes debt, which includes minority interest. Basically the value which you need to pay when you acquire a company. If you're acquiring a company, you need to pay a price for acquiring the company. So you need to pay some consideration to equity shareholder, you need to pay some consideration to debt holders, and in the formula we subtract cash and cash equivalent. The reason is, let's assume you are paying 5,000 crores to acquire a company. When you acquire this company, pay 5,000 crore, immediately that cash which is there, you can use that cash also indirectly to pay 5,000, or you may pay 5,000 crore and then that cash can be deducted. So your net outflow is minus cash and cash equivalent. Is the economic value of the company. It is through market value. You do not go by book value. Equity plus debt plus minority interest minus cash and cash equivalent. The reason for subtracting cash and cash equivalent is simple, because moment you acquire a company, what you can do is, after acquiring, you can use that cash. So let's assume you have paid 5,000 crore. Use the cash. If you have borrowed 5,000 crore to acquire a company, use that cash and bring down the borrowing. So your net outflow is post subtracting cash and cash equivalent. Now there are two other types of enterprise value. One is operating enterprise value and core enterprise value. In operating enterprise value, you remove some non-operating assets, something which do not add to your regular cash flow, like investment in associates, you subtract them. And in core enterprise value, you remove some non-core assets. If you're told some land is stuck, you remove all those non-core assets. Now enterprise value is used to compare your company with someone else also. In a practical world, you can calculate the enterprise value of TCS and compare with enterprise value of Infosys. You cannot compare the overall value. So we have 2-3 multiples. The two multiples which we normally use, enterprise value divided by EBITDA of a company, or enterprise value divided by sales, EV by sales, which have negative cash flow or negative earnings. So if you have negative cash flow, you cannot obviously do EBITDA, because EBITDA will be negative. So you do it on sales, EV to sales multiple. Then enterprise value to EBITDA multiple is, this is used for those companies which are making some profit, because they need to make some profit. If profits are not there, you cannot use it. And this is very useful in case of capital intensive company. Even in for non-capital intensive also we do, because capital intensive company have a substantial expenditure on depreciation and amortization. So what we do is we try to have EBITDA which is before this depreciation and amortization. So EV to sales multiple and EV to EBITDA multiple are the two multiples which we use for comparison of one company with another company. Duration of a bond, I think this is covered in your problem solving also. This is basically the weighted average period, time taken by the bond to repay the amount which has been taken. Average time taken by an investor to collect his or her investment, or in other words, it is also a level at which you are not exposed to reinvestment risk. You are not exposed to your reinvestment risk. So reinvestment risk is basically whatever money which you get, you need to reinvest them. So you should not be exposed to that risk. So that risk gets eliminated if you are able to immunize your portfolio by ensuring, immunization is also a concept which you would have learned. So if you are able to immunize your portfolio by making investment which is equal to duration of the bond. So in case of a bond, normally the bond will keep paying some amount. So what will happen is, that's the weighted average time. If you remember, we used to do it as year, cash flow, PVF, DCF, weight and product, the sum of the product. So in case it's a zero coupon bond, the duration of bond is equal to the life of the bond. For others, the duration of the bond will be lesser than the life of the bond. It measures how quickly the bond will be able to repay its true cost. The longer the time, if it's longer time taken, then volatility will be higher, because your volatility is equal to duration by 1 plus YTM. So if you have high duration, you will have high volatility. The longer the time it takes, the greater exposure bond has to changes in interest rate. So if you have longer duration, you will have higher volatility and you will be impacted. So it is preferred to have lower duration bond, so that you have lower volatility. Immunization, as I was indicating, immunization is a process where my investment weighted average of my portfolio duration is equal to the time period for which I need to make investment. If interest rate goes up, return on investment improves, but value of bond falls. So there is a price risk and there is a reinvestment risk. Price risk is the fall in the price because of the changes in interest rate. Reinvestment rate risk is the difference in value which you get because of the changes in reinvestment. So what you need to do is, you need to ensure that the price risk is exactly offset by the reinvestment rate risk, and that will happen if you are able to immunize your portfolio. Term structure theory. Term structure theory is basically trying to establish a relationship between interest rate or bond yield of different terms or maturity. Before I explain the different theories, let me show you a graph. Now, in practical world, your graphs can be like this, the term structure of interest rate. The interest rates can be downward sloping. What is downward sloping is, the interest rates are very high. This is the term period. So if you have a shorter, the interest rates are high for 1 year investment, and as the time period goes up, the interest rate keep coming down. So that's a downward sloping. For a 1 year, the interest rate is 5%. For a 2 year, it's only 4%. Flat means the short term interest rate, long term interest rate is same. Upward sloping is short term interest rates are low, long term interest rates are higher. Most common is upward sloping. If you look at FD rates, the bank will keep increasing the rate of interest if you increase the time period. So normally we have upward sloping interest rate. Now term structure theory, there are different term structure theory. There is as an expectation theory. What does expectation theory basically says? FRA. If you remember in FRA calculation, what we did is we used to use the interest rate of the longer period and try to calculate the interim interest rate. If you have a 3-year interest rate and a 2-year interest rate, you can calculate the interest rate for in between period. So as per this theory, the long term interest rates can be used to forecast short term interest rates. You can use the long term interest rate to forecast the short term interest rate. Liquidity preference theory says the interest rates for longer period is going to be higher. The interest rates for longer period is going to be higher. Why will it be higher? Because if you are not using money for a longer period of time, you are basically compromising on using the money or sacrificing this for a longer period, and you need a compensation. So according to this theory, the interest rates will be like this, upward sloping, shorter period, and as time period goes up, the interest rates will keep going up. Preferred habitat theory basically says your interest rates in the shorter period and longer period has no linkage. They are dependent on demand and supply. Of the money. If there is high demand for money for a longer period, the interest rates can be higher. If there is high supply for a shorter period, the interest rates can be lower. So the final curve, the curve can be upward sloping, which basically, sorry, just a minute. It can be upward sloping, it can be downward sloping, it can be flat, it can be either ways. It all depends on the demand and supply. So not the term of the maturity can be used to explain almost any yield shape curve. Upward sloping, downward sloping, falling, flat, anything can be explained as far as preferred habitat theory is concerned or market segmentation theory is concerned. Liquidity preference theory is basically for upward sloping theory, because why it is for upward sloping is it basically says you will have higher premium for a longer period of time. Convexity adjustment. Now this is also a concept which you learnt along with duration. What we do is when yield changes, we use volatility as a concept to find out the new price, but that assumes that there is a linear relationship. If interest rates go up by this much, this will be the percentage increase. If it comes down, this will be the percentage fall. If there is a double fall, for example, what duration basically says is 1% fall, 4% change, 2% change, 8%, 3% change, 12%. This is basically a linear relationship. As you double the percentage, this also doubles. But in a practical world, convexity is not dependent on linear relationship. There is exactly not a linear relationship. Duration is a good approximation of the percentage of price change. However, the change cannot be estimated because of convexity effect. So you need a non-linear adjustment to be done, which is called as convexity adjustment, whose formula is this: V plus is basically the price you get if the price of the bond increases by some percentage. V minus price decreases. 2V0 is the base price, divided by 2V0 and delta square is the change which happens. The same question is on modified duration. Is a proxy but not an accurate measure of change in price of a bond due to change in interest rate, which is true. Modified duration can only give you an approximate answer. It cannot give you an exact answer. Modified duration is duration divided by 1 plus YTM. So it assumes a linear relationship. But that is not true, because the changes are likely to be non-linear, and because of which you need an extra adjustment called as convexity adjustment. When you have convexity, it used to be like this: price is equal to base price plus or minus change due to duration or volatility, and plus your convexity adjustment. Convexity adjustment needs to be added always, and you get to the new price. Risks are inherent and an integral part of the market discuss. Risk is basically calculated by standard deviation. Now there are two types of risk also: systematic risk and unsystematic risk. Systematic risk is basically non-diversifiable risk, and what we learnt is systematic risk is unavoidable in nature. It is going to impact everyone. Risk is an integral part of market, and this is a type of systematic risk that affect prices of any particular share consistently in line with other shares. A general rise is called as bull trend, where all the shares will go up. general fall is called as bearish trend. So you will see mostly that our security will move in line with the market, and you can't do much about it. This movement will happen. In line with the movement in the market. So risks are obviously an integral part. They are an integral part of the market. Reverse stock split. Now what a stock split is: one share of face value of 10, this can become one share, or so one share of 10 can become 10 shares of face value of 1. This is called a stock split. One share is becoming 10 share. Now you may have one share of face value 10. So like this, there are 10 shares. You make them as one share of face value 100. Basically, you combine 10 shares into a single share. So reverse stock split is a process whereby company decreases the number of shares by combining current shares into fewer or lesser number of shares. 5:1 reverse split, 5 shares will become 1. Now, in a reverse split or in a stock split, the market value does not change because your number of shares come down, but the value per share goes up. So technically the value of the company does not come down, but still companies do reverse stock split. For example, if you have a share value of 10 rupees or 1 rupee, that is technically called as a penny stock, 1 rupee or 10 rupee. So you don't want to be called yourself like a penny stock, so you will do a reverse split, and 1 rupee stock will now become 10 or 100 rupee stock. Sometimes mutual funds will not invest in companies whose value per share is on the lower side, to avoid the tag of penny stock. If the prices of shares of a company go below a limit, it may be called as penny stock. It might be possible certain institutional investors do not acquire low value shares. So if you want to do attract these people, you will have to do this. You may be part of an index. There is a Nifty, there is a Sensex, there is a mid cap index, there is a micro cap index, there is a small cap index. So if you want to be part of that index and you want to avoid being removed from that, so you may want to do this. And sometimes the stock exchange will say, if the price of the share goes below this rupee, I may have to remove it from, or I will have to delist it. So in case you want to make a 1 rupee share 100 or 10, you will have to do a reverse split. Zero coupon bond. Zero coupon bond is something we saw in the theory part also. Zero coupon bond is basically those bonds which do not pay any interest. And why will I buy such bonds? I am buying such bonds is very simple, because I don't want to earn any fixed income. I want to earn a lump sum amount at the end of the life. So in a zero coupon bond, the income is equal to the price which you receive on the end and the price at which the bond is issued. It will be issued normally at a deep discount. This is also called as deep discount bond. Are issued at a discounted price, which is the amount a bond will mature and will be worth when it matures or comes due. So it will be 10,000 rupee bond will be issued at some 3,000 or 4,000. So that difference is what you earn. When a zero coupon bond matures, the investor will receive one lump sum equal to the initial investment plus interest that has been accrued. It is issued by banks, government, private sector company. The good part is you do not pay any interest, and one lump sum amount will be received at the end. Some people may not be interested in this because I may want to get some regular income, then zero coupon bond will not work. This is also known as deep discount bond. Arbitrage pricing theory, CAPM theory, basically says the return of a bond is equal to, the return of a security is equal to RF plus beta into RM minus RF. Arbitrage pricing theory basically said the return is not dependent only on beta, it is dependent on multiple factors. So RF plus factor 1 into risk premium of factor 1, factor 2 plus risk premium of factor 2, and goes on. B1 into RP1, B2 into RP2, and goes on, is an alternative to CAPM. CAPM is also used to calculate expected return, but only thing is CAPM is based on single factor. This is based on multiple factors. Like interest rate, sector growth rate, GDP growth rate, inflation. All these factors can be brought in. Next, money market instrument and what are its characteristics. Money market instrument is basically for the short term period, normally less than a year. In fact, a lot of the securities could be even less than a month time, is for meeting the short term funding requirements of corporates and bank. They are for shorter period. When something is for shorter period, it has to be highly liquid. It cannot be illiquid, because you are trying to sell and buy something in 2 days, 3 days, 5 days, 10 days. Large volumes will be there. and normally they are safer in nature. Only companies which are financially very strong will be able to make use some of the instruments of your money market, like commercial paper. You'll have to be a highly rated company. Different money market instruments, so we have, I think, treasury bills are there, you have trade bills are there, um, commercial paper is there, certificate of deposits are there, repo are there, reverse repo, call or notice money. Call money market or interbank call money market, that is basically one bank is dealing with another bank, where scheduled commercial bank lend or borrow on call. Call means you will inform and then say that money is to be paid back or received, or at short notice. Either you do it on call, which is overnight, or at short notice. Notice money is for period 2 to 14 days. Call money can be even a day. Notice money is for period 2 to 14 days. Treasury bills are normally issued by government. They are normally issued by government of India. The difference between the issue price and the redemption price is the return. This can also be used by some corporates. If they have some surplus, they can do it, and also by banks if banks have surplus money. In some time back, banks were flooded with a lot of liquidity. They had a lot of money with them because there were no loans being extended. Because of the situation was weak, loans were not getting extended. So that at that point of time they have surplus, you can put it in treasury bill. Commercial bill is basically a trade transaction. This is also called as bill of exchange. It's a trade transaction wherein a seller draws a bill on the buyer for goods sold on credit. So I buy a good, there's a bill of exchange which is signed. Now I go to with this bill of exchange to the bank and discount it and get the money out of it. The buyer accepts it immediately, agreeing to pay amount mentioned. Thus a bill of exchange contains a written order that buyer is saying, I will pay you something after a certain period. At the end of that period, this money can be paid. You can also go to the bank and discount it and get the money, and the bank will collect the money from your buyer. Certificate of deposit, these are like term deposits which are issued by commercial bank, Normally this is from bulk depositors. The value of this is on the higher end. You issue at a discount and a face value is paid on the maturity. The difference is called a certificate. The difference is called the return which you earn. Similar to zero coupon bond, but zero coupon bond is for a longer period of time. The concept is same. Commercial paper, there are certain rules for issuing commercial paper. One of the rules is you need a credit rating, and the credit rating should be on the higher side. So this can be issued only by corporates which have very good credit rating. High rated corporate entities to raise short-term funds, 7 days to 1 year. In fact, I worked in a rating agency, so when you do a commercial paper issue, you also need to give some liquidity backup. There should be some backup available. This backup will come into picture in case the company is finding it difficult to make the payment. The issue of CPs is to bypass the intermediary loan. It partly replaces the working capital which are needed by the companies. So it will replace that. It will be issued at a discount, and basically the return is basically the discount minus this, and an interest will also be paid. Repo option and reverse repo option, this is basically something along with the RBI coming into picture. Repo and reverse repo refers to a time of transaction in which money market participant raises funds by selling security. So I have some money with me, I have some security with me, I have a government security, so I will raise funds by selling the security, and I also agree to purchase this back after a specified period of time. I agree to buy it back. So it's like selling and agreeing to repurchase it back, with some interest. So this is a repo and reverse repo agreement. And this is repo rate. Repo rate is along with the RBI. Repo rate is the rate at which RBI lends to commercial bank. RBI gives money to commercial bank for a shorter period of time. Reverse repo is the rate at which RBI accepts the money. So reverse repo is the rate at which commercial banks lend to RBI. And you also have this transaction repo and reverse repo from the buyer and seller. See, for example, I need 20 crores. I've invested in government security. The government security is giving me 8% interest. Now what I can do is I can use this 8% interest loan and give it to someone else and say that I will buy this back after some period of time. So I sell it on January 1 and I buy it back on January 15. For this 14-day period, I'll be paying some interest which can be lesser than 8%. We have also done some problems on this. You will see this as part of the problem solving also. A transaction is called as a repo when viewed from the perspective of the seller of the securities, and reverse repo when it's looked from the supplier of the fund. The supplier of the fund will also charge some interest. The purpose is to fulfill the deficiency of funds. Somebody is in need of funds, so he can use the security. Reverse repo is to use the liquidity available with them. Some people will have liquidity, some people will need money, so accordingly you can match them and use it. So this chapter is fairly simple. It is basically on different types of investment. So we first learned about what is the difference between expected return and required return. The difference is technically called as alpha. Then we saw equity risk premium, which is the excess return which you generate because of taking risk, beta into RM minus RF. Nominal cash flow is without any adjustment of inflation. Real cash flow is you adjust inflation. Enterprise value is the value of debt plus equity plus minority interest subtracted by cash and cash equivalents. You also subtract non-operating assets and core assets. There are two multiples. One is with related to sales, another is related to EBITDA. Duration is basically the average time period taken to repay a bond. Also, it is the time period in which you are not exposed to interest rate risk, which is also a concept of immunization. Term structure theory is basically trying to express the relationship between the interest rate and the term period. The interest rates can go up with the increase in time period, which is called as upward sloping. Interest rate can be flat, interest rate can come down, downward sloping. Expectation theory says long term interest rate can be used to forecast the short term interest rate. Liquidity preference theory says long term period has more risk, so there should be extra return because of the extra return because you are waiting for some period, and you're compromising the, or you're sacrificing the usage of the money. So there should be a premium for the risk which is being taken, for the liquidity premium which needs to be paid. Preferred habitat theory says basically the value of the interest rates is dependent on demand and supply. Convexity adjustment is when you use volatility formula, you get an approximate price. If you make convexity adjustment, you will get to the exact price. Modified duration is basically only an accurate measure. It's not an accurate measure, it's only a proxy measure. For accurate measure, you have to do convexity adjustment. Risks are inherent because of systematic risk. Reverse stock split is converting 10 shares into a single share. You want to avoid the tag of a penny stock, you want to continue to in an index, you don't want to be delisted, you want to attract mutual fund investor, institutional investor. For all that purpose you can do. Zero coupon bond does not pay any interest. The difference between the issue price and the face value is the return which an investor get. Arbitrage pricing theory is basically says that the required return is dependent on not only beta but on multiple factors. So arbitrage pricing theory is basically using that concept. Money market instrument is for a shorter period. Different types of instruments are there. Call or notice money. Call is overnight borrowing. Notice money is 2 days to 14 days. Treasury bills is issued by Government of India. Commercial bills is between a buyer and seller. Certificate of deposits are issued by commercial banks. Commercial paper are issued by highly rated companies. Repo and reverse repo transaction is done by a person who is in need of money and who is having surplus fund. Repo, the person who is the seller of the securities, that transaction is called repo. From the other side, it's called as reverse repo. Major differences between repo and reverse repo. Repo is refers to the rate at which the RBI lends money to the commercial bank, and reverse repo is the opposite rate. With this, your chapter 4 theory gets over.
Okay, good morning friends. Let's now start with our discussion on this area of portfolio management. Portfolio management, as we have seen in the practical portion, basically it tries to first find out a risk and return of a security, and then how can you combine individual securities to form a portfolio, get the benefits of diversification, and ensure that we are able to generate healthy returns for the investor. So let's look at, in the context of that, few theory questions. What are the objectives of portfolio management? That is, what do you want out of portfolio management exercise? See, basic requirement is a person would be planning for his retirement, or could be planning for some expenses, to be some bulk expenses which are likely to come, and because of that he wants to save money and invest them. So when you invest, there are multiple objectives a businessman and multiple objectives an investor would have. He would want some steady state regular income. He would want that he can sell the securities whenever there is needed. There should be a liquidity of the securities which are forming part of portfolio. Also, I should be able to preserve my capital. So security or safety of principle, that's whatever money I have invested, I would want to keep that safe. I wouldn't want my capital to be lost. not only keeping the principal sum intact, but also ensuring that you are able to beat inflation, but also its purchasing power. So safety of principal would basically mean if you have invested 10 lakh rupees, you would want the 10 lakhs to continue to be there, but it also is required to beat inflation. So in 5 years time, 10 lakh should at least become 12 lakh, so that it at least beats the inflation. So security or safety of principal. Stability of income. Stability of income is, let's assume I've saved this money, I've retired now, I've invested this money in multiple asset classes. The objective of making the investment was very simple, that I wanted to get a fixed income of 20,000 per month or 40,000 per month or 60,000 per month. So there is need for some stable income also to be generated. If you are investing in at young age, you don't want any income to come in, so you kind of okay with even reinvestments being made. So either reinvestment should be there or consumption should be there. Capital growth, that is you are planning not only to keep the money intact. See, one main objective is I would want my principal to be kept intact, but I also would want to grow. That is where you try to invest in a combination of debt and equity. So if you invest in growth securities, you'll be able to. Marketability and liquidity is technically similar. Marketability is your security should be bought, can be easily bought and sold. Liquidity is ability to convert this back into money. So technically both are same. I would want to invest, for example, if you are investing in an asset class called as real estate, the liquidity of that asset class is not that healthy. So if you need money for some short-term emergency, you cannot be dependent on your investment in real estate. So real estate, see, portfolio does not mean it's only investment in shares. It can be investment in multiple asset classes. You can invest in shares, you can invest in gold, you can invest in real estate. So liquidity and marketability is basically ability to convert this into cash. Diversification is, as we learnt in portfolio chapter, that every security has an individual risk which is measured through standard deviation. This individual risk can be split into two components. One is systematic risk and second is unsystematic risk. Objective is to eliminate this unsystematic risk by diversifying your portfolio. So risk of loss by investing in various types of securities. Favorable tax status is the objective is to reduce the tax liability to the extent possible. See, when I invest in, when people were earlier comparing debt and equity some few years back, investments in equity earlier was giving healthier return, and the tax benefit was also very healthy because there was no taxation on long-term capital gain. Now there is a taxation which is introduced on long-term capital gain, but still the rate of taxation is at the lower end. So there is some tax benefit if you invest in equities. Vis-a-vis if you are investing in debt or real estate, the tax benefits may not be there, the tax rates can be on the higher side. So you need to try to balance between this aspect as well, that how can you take care of the taxation. The effective yield depends on tax on which you are subject to. By minimizing the tax burden, yield can be effectively improved. So my objective of portfolio management is I need income, I need capital preservation, I need capital growth, and I also need liquidity or marketability of my security. What are the phases of portfolio management? That is, how do you go about investing in securities and monitoring them? It's not only just one-time investment. There's a periodical monitoring which needs to be done. So how do you go about first finding out the securities, making an investment, monitoring them on a regular basis, and making adjustments to the portfolio? It's a process and broadly involves 5 phases. The first phase is security analysis. What is security analysis? Analyzing the risk and return of the individual securities. Analyzing the risk and return of the individual securities. You are not even getting into any portfolio level analysis. You are just analyzing the individual securities risk return correlation coefficient and finding out which securities are better, which securities are efficient, which securities are inefficient. We had an approach of your efficient securities and inefficient securities. A security was said to be inefficient if it was generating a lower return for the same risk, or same return but with a higher risk. So we had multiple scenarios where the securities were said to be inefficient. So first you analyze the individual security. After you analyze the individual security, you decide on a portfolio of securities. You decide on a portfolio of security, which is combination of few securities, and it is possible for you to create large number of portfolios. Indefinitely large number of portfolios can be created. That's the second stage, which is called as portfolio analysis. Third stage is portfolio selection. From this large number of portfolios which have been constructed, the goal is to identify the efficient portfolio. So you have large number of portfolios which have been created. From this you decide on some portfolio which you can invest, according to your risk appetite. You may want lower risk, so the portfolio which can be selected for you would be in line with that level of risk. You may want a higher risk, so the portfolio which is selected for you could be in line with higher risk appetite. So you, depending on the risk appetite, you will select the portfolio. You will have to constantly monitor the portfolio. Once you have assessed the portfolio, you may have to make certain revisions. And also portfolio evaluation is, this is looking at the performance over a selected period of time, or basically over a longer period of time. You analyze the performance over a selected period of time in terms of return and risk, and see whether there is any kind of changes altogether needed. Do you need to change the portfolio altogether? Because periodical revisions can be done, but if the portfolio is not generating returns over longer period of time, then there could be a need to reevaluate this and make changes if needed. Explain the traditional approach of portfolio management. Now, what is traditional approach of portfolio management is, how do I go about selecting and advising a portfolio to a person? For example, a person who is of age 20 may want to invest more on equities. As you grow older, you look at safer asset classes. You don't want to take more risk. So process of investment is as follows. Investor study. The objective of investor study is to understand his risk appetite, age, health, responsibilities. This will indicate whether is in a position to take more risk or less risk. Understand on the taxation side, and what is the need. Do you need regular income or do you need capital appreciation? So you need to take care of that, and considering the risk appetite, considering the need for capital maintenance, considering the need for income, considering the need for liquidity, considering the taxation status, you are going to determine the portfolio objectives, which is to maximize the investor wealth, but also to take care of risk element. See, the concept is very simple. You can maximize your returns if you are able to increase the risk. The returns can obviously be increased. But certain people are not in a position to take extra risk. They wouldn't want to take any extra risk. So you will have to take care of that aspect. So a lot of things needs to be balanced. Fixed interest security against equities. Equities are considered to be risky in nature. Fixed interests are considered to be less risky in nature. So you need to see how much to invest in debt vis-a-vis equity. High dividend payout companies as compared to high earning growth companies. There are certain companies which are growing at a very healthy rate. They'll keep growing at a healthy rate. If you keep growing at a healthy rate, there is a need for capital. There's a need for capital at their end. If there's a need for capital at their end, they may not want to declare dividends. So you need to see how do you balance out on companies which are high growth as compared to companies which are high dividend payout. Balancing income tax payable against capital gains taxes, thinking about the transaction cost which are there, because if you keep switching your portfolio on a regular basis, there are extra costs which can come. And if you need liquidity, you can maintain liquidity, but when you maintain liquidity, it can kind of compromise fee. One way of maintaining liquidity is to keep money as in the form of cash. If you keep money in the form of cash, it can give you some opportunities to invest. For example, during COVID time, the market had a sharp fall. Recently also, because of the Russia-Ukraine war, the market had a sharp fall. So when there is a sharp fall which happens in the market, you need quick money to invest in the market. So if you have liquid cash, it is possible for you to invest in market during these scenarios. So that is the benefit of keeping cash. But cash as such does not generate any returns. Cash is not going to generate any return, so you will have to take care of that aspect as well. Diversification is very simple. Objective of diversification is to look at multiple securities. When you look at multiple securities, you are trying to invest in such business that one business will do well during a specific event, and another business would do well. Balancing of equities against fixed interest securities is also part of your diversification strategy, because during the Ukraine war, if you are totally invested in equities, you would have seen a sharp fall in your portfolio. Whereas if you had done a balancing of debt versus equity investment, debt investments wouldn't have fallen, equity investments have fallen, so that would have given you benefit. Now, selection of individual investments, we have touched upon this as part of your security analysis chapter. You can even do something called as your fundamental analysis, technical analysis, and random stock selection. You can do all the three approaches. So methods for selection by calculating true or intrinsic value, which is your fundamental analysis, are going through your technical analysis. Inside information is sought and relied upon. This is basically technically like insider trading. Newspaper tipsters about good track record. So you keep tracking information, and based on fundamental, technical, or random stock analysis, you try to find a stock and invest in that. So but before making a final investments, you'll zero down on the securities. After zeroing down on the securities, you understand how they are linked with each other by building a lot of portfolios. Then you select a portfolio, then you keep evaluating it, keep monitoring it, and make changes if needed. What are the elements of risk in an investment? This is something which we have already seen when we were solving problem. The elements of risk in a security is measured through standard deviation. Your standard deviation is sum of systematic risk plus unsystematic risk. Beta is basically a measure of systematic risk. Systematic risk is which are external to company, that's going to affect large number of companies, uncontrollable in nature. Examples of this: interest rate risk, purchasing power risk, and market risk. Interest rate risk is variation in the cash flows of the company due to changes in the interest rates, This is also significantly affecting bonds and debentures. Purchasing power risk is basically your inflation risk. If inflation rates in a country are very high, it is going to significantly impact the value of money. So the returns which I am generating can be significantly impacted. And investors are caught unaware where rate of inflation changes unexpectedly, causing erosion in the value of the expected rate of return. Market risk is prices of any move up or down consistently over some periods in line with the other shares in the market. Example, during the Russia-Ukraine war, what had happened is all securities were falling, or if when the recovery happened, all securities start moving up. So this is basically systematic risk, which is uncontrollable in nature, which is going to impact everyone in the company, everyone in the economy. Unsystematic risks are those risks which are specific to a company, basically its own business risk and financial risk, and it can be eliminated through a process of diversification. Internal to companies, controllable in nature, it's going to affect only that company. Financial risk is basically if you are highly geared, if you have a very high debt equity ratio, then there's a possibility of that company not doing well. It can suffer, and because of which the returns can get impacted. So financial risk is basically the risk which arises due to the change in capital structure of the company. It's also known as leverage risk, and expressed in terms of debt equity ratio. Business risk is basically which emanates from your basically the business of the company, its customers, its suppliers, the industry in which it operates, the business cycle, the technology, all those factors which are going to affect the individual company, individual company's business. Financial risk is impacting the balance sheets of the company. Okay, next, what are the assumptions of Markowitz model? See, Markowitz model was analyzed to create a portfolio. Under Markowitz model, we understood how do you calculate a risk of a portfolio, how do you calculate return of a portfolio, and the objective was to use the concept of diversification and reduce risk to the extent possible. So we had a Markowitz model, we also had a Sharpe model to calculate risk of a portfolio. So now there are certain assumptions of Markowitz model. The major assumptions are one is rational investors and risk averse investors. This is the major part. Rational investors are basically those set of investors who would take a decision not based on emotions. You're going to take a decision based on emotions, you're going to take a decision based on the facts. Take a proper decision based on facts. And risk averse are those set of investors who would want to reduce risk if there are no returns, and if you want to increase the returns, you are ready to take extra risk. The return on an investment adequately summarizes the outcome of the investment. That is, the return is basically going to explain how much you are earning from an investment. Investors can visualize a probability distribution of the rates of return. Probability distribution is basically you can understand what are different possible returns which are likely to be generated along with probability for them, proportional to the variance of the return, expected return and variance. So risk and return are the two factors which are considered. All investors are risk averse. For a specified level of return, I take minimum risk, and if you want to take extra risk, you need extra returns. You need extra returns. Investors are assumed to be rational. They would prefer greater returns to lesser returns given equal or small risk. Risk aversion means merely that between two investments with equal expected return, two investments with equal expected return, obviously I would prefer an investment which has lower risk. This is what we learnt in efficient and inefficient securities calculation. Return is basically, they are saying, could be measured through some monetary inflows like NPV. Simple, your return for a security is basically two forms. One is dividend and second is capital appreciation. This is from an equity security point of view. From a debt security point of view, it could be interest income and principal redemption. From a real estate security point of view, it could be rental income. And then finally, you get some sale value of the property. Standard deviation is basically the standard deviation of returns as compared to the expected value. In simple words, Markowitz model basically says return and risk are the two major factors on the basis of which you decide to invest in a security or you decide to create a portfolio. The objective is simple. You can increase the return by increasing the risk. The returns can be increased if you are able to increase the risk. And if you are taking a minimal level of risk, you are going to get a minimal level of returns. And if there are two portfolios which give me same return, obviously I'll select a portfolio which has lesser risk. Interpret the capital asset pricing model and its relevant assumption. Now, what is the role of a capital asset pricing model? The CAPM model, this works for an individual security. Markowitz model is basically for a portfolio of security. It was for a portfolio of security where you combine a set of securities together and generate a return as well as balance the risk element in that. Now, capital asset pricing model and its relevant assumption. Now, capital asset pricing model is used to calculate the expected return or the required return. To calculate the expected return or the required return on the basis of a single factor called as beta, which is a measure of non-diversifiable risk. So, you are basically calculating the expected return based on beta. based on beta. Diversifiable risk is eliminated. However, your systematic risks cannot be eliminated. So that is why expected return of security is equal to RF plus beta into RM minus RF. RF plus beta into RM minus RF. Expected return of a security. Expected return of a security is computed on the basis of expected return of a security is computed on the basis of non-diversifiable risk. Assumptions are going to be more or less similar, which you saw earlier. Risk averse, a rational set of investors, efficient market would be there. It's the first assumption of CAPM. Efficient market represents the existence of a competitive market. In the earlier chapter, we learnt about efficient market and inefficient market. Efficient market is where there's good amount of competition and people are no single person can influence the market. No single person can influence the market. First, the efficient market refers to the existence of a competitive market where financial securities are bought and sold with full information. Rational investments, higher return for increasing the risk, lower return for lower risk. I want the lowest risk for my desired level of return. I want a higher return for an acceptable level of risk. So these two are basically technically same. Risk aversion and rational investment goals. Other major factors which I also want to consider is the major assumptions which needs to be considered. These are not practical assumption. One is there are no transaction cost. Which is not practically possible. Securities can be exchanged without payment of brokerage, commission or taxes and without any transaction cost. This assumption is not practically valid. There are transaction costs which are there. Also, you can borrow freely at risk-free rate of interest. We would have done a lot of problems on arbitrage. You do it as part of derivatives chapter as well. So everywhere we will say that I'm going to buy the security and take a loan for that. So when you take a loan, you would have taken a loan at riskless rate of interest. And another major assumption is there is no bankruptcy or insolvency. Again, not a practical assumption. We have seen companies which are becoming bankrupt or becoming insolvent. So few of the assumptions may not be practically valid at this point of time. Efficient market, yes, but a lot of times we have seen inefficient market also. Rational investment goals is perfectly fine. Risk aversion is fine. Divisible and liquid assets are also fine. More or less markets are having that liquidity, but borrowing at risk-free rate of interest or no transaction cost, no bankruptcy is something which may not be that logical. What are the advantages and limitations of CAPM? See, CAPM is something which is very, very critical because one, it gives you risk adjusted returns. That is, you are calculating the cost of equity. Cost of equity also had a formula called as RF plus beta into RM minus RF. So based on the risk of a security, you are able to, based on the beta of the security, you are able to estimate the cost of equity, and based on the estimated cost of equity, you try to value the share. So this will help us in providing risk adjusted return. Also, it can be helped in estimating, I think, the cost of equity for companies which are not paying dividend. It provides a reasonable basis for estimating the required return on an investment which has risk inbuilt to it. Hence, it is used as risk adjusted discount rate in capital budgeting. Also, it can be used for calculating cost of equity, which does not declare dividend, Now, there are certain limitations which are also there as far as the capital asset pricing model. Now, this model, the CAPM model, is significantly dependent on beta. And sometimes it may not be possible for us to estimate the beta of the company, because for estimating the beta you need the return of the security, also need the return of the market, and based on that you estimate the beta. But if you do not have data, then you may not be in a position to reliable data to measure this, because there are certain unlisted companies. So what will you do there? So it is sometimes difficult to estimate the cost of equity. So whatever shortcomings are applying to beta will also apply to CAPM. Now, beta, your portfolio management or CAPM model basically has lot of weightage. It provides lot of weightage on an item called as beta are your systematic risk, but that does not mean I can ignore the entirely unsystematic risk. Unsystematic risks are also there. Some businesses have a very high debt equity risk, so there is a possibility that they may become bankrupt. I cannot ignore all those risks also. So you will have to have a fair balance or an understanding of even your unsystematic risks, because without an understanding of this, you will have difficulties. And sometimes the information issues, because you have a formula called as RF plus beta into RM minus RF. Getting market return is not that difficult, but getting your risk free rate, because multiple risk free rates can be possible. Also, the markets could be volatile for a short term period. So when it's volatile for a short term period, during that period it may not be the right market return, because for a shorter period in the markets can even give a negative return. So you cannot use negative return in your CAPM formula and then try to estimate the cost of equity. So those are other challenges which are there, because one, your beta has its own set of risks, so you need to factor that. You cannot totally ignore unsystematic risks. Totally ignoring unsystematic risks is also not logical. Okay, now let's get into portfolio strategies. There's something called as an active strategy. There's also something called as a passive strategy. Active strategy, the word itself would explain to you, because you're going to constantly monitor the market and make movements. A lot of mutual funds follow an active strategy. They follow an active strategy where they keep track of market movements and make changes to their portfolios. Passive strategy are basically, if you invest in something like an index fund, it's like a passive strategy. Those mutual funds, the index mutual funds, is technically following a passive strategy. Is aggressive investors who strive to earn superior returns after adjustment for risk. But for following an active strategy, you need a lot of information. You should be fully updated about the latest happening in the market. If you are not updated about the latest happening in the market, it is very difficult for you to follow an active investment strategy. So mutual funds can follow it because they do researching, they gather extensive data, and based on that they try to make investments. So it is basically, you keep monitoring and keep regularly making market timing. Market timing is, you are trying to invest at a time when the market is at lowest and come out when the market is at highest. Practically it's very difficult for someone to time the market, but an active strategy would involve strategy for long run asset mix to reflect assessment of various assets in the near future. Explicit and implicit forecast of general market movement. So you are trying to assess what is going to happen over the near future, and based on that you are going to make the investments. If COVID is going to come in, you know that things are going to become bad, you try to move out of the market. The impact of COVID is not there now, you try to make an entry into the market. So that's a strategy which you follow. Sector rotation. Some sectors are likely to do well during a few years or during some time period. Some sectors are not likely to do well. When COVID came in, maybe you would have felt the pharma industries can do well. So maybe you will increase the weights for pharma industry at that time. During some other period, some other industry may do better. Sector or group rotation may apply to both stock and bond component. With respect to strategy, when it involves shifting, you will constantly keep shifting. And keep moving from one sector to the other sector. Security selection is basically trying to find those securities which are underpriced. If you are using fundamental analysis, you are trying to find on underpriced security. If you are doing technical analysis, then that is nothing related to the fundamentals of the company. You are trying to find those patterns, and based on the patterns you are thinking that this is likely to do better, and you are trying to increase the returns. So an active strategy is one where a lot of research is needed, and based on the research you try to find some underpriced securities, invest in them. You try to see that market is likely to do better, you increase your investments. You try to see that market is going to turn weaker, you move out of your investments. You see that some sectors are likely to do better, so you will do a sector rotation. Also, specialized investment concept. What is specialized investment concept? Is making investments in some theme. For example, today you can invest in companies which are likely to do well if electronic vehicles become the future, which is likely to become future. EV is likely to become the future. So if some companies are involved in them, there's a possibility that you invest in them. So growth stock, neglected or out of favor stock, some of the companies are not doing well, so they are neglected at this point of time, so you invest in them. Asset stocks, technology stock, tech stocks are likely to do better at any point of time. In the past also the IT industry has given superior returns, and in future also they are likely to give returns. Passive portfolio strategy is exactly opposite of your active strategy. Exactly opposite of your active strategy. You create an asset allocation and you don't do, it's like buy and hold. Once you have created, you try to leave that as it is. Create a well diversified portfolio, hold the portfolio relatively unchanged, unless you see that it has become inconsistent with the investor's risk return preference. If it has become inconsistent, then you are going to do something, otherwise you leave it. Example, as I said, it is index funds. Index funds are very critical. What are the criteria for bond selection? Bond selection is basically a lot of aspects. We saw something called as yield to maturity. We saw something called as duration, volatility of a bond. So my investment time horizon, the reputation of the company. So there are the coupon rate which the bond is paying, yield to maturity. The yield to maturity represents the rate of return. So higher the yield to maturity, I would want to invest in such companies. But also keep in mind that because you want a higher yield returns, you also need to see that whether there is any risk of default. If there is a risk of default, it is slightly incorrect, or it will be slightly difficult for me to invest in those businesses, because if there is a risk of default, I will unnecessarily lose my money. So I don't want to lose my money. As well, I want to maximize my returns. And what kind of returns I want to maximize? I want to maximize my after tax return. So see if there are any tax benefits and the ability to convert into cash. 3 approaches for selection of stock: your fundamental analysis, your technical analysis. Fundamental analysis based on the fundamental aspects, like you look at the returns of the security, you look at the risk of the security, you look at the business of the company, you look at the future growth potential of the company, you look at the various ratios, and then make a decision. So technical analysis based on the past data, and random stock analysis. In random stock analysis, you are really not bothered about the market movements, you are really not bothered about the data of the company, like earnings level, growth prospects. Basically you believe market is efficient and security is properly priced, so you start buying anything, you start buying any kind of a security. What are the various types of asset allocation strategy? Very good question. Now let's first understand what is asset allocation strategy. See, an investor can put his money in debt, equity, gold, real estate, forex. I think there's something called as alternative investments. You'll learn that later. But there are multiple places where you can put your money. Now, asset allocation strategy is creating a proper balance, among the various, asset classes which are available. There are multiple asset classes which are available, so you need to decide whether see, when I'm young, I may invest in equities, real estate, alternative investment, because these are considered to be more risky. As I become older, I may want to invest in debt. I am a person who is having less risk appetite. I may invest in debt. I am currently having a lot of responsibilities. I cannot afford to take risk. So depending on that, you will have to decide a mix. I'll come to integrated asset allocation. First, let me talk about strategic asset allocation. What is strategic asset allocation is, you decide an optimal portfolio based on the return and your risk, based on your return and risk. Least bother about what is happening on the market. I'm least bothered about what is happening to the market doing well, market not doing well. I am going to decide a portfolio of strategy based on my returns, my risk, correlation among the various asset classes, and I decide a portfolio. I'll periodically monitor it and make changes based on my risk and return appetite. Based on my risk and return appetite. I'm not bothered about the market side. I'm not bothered about the market side movement. Under tactical asset allocation, what you do is you decide the risk of the investor and keep changing based on the market condition. Based on the market condition, if equities are likely to do better, you invest more on the equity side. If equities are likely to turn weaker, you invest more on the debt side. So this is more like buy and hold, more like a passive kind of a strategy. Tactical asset allocation is more like an active kind of a strategy. It's more like an active kind of strategy. You'll keep making changes. Insured asset allocation is more like your constant portfolio insurance strategy, constant portfolio proportion insurance strategy, where I have a base value, I don't want my portfolio to fall below that base value. If it falls below that base value, my entire investments will happen in non-risk securities, like it will happen in debt side. Whereas when my value is above that base value, I have the ability to take more and more risk. Integrated asset allocation is basically you are trying to consider the market condition, consider your asset allocation, consider your risk and return expectation, your constraints, what the investor really wants, and basically based on a combination of these two factors, you decide on an asset allocation in line with what is happening on the market side, and constantly monitor it, make changes if needed. Here you totally kind of ignore what's happening to the market. So what's happening to the market is totally ignored and you kind of hold it. And tactical asset is you kind of keep monitoring the market and keep making changes based on the market side movements. Features of alternative investments. Now, alternative investments are something which are picking up. You are trying to invest in, certain businesses, you're trying to invest in certain asset classes where the liquidity may not be there. As next buyer may not be easily available due to limited market. There is a own amount of fees, because whoever is advising on this, they will charge a high transaction fees. Limited data is not there. Your historical information will not be there. Transparency is not there. So they are extremely risky. But obviously they can give you very healthy returns. Returns are very high, but risks are also there. So you need to take care of that element when you're making investments on these asset classes. They are not your routine asset classes like debt and equities. These are some asset classes which are not routine in nature. So when you make such investments, it is possible that you will be generating very healthy returns, but there are risks also along with that. So the important part of alternative investments is very clear. It has high risk, but it will give you high returns. There is less transparency, limited information would be there. Some of the examples of it's basically those asset classes which are not conventional, which is like your debt, equity, cash. Example, if you do some private equity investments, or if you do some venture capital investments, or if you are getting into some commodities kind of investment, even real estate investments can come under alternative investment side. 4 approaches to value real estate. Now, any asset can be valued on the basis of cash flows which it generate. This is one way. Or replacement cost approach. Replacement cost is the price at which you can buy this asset at this point of time. Sales comparison approach, it's like price earning multiplier in case of equity share. Benchmark value of a similar type of property can be used to value real estate. So you look at the value of a similar property and then based on that you try to value this. This is what I was talking about. Income approach, value of perpetual debenture or unredeemable preference share. Perpetual cash flow is deducted at or is discounted at market required rate of return. Market required rate of return based on the cash flows. Cost approaches, cost is estimated to replace the building plus the estimated value of land. Replace the building plus the estimated value of land. So one is your cash flow based approach, second is your replacement, which is technically called as cost approach. Okay, they also have a separately called as discounted cash flow after tax approach. Technically, according to me, both are similar. Your income approach is also going to consider the regular cash flows which it's going to generate. The only difference may be, okay, here it is like a perpetuity. There you may consider a sale happening after 15 years or after 20 years and discount those cash flows. What is mezzanine finance? Mezzanine finances, see, one, I have debt kind of financing. Second, I have an equity kind of financing. Mezzanine finance is a combination of debt and equity. It's a combination of debt and equity financing. It's a hybrid kind of a structure. It's a hybrid kind of a structure where I do an equity funding. Also, it will have debt funding. If company does well, my debt would be returned by them. If company does well, my debt would be returned by them, the debt funding which I've done. But if the company is not doing well, the debt will have to be converted into equity. The debt will have to be converted into equity. So it is an extremely risky proportion for me. I may do this because I believe over a longer period of time I can generate superior return. Some of the companies try to buy assets, from your NCLT proceedings. Some insolvency proceedings are going against a company. So when these insolvency proceedings are going against the company, the CDR proceedings are going against them, you may try to get into buying that company. So making some heavy investments or buying out some company. But however, this type of financing is not that popular in India. As of now in India, even when I worked in a rating agency, I have not seen too much of this being there. What are the characteristics of venture capital financing? A venture capital fund is basically a person who's making investments for a longer period, minimum 5 years. He can even go to 10-15 years kind of an investment. There's a long-term horizon, minimum period. Okay, the definition says 3 years, but I've seen a lot of businesses getting into at least minimum 5 years kind of investment would be made. Lack of liquidity, because it's a specialized kind of an investment, you would be making a bulk kind of investment, a sizable investment, material investment would be made. So because of that, there is going to be less liquidity. Because less liquidity is there, you add this liquidity premium and want to generate higher return. Your venture capital investing is one of the example of alternative investments. So this obviously have high risk. So high risk and high returns. Mostly these guys would want equity participation. They will also do some debt funding, but mostly they would want equity participation and a sizable equity participation. They can even do some warrants kind of an investment also, where this warrants will be converted into equity shares in future also. But the objective is, why they want to invest in equities, if the company is growing, VC can also grow and grow with them. Also, they can participate in the management of the company. They can have a role in the company's business. They can participate there. They can give guidance to the company, and based on the guidance, the company can generate healthy returns, healthy cash flows, which will help the venture capital guy to generate a superior return. Because the problem for a venture capital person is he is taking high risk. So for that extra risk which he has taken, you need to give them that superior returns. Okay, next part is, what are the advantages of venture capital financing? One, these are people who are long-term investors, so they will participate for a longer period of time. These guys can have network of contacts also, so that can provide me some I can get into some new supply relationship, new customer relationship, which can help my business to grow. They are also capable of providing additional funding. These guys are also having financial understanding, so they can help me in doing an IPO or a share sale in future. So long-term finance, which provides a solid base for future growth. He is looked at more like a business partner who will share both your risk and reward. He is able to provide you advice and assistance based on the past experience of companies, network of contacts, capable of providing additional rounds of funding. They can help you in doing an IPO, facilitate a trade sale in future. Explain the VC investment process. So venture capital process is not a very simple process. It takes a good amount of time also, because there's a due diligence to be done. So first you find out a deal which is there, deal origination. VC operates directly or through intermediaries. Some chartered accountants can work as an intermediary and give the VC a deal which is possible. There are few chartered accountants who are doing the role of due diligence as well, or they are the set of people who have contacts, because you do audit of so many companies. So if there is a need for funding, they will talk about this to a venture capital fund and tell them that this deal is there. After this deal is sourced, the screening committee will look at it, and once the screen, because you may get some 100 deals, you're not going to do due diligence of all the 100 deals. All due diligence will not be done. After the screening, whatever company has decided to be taken forward, the VC will carry out a due diligence. After that, once the due diligence is successful, all the documents are received, all the pre-funding conditions are taken care of, the deal would be structured and the funding would be provided. You will obviously monitor the performance. So post investment activity, the VC will nominate a person. There will be some strong MIS budgeting system will be there. You will keep tracking the performance, and at some point of time you will also have an exit happening. Could be 10 years, could be 15 years. At the time of the VC would ask the promoter to spell out in detail the exit plan is to sell to third parties. They would need some IRR also. They would need some healthy returns. What are distressed securities? Distressed securities are buying securities of those companies which are almost near to bankruptcy, that are in or near bankruptcy. These companies are technically bankrupt, so they will be available at very low price, and you are going to do efforts to revive this company. There's also talk about an arbitrage strategy in this. I don't see this practically working, but still the theory has this arbitrage strategy, that is, you invest in debt as well as equity. You buy this and you go short in this. So if the company revives, you will get back your debt and earn a healthy interest income. If the company is doing well, and what will happen, the share price will start moving up, but you will suffer loss because of this. Because the share price has started moving up. But technically still it does not matter, because the interest income which you are going to generate would kind of take care of the losses which are happening on the short side. Taking long position in debt and short position, if company's condition improves, investor will get back interest which shall be more than the dividend on his short position. And if it deteriorates further, then the value of both share and debenture goes down. You will make good profits in your short position. I technically don't agree to this, because this kind of a strategy is not going to be that critical, and going short and all is not practically possible. There are also multiple risks which are there. Liquidity risk, they may not be saleable. Event risk, this company can technically become, it's already at the verge of bankruptcy, so it is going to reach a stage where it will affect this company, and there can be some major event which can happen, and that is going to affect the company, and because of this you may see this company not even existing in few days, or technically it is wound up. Market risk, human risk, this is on the company in distress. The judge's decision on the company in distress also play a big role. That is whether the company can continue to operate, or you want this company to be the winding up proceedings to be initiated and the company becomes wound up. Explain the strategy of portfolio rebalancing under which the value of portfolio shall not fall below a specified value. This is your constant portfolio proportion insurance strategy, where we have a floor value, and below the floor value my value should not go down. In fact, I was explaining this insured asset allocation. This is similar to your insured asset allocation strategy. So you have a floor value. For example, your portfolio value is 4 lakh, base value is, or your floor value is 3 lakh. So the difference between them is 1 lakh, and there will be a multiplier. The multiplier could be 2, 1, whatever. Based on that multiplier, you will decide how much you can invest in the equity markets, which is your risky scenarios, and how much you can invest in non-risky. Under constant portfolio, investor sets a floor below which you should not allow the asset to fall. The value will not fall below the specified floor value. In contrast, the bearish market losses are avoided by sale of shares. This is what the formula was. Target investment is multiplier into portfolio minus floor value. Your multiplier can be anything. We had seen a problem where the multiplier was 2 times. So with this, my discussion on the theory on portfolio management chapter is over. I'll record the balance chapters and provide them as soon as possible. Okay, let's move to now chapter 6, which is on securitization. Now let's first understand what is securitization, then we can go through features, the participants, the process, all that we can go through. But let's first understand what happens in a securitization. Now let's take example of ICICI Bank. ICICI Bank gives lot of home loans. They have home loans which are given. They also have auto loans. They could also have some unsecured loans, some personal loans. So they keep giving a lot of loans to companies. These to individuals, companies, it goes to multiple people. When they prepare that balance sheet, this sits in their asset side. This sits in the asset side of the balance sheet. Now, this money would be realized over a period of next 5 years, 10 years, 15 years, 20 years, 25 years. It's going to take a lot of time for this money to come to ICICI Bank. People who have taken loan from ICICI Bank will keep paying this depending on the loan horizon. Now, ICICI Bank wants money to be paid immediately by these people. So they tell, can you pay it immediately? The customers are obviously not in a position to pay because home loans and all cannot be paid immediately. Now what ICICI Bank will do is, these assets, they will transfer to an SPV. So from their balance sheet, all these assets would be removed and it will become the asset of an SPV. It will become an asset of an SPV. The SPV would be created specifically for this purpose and they will transfer this to an SPV. Okay. After transferring this to an SPV, SPV has to pay some consideration to ICICI Bank. SPV has to pay some consideration to ICICI Bank, which is nothing but the present value of the future interest which this loans will give to the SPV. That present value would have to be paid to ICICI Bank. So what SPV will do now is, if I prepare SPV balance sheet, it will have this asset. It has to pay some money to ICICI Bank, and if you are not paying, it will sit as a liability at this point of time. So what the SPV will do is, SPV will pay some consideration to ICICI Bank. SPV will pay some consideration. How are they going to pay? They are going to pay through investors. Investors would give money to SPV. Investors would give money to SPV. SPV will give that money to ICICI Bank. ICICI Bank had so many housing loans, personal loans, unsecured loan, auto loans, credit card loans. So it had so many loans. The cash flows are going to come over the next 5 years, 10 years, 15 years, 20 years, 25 years. So these cash flows will keep coming in. What ICICI Bank was very clear is they need money immediately. They need money immediately. So they transferred all these loans to the SPV. SPV has issued some financial securities to the investors. Had issued some financial securities to the investor. These securities will understand in some time. There are multiple different names for the security. There's something called as PTC. There's something called as PTS. So you will understand that as we proceed. So they will allot these securities to the investors. So what will indirectly happen in future is, on day one, ICICI Bank, on day 1, these are the transaction. ICICI Bank will transfer all loans to SPV. SPV will issue financial securities, they are called as PTS, PTC and all, to investors and receive money. SPV will give this money to ICICI Bank. Now this transaction can be with recourse, without recourse, all that you will understand. So what will happen because of this? Now in the ICICI Bank, the loans which were there, which was illiquid at this point, when I say illiquid, it takes time to receive. Now that loan will become cash and bank balance. It will become cash and cash equivalents in the balance sheet of ICICI Bank. Why does ICICI Bank wants to do this? After it becomes cash, it can use it for lending for some other purpose, or also for future growth potential, or for some other opportunities which are there. So ICICI Bank wants that money for some purpose, so they'll use it for that purpose. Now what will happen from day 2 to year 5? Let's assume it's a 5, all the loans will be repaid by end of year 5. So day 2 to year 5, what's going to happen is the borrowers will repay interest, principal to SPV. The borrowers will repay interest and principal to SPV. SPV will pay interest, principal to investor. It can have some surplus also, or it can end up paying entire amount to the investor. So the investor has indirectly, if you look at the entire process, the investor has indirectly now given a loan to so many people, so many housing loans, so many personal loans, microfinance loans, so many loans could be there. So the borrower will keep repaying. The default happens, who bears the risk will depends on whether it's with recourse, without recourse. So all those challenges will understand, but this is the process of securitization. The objective is ICICI Bank wants to take it out from its balance sheet. They want to take it out from its balance sheet. They are in need of money. So they are going to transfer this. They are going to transfer this to an SPV. SPV will be issuing securities and receive money, and this money will be given to ICICI Bank. ICICI Bank is out of scene at this point of time. They have received their money. The borrowers will keep paying the money to the SPV. SPV will keep paying interest and principal to the investor. If there is a default, if the SPV has to bear the risk, the investors will indirectly bear that risk. The investors will indirectly bear that risk. So let's understand. The process of securitization involves creation of pool of assets from the illiquid financial assets. Illiquid financial assets, which are automobile loans, credit card receivables, residential mortgages, personal loans, all these are illiquid. All these are illiquid. So the objective is you want to create a pool of assets because from this illiquid financial assets, so that they are marketable. They are marketable. Creation of financial instrument. The process of securities can be viewed as a process of creation of additional financial product or securities in market backed by collateral. This additional financial instruments are called as PTC, PTS. Bundling and unbundling. Bundling and unbundling is first you combine all assets together. That is your housing loans, personal loans, or multiple housing loans, and then you break it down into instruments of fixed denomination. You have to allot instruments to your investors, so that's called as unbundling. Tools of risk management. For the person, for the ICICI Bank, what is ICICI Bank called as? He is called as originator. I'll touch upon that as we proceed. If you are doing it on non-recourse basis, if you are doing it on non-recourse basis, then the entire risk of default is also shifted. The risk of default is also shifted. So this can become a tool of risk management. This is one of an example of a structured finance. You have a proper structure in place. So this is a good example of structured finance. Securitized instruments are considered as best examples of structured finance. Trenching. Trenching is you have multiple assets in a securitization transaction. You can have multiple receivables, multiple tranches of receivable, the first tranche, the second tranche, or the third tranche. There can be multiple tranches of receivables. So you can combine them together and call it as a single tranche. You can combine them together and call it as single tranche. Every tranche will carry specific risk and return. Within that tranche, the securities are of homogeneous. Homogeneous means similar risk. They are of homogeneous nature. How did securitization start in India? Securitization is something which has been started recently. It's not that it is there for the last some 50 years or something. This was started recently, and it was started by Citibank. Citibank had pioneered the concept of securitization in India. They started with auto loans. Thereafter, multiple levels of securitization has happened. Now even they have moved to securitization of something called as sales tax receivables, or aircraft receivables. All of this can also be securitized at this point of time. The securitization movement, which picked up with auto loans, has now moved to multiple areas. Also because one issue with securitization which can be there is the end customers, if they are defaulting, it can lead to loss for the investors. So now with your SARFAESI Act being there, somehow you are able to tackle the non-performing assets problem to some extent. So you will have to tackle this default risk. If default risk is not tackled properly, the securitization market is not going to move forward. Now it has moved forward, which initially started, as I was saying, it initially started with loan receivables. It has now moved to microfinance, NBFCs. The important players are ICICI Bank, HDFC Bank, NHB. All these are the most important players in the securitization market in India. This is as per a report by CRISIL. The securitization market is some 70,000 crores in financial year 2016. So it's a big market, because people see, I want to invest in, I want to give a housing loan to a person. Now, because I believe housing loans are not considered to be that risky. So I want to give a housing loan to an individual investor, to an individual person who is constructing house, but I am very risky to give it to him. So what I can do is, ICICI Bank would give the loans. They would give loan to some 1,000 people. So even one person defaults, it's not going to have a big impact on me. So they'll give this loan to some 1,000 people. After they're giving the loan to 1,000 people, they will transfer it to an SPV. Once the transfer happens to an SPV, I can invest in that SPV instrument and then technically invest in these. What are the benefits of securitization? Explain the benefits of securitization from the point of view of originator. There are benefits for the originator. There are benefits for the investors also. Originator, off balance sheet financing. Off balance sheet financing is moment the securitization transaction is done. What indirectly you have done is, you have taken a loan against the loans which you have gave to individuals, companies. So multiple loans you had given, that was your asset. Against that asset you have taken a loan. Our securities, it's release a portion of capital tied up in the asset, results in off balance sheet financing, improved liquidity portion, because this is not going to be reflected in your balance sheet. It's an off balance sheet item. Also, it can help you in removing the risk also of default also. If you have a risk of default, that can also be eliminated. In the main business, some of the assets you don't want to focus on. Suddenly you have decided that you're not going to focus on auto receivables, or you're not going to focus on home loans. So by transferring this, you can concentrate on your core business. The risk of servicing of loan is transferred to SPV. Non-recourse arrangement, even the burden of default is shifted. Improves your financial ratios. Your debt equity ratio will improve. Capital to weighted asset ratio will improve. You also have this capital adequacy ratio requirement. So all this can be improved. Also, these securitized papers, there is one credit rating done. There are certain credit enhancements which can happen on top of this. So it is possible to get it at a reduced rate of interest. The SPV can issue this at a reduced rate of interest. There can be a spread which can be there, so that the SPV may enjoy. If the SPV is indirectly being managed by the originator, or if the originator has a stake there, he can also earn something out of that. Hence the originator earns a spread, resulting in reduced cost of borrowing. See, the 9% would be the earning on the loans which are given to the customers. you are issuing security at 7% to the investor. So the present value of this 9% could be different, the present value of this 7% could be different, and there could be a spread which could be earned by the originator. From the investor point of view, as I was saying, I want to give loan to an individual home loan borrower. I cannot do it, so I can do it through this, and this helps me in diversification of portfolio. Regulatory requirement. What is regulatory requirement? Is some of the banks, some of the NBFCs, some of the microfinance companies, they have to invest, let's assume 5% of their advances should be given to residential real estate sector, or they have to give to home loan buyers. You can meet the regulatory requirement by going through investing in the SPV and saying that the SPV has taken, or SPV has those assets which are of home loans. So indirectly I am given home loans to the people, because the investors indirectly are giving a loan to the end customer. Protection against default. This happens only if it's with recourse. With recourse, then there is a protection against the default. Sometimes an insurance arrangement can also be taken, so that will ensure that the risk of default does not fall on me. Participants in securitization process. So this is also an important question. There are primary participants, there are secondary participants also. The primary participants, I think the most important participants are these three set of people. ICICI Bank, who is called as an originator, SPV, who is called as an investor, SPV, which is separate, and then there are investors. So originator, the initiator or deal, and can be termed as securitizer. It is an entity which sells the assets lying in its book. It is going to transfer the assets which are sitting in its book and receive the funds generated through the sale of such assets. So it's going to transfer, get the money, and be done. Special purpose vehicle is one is going to execute the deal. They are going to make an upfront payment to the originator. They hold a very important role here. They're going to keep collecting money and pass on this money to the investor. So executing, since each year originator transfers all rights, it holds the legal title of these assets for the purpose of securitization, can be in the form of a company, firm, society, trust. Investors are the people who are buying, and they are providing this money to the SPV. SPV will give this money to the your originator. Buyers of securitized paper, which may be an individual, an institutional investor, mutual funds, provident fund. Obligor. Who is an obligor is very simple. This persons who have taken these loans. The housing loan is taken by so many people, auto loans are taken by so many people, unsecured loans are taken by so many people, personal loans are taken by people. The people who have taken that end loan are the obligor, and the interest rate, the risk of the ratios will depend on the risk of these people, the risk of those the risk of those assets. They are the main source of, they are the parties who own money to the firm and are the assets in the balance sheet of the originator. Amount due for obligor is transferred to SPV and they form the basis of securitization process. Rating agency. Rating agency is basically, they are required to give a credit rating. So they are going to assess the credit quality, see the credit support available, and then give a credit rating. Based on the credit rating, the SPV can take even loans which could be at a lower rate, or the issue which they are making to the investor, the instruments which they are issuing to the investors, they can be at a lower rate of interest. Receiving and paying agent, their role is to collect money. Receiving and paying agent is basically, they are going to collect money from the obligor, pass it on to the SPV. SPV will finally pass it on to the investor. It can also follow up with the defaulting borrower and ensure that money is collected. Originator will act as doing this person, mostly originator or some of its affiliates. Agent or trustee, is going to oversee the operations of the SPV, oversee that all the parties perform the true spirit. It's taken care of the investors, so they are going to mostly oversee the operations of the SPV so that the role of the investors is taken care of. Credit enhancer. Credit enhancer is investors will feel that in case the end customers default on a loan, there's a problem for me. My returns will significantly get impacted. I may even not get my money back. So I may need some extra comfort, some comfort. they can get extra comfort in the form of a credit enhancement. Credit enhancement is basically like a guarantee. It could be a guarantee which could be given. This will help me in giving that money at a lower rate of interest. Structurer is a person who is going to structure this entire transaction. The transaction needs to be structured, so you need investment bankers who are going to create this, and they are going to obviously ensure that all the rules, regulations, conditions, regulatory requirements, legal requirements are met, and they will also be paid a fees for this. Explain the process of securitization. As I had indicated, the process is broadly this: creation of pool of asset. Creation of pool of asset, that is, the process of securitization begins with creation by segregation of assets backed by similar time of mortgages, interest rates, maturity and concentration. You transfer it to SPV, sale of the securitized papers. This happens to the investor either through PTS or through PTC. We'll discuss this in some time. Administration is basically you are going to ensure that the money is collected. You administer these assets. The administration is subcontracted back to originator, which collects principal and interest from underlying assets and transfer it to SPV, which works. This is basically that receiving and paying agent. Receiving and paying agent. Is there a recourse or non-recourse? You say if there is no recourse, then the loss has to be borne by SPV. If there is a recourse, the default will go back to the originator. Performance of securitized paper depends on the performance, and unless specified, in case of default, they go back to the originator. The funds will be repaid to the investors. Credit pooling, credit rating can be done, which is also one of the requirements. Now, though securitization is good, but still there are certain problems with securitization in the India's context. Okay, let's move to the problems part of securitization. Now, there are multiple problems in the securitization in the India's context. Some of the points which are indicating, one I think is on the stamp duty. Under Transfer of Property Act, a mortgage debt stamp duty which even goes up to 12%. So there's a stamp duty which is there, which is going to impact the growth of securitization. Somewhere they've said PTC are exempted from stamp duty, so that is good. Also, some of the states have reduced stamp duty for securitization transaction. Second, taxation side, whether the investments which are happening from the investors, how the taxation of that is to be done. So on the taxation side also there is lack of clarity, and the opinion of experts differ a lot. Accounting aspect, see, what I do in a securitization is I transfer a part of my assets and receive money on that, and technically I'm trying to make it as an off balance sheet financing. The accounting rules are also not standardized here, and also there is a more problem if it's a with recourse kind of a transfer. When it is with recourse, in case there is a default, the risk of default will fall back to me. So just a minute. When assets are transferred without recourse, okay, I at least see a problem happening more when the transfer happens with recourse, because with recourse what indirectly happens is it's an off balance sheet financing, but still the liability can fall back on you. So from an accounting angle, that could be an issue. Lack of standardization, accounting side, documentation side also standardization is not there. And for the securitization market to work well, you need a good debt market. Good debt market is very, very critical. If the debt market is not doing well, if you don't have a well developed debt market, then it's a problem. So another issue is if there is a default which happens, I need to, for example, if a home loan is taken by an end customer and he defaults, I should go and take the possession of the property. However, in the India's context, the foreclosure laws is the mortgage lender, a person who gives loan against a property are backed by security. This mortgage backed securities become less attractive because the lenders face difficulty in transfer of property. The transfer of property does not happen so smooth. If it's not happening so smooth, then there is a problem. Now, various securitization instruments. PTCs and PTS are the two important form of securities. Pass-through certificates and pay-through securities. PTCs and PTS, pass-through certificates, pay-through security. Now let me first explain what PTC is. PTC is very simple. SPV collects 1000, pass on. SPV gets prepayment of loan, pass on. SPV does not get any money, no interest payment. So whatever SPV is getting, that entire money will be transferred, that entire money accounting for its expenses and other thing. But whatever you are receiving, if there is a prepayment, pass on the prepayment to the end investor. If there is some delay, the delay has to be borne by the end investor. So whatever money is collected, SPV passes it on to the investor. Originator transfers the entire receipt of cash in the form of interest or principal. Thus, these securities represent a direct claim of the investor on all the assets that has been securitized. Since all cash flows are transferred, carry proportional beneficial interest. Any prepayment of principal is also proportionately distributed. Because of this, there can be skewness of cash flows. There can be skewness of cash flow, because if there is a prepayment which happening occurs in early stage, if principals are repaid before the scheduled time. Now, what is PTS? PTS is, there is a set schedule. Year 1, I have to pay 10 lakh rupees. 10 lakh of year 1 interest plus 10 lakh. Year 2, interest, whatever the balance interest turns out to be, plus 8 lakh. Year 3, interest plus 6 lakh. So some set schedule is there. You will be paying money as per the set schedule. For example, some of the customers made prepayments in year 1. You ended up collecting 40-50 lakhs of principal and interest was collected. You collected extra money. You have ended up collecting extra money from the end customers. Extra money from the end customers. Now what you are going to do here is, you will pay interest plus 10 lakh to the investor. Balance money will be held back in the SPV. SPV will invest in some short-term securities, earn some interest on them, whatever it is possible, and then pass on this money as per the schedule. In contrast to PTC, backed by assets, hence it can restructure different tranches from varying maturity. This structure permits desynchronization of servicing. Simple. SPV to invest surplus funds as per the requirement. Surplus funds as per the requirement. In case of early retirement, this can be used for short-term yield. Provides freedom to issue several debt tranches with varying maturities. Here there is no skewness of a cash flow from an investor point of view. Whatever money comes in, the SPV will pay as per the schedule. There will be some tranching which would have been done. Several debt tranches can be there with varying maturities. You can have several debt tranches with varying maturity. So as per those maturities, you will keep making investment. Stripped securities is, you can convert this security which is allotted to the investor as either interest only security or principal only security. What is interest only security is, these securities, the income to the investor will come from the interest which is earned on the base securities, the interest which is earned on the base asset classes, the money which is given to the obligor, the home loans, the housing loans, the auto loans, all those. Principal only means the cash flow will come only from the principal. The holder of IO securities receives only interest, while PO security holder will receive only principal. Now, there's a problem with this kind of a security. You would have learnt that whenever yield changes, yield is our interest rate changes, the present value of interest and current market price of debt is impacted. Sorry, current market price of debt is impacted. Reinvested interest and current market price of debt is impacted. That is, if interest rates go up, the value of the bond will come down, but the reinvested interest will keep going up because your interest rates have gone up in the market. So whatever you're reinvesting, that will keep going up in future. The reinvested interest will go up, but the current market price of a bond will come down. If interest rates come down, the current market price of a bond will go up, and that is where we had a concept called as immunization of a portfolio, where we said that our investment horizon should be equal to the bond. Now, if you are only in interest only or debt principal only, the problem is when a change happens in the market, when the interest rates change, interest only security can go down, principal only security can go up, or the alternate. Earlier both were together, so loss on one side was impacting the profit on the other side. Here if you are only interest or only principal, they are highly volatile. They are going to be highly volatile, and because of this they are less preferred by the investor. Final question is, how are you going to do the pricing of the securitization instrument? How are you going to decide the pricing? Pricing is very simple. The value which the SPV needs to pass on, the value which the SPV needs to pass on to the originator, the value which, how are you going to calculate? Let's first look at from an investor point of view. From an investor's angle, what he is going to do is the security price can be determined as the present value of future cash flows using a comparable yield, using a rate of yield to maturity of a security which is comparable, So using that comparable rate of yield, you do the discounting. After doing the discounting, you get to know the value of the securities to be issued, and this needs to be passed on to the originator. From an originator point of view, he would want the discount rate. He would want a lower discount rate. Investors would want a higher discount rate. From an originator point of view, the instruments can be priced at a rate at which the originator has to incur an outflow, and if that outflow can be amortized over a period of time by investing the amount raised through securitization. Now what is originator has to incur an outflow is simple. See, the originator is not going to get regular income now. He's not going to get regular income over a period of 5 years, 10 years, or whatever is that time period. So that cash flows are not going to come to him. Because he's transferring the assets now. So what the originator basically wants is, he wants a healthy inflow initially. So that he wants a lower discount rate. A lower discount rate will give a higher present value of cash inflow, and investor would want a higher discount rate. So they try to negotiate and decide what can be the pricing at which this can happen. So from a securitization point of view, first we understood the process of securitization. After that we saw what are the features of securitization, which is creation of financial securities, bundling and unbundling tools. If it's a non-recourse, tools of risk management, structured finance, trenching can be done, homogeneity is there. There is homogeneous, the securities are of homogeneous nature. There are how did the market of securitization evolve in India, starting with Citibank, starting with auto loans and moving together to multiple things. Who are the participants? There are primary participants, there are secondary participation. There are benefits to the originator because it becomes an off-balance sheet financing. It improves their ratios. They can focus on their core business, reduce borrowing costs. From an investor point of view, risk diversification happens if they can fulfill the regulatory requirement, and there can also be protection against default, and also you can go through some insurance which can be taken. Participants, primary participants, where your one is your the primary participants was your ICICI Bank, which is your originator, SPV, and then the investors. Secondary is your obligor is there, who are the person who have taken the loan. There is a need for a credit rating agency. There's a need for receiving and paying agent. There's a need for a trustee who's going to oversee the operations. There's a credit enhancer requirement which can be there. And structurer is a person who is going to structure this transaction. Mechanism of securitization, creation of pool of assets, transfer to SPV, issue of security, collect the money, administration of assets would be there. What happens if there is a risk of default, and finally paying back the money to the investor, repayment of funds, and credit rating of instruments. Problems in securitization: stamp duty, taxation issue, lack of standardization, accounting level issues are there, ineffective foreclosure laws are there, inadequate debt market is there. There are multiple ways of securitization instruments. One is your PTCs, where if you get a prepayment, pass it on. If you are not, whatever interest is earning, everything is passed on. No money is held back at the SPV end. At the pay through security, they are going to held back money. This money would be held back at their end. They will pass on as per the predefined schedule. So you can do tranching of different maturities. and stripped securities, which can be only IO security, interest only securities, or principal only securities. They are more volatile and hence less preferred. Pricing is basically using a discount rate for the purpose of discounting of future cash flows. The discount rate could be the discount rate, the yield to maturity of a security which is comparable with respect to the credit quality and the average maturity. Originator would want a lower discount rate, investor would want a higher discount rate, and that's how the pricing is finally decided. Let's start now with the discussion on mutual funds. A mutual fund is basically a trust which is going to collect money from a lot of investors. They'll pool that money together and invest as per the objective, as per the investment objective given in their mutual fund philosophy. They would be either investing in equities, they could be investing in debt. In equities, they could be investing in large cap, they could be investing in mid cap, they could be investing in micro cap, they can be investing in flexi cap, they can be investing small cap. So different mutual funds invest in different asset classes. They can invest in real estate, they can invest in government securities. So the role of a mutual fund is it is going to pool money together from multiple investors, like-minded investors who share a common financial goal and then invest the money. It's a trust that pools together the resources of investors to make foray into investments in capital market. Resources of investors who share a common financial goal. This is managed by a fund manager, professional money manager, who makes investment in various stocks, bonds, other securities according to the investment objective. According to the investment objective. So the mutual fund plays a very important role for retirement planning or for planning a corpus fund, because see, when I was explaining earlier, I had said that investment in equities are very critical if you want to create a long-term wealth, because if the returns can increase even by 1 or 2%, it can have a significant impact on the final corpus created. But there also we did learn about some challenges. The challenges which we learned is investing directly in equities is risky. That is why people invest in mutual funds. Through mutual funds, you can make investments in equities. What are the various classification of mutual funds? So there are multiple levels of classification which are there. One is based on the functional classification, based on the portfolio level, based on the ownership level. So multiple level classification are there. Functional level, open-ended funds and close-ended funds. What is open-ended funds is an investor can enter and exit at any time. Practically many of the funds are open-ended. You can enter and exit at any time. The NAV would be calculated on a daily basis and given to you. So you can invest at any point of time, you can exit at any point of time. Practically even for open-ended funds, sometimes the mutual fund will say that they are not going to accept any lump sum investments. They'll accept systematic investment plan investments, but they will not accept lump sum investment. The problem for mutual fund is if money keeps coming in, you need to invest. Sometimes the markets could be at a extreme rich valuation, peak valuation. That time you may not have money to invest. So you can say that even in an open-ended fund, the MF can put restrictions on entry. Exit restrictions will not be there. Close-ended funds is there is an IPO which will happen. After that, you cannot enter, you cannot exit. If you want to exit, you will have to exit through stock markets. You will have to exit through buying and selling it in the stock market. So you can sell it, someone else will buy it. The mutual fund is not going to buy it. Next classification, equity funds based on the portfolio. Based on the portfolio, you can do it on equity funds, debt funds. So equity side, there are multiple subcategories. Equity funds are basically these mutual funds will invest in equity shares. Debt funds are those which will invest in the bonds and debentures. Debt, they'll invest primarily in the debt. The equity guys can also have some debt investment, which is also called as a balance funds, which can be there, which can invest small amount in debt also. Growth funds, these are basically trying for long-term capital appreciation. They are trying to invest in companies which are doing well and expect to do well over the longer term. They are not looking for some short-term kind of returns. Aggressive funds is, the term aggressive itself indicates that they are able to take more risk. They are able to take more risk. So these guys are willing to take more risk. Because of this, they are going to invest in companies like startups, speculative shares, IPO. Income funds is the ability, they are planning to invest in those companies which give high dividends. The objective is to invest in those companies which give high dividends and high yield money market. So they are basically for investors who want regular income. Balanced funds is mix of debt and equity. Mix of debt and equity. You try to balance both. Try to balance, because debt gives you low return but it has low risk. Equity gives you high return and high risk. So you want to balance both. Debt funds, you can invest in bond funds and gilt funds. Bond funds are basically fixed income security which can be issued by government. It can be issued even by non-government, like corporates can be issued, the banks can be issued. So you are basically making investments in this. Gilt funds are basically you invest primarily in government security. They're going to invest specifically in government security. There's the third way of classification, which is on the special funds. In special funds, I have multiple category. One is index fund. Index fund are those funds which invest in specific index. For example, there's a fund which is on Nifty. There's a fund which is on Sensex. There's a fund on Nifty 100. There's a fund on small cap which could be the top 100 or the top 50. So you are basically investing in a bouquet of securities rather than a single security. These are very low cost funds because there is a passive kind of an investment strategy. You're not going to regularly monitor. International funds are mutual fund which is located in India, which is raising money in India, but it's going to invest in global securities. It's going to invest in global security. Whereas an offshore funds is one which is located in India, but it raises money outside and invests in India. Invests in India. International funds is raising in India, investing outside. Offshore funds is raising outside and investing in India. Sector funds is basically those funds which will invest in specific sector. You can have real estate sector, steel sector, pharma sector funds. So power, gas, public works. So specific sectors they are going to invest. Money market funds are basically predominantly debt oriented schemes. Objective is to earn interest income. Money market means short term securities. So their objective is to preserve capital and invest in safer short term instruments. Fund of funds is basically these are going to invest in multiple mutual funds. They are going to invest in schemes which invest in other mutual fund schemes. So they are going to invest in multiple mutual fund schemes and they are going to earn returns. This is extreme amount of diversification. Diversification is good, but this is extreme amount of diversification, which is a capital protection oriented fund. The name itself will indicate what it wants to do. It wants to protect the capital, protect the capital investment, set aside major portion of the assets for capital safety and invest in high rated debt instrument. Some amount they may want to take risks and invest in equity side. They want to take risks in equity side. Gold funds are basically going to track the performance of the gold and invest in the gold side. Ownership classification. So there was a functional classification which was open-ended and close-ended. Equity funds, we have a portfolio level classification. Equity funds, growth funds, aggressive, income and balance. Debt funds had bond and gilt. In special funds, we saw index fund. Index funds can also be an equity fund also. So there can be what do I say? A same fund can be called as equity fund and can also be called as an index fund. Then we had something called as your offshore fund, international fund, fund of funds was there, sector funds, gold fund. Then from a classification, ownership classification, you can have a public sector mutual fund, private sector mutual fund and foreign sector mutual fund. Public sector are those by companies of the public sector, that is government companies. Private sector are sponsored by the private sector and foreign funds are by those companies which operate raising in India, operate from India, invest in India, but these are sponsored or these are owned by the people who are outside India. What are the various types of schemes in mutual fund? Various types of schemes in mutual fund. I think you will see this as a continuation of your equity funds only. Balanced fund, which we saw here. It's a kind of continuation only. Balanced funds which we saw here, which is going to invest in a mix of debt and equity. Mix in stability along with growth. Stability along with growth. Equity diversified funds. Equity diversified funds is these are going to have high level of diversification, invest predominantly in equity shares, can be flexi cap, can be index fund, can be dividend payout fund, dividend yield fund, contra fund. Equity tax linked saving schemes, ELSS schemes, the objective is to get tax benefits. Sector funds which are going to invest in particular sectors, again we are repeating. Thematic funds, they may invest in multiple sectors rather than investing in a single sector. They go with a specific theme, Make in India. If Make in India is a theme, which are the funds which are likely to earn better? Which are the funds which are likely to earn? So accordingly you will make investments. Arbitrage funds, these are basically trying to earn returns by taking less risk. Arbitrage is basically earning returns without taking any risk. You try to earn based on the price differentials on the spot and futures market. Hedge funds are those which are a private investment vehicle. They are free from most of the regulations. So these are aggressively managed funds with the goal of generating high returns. There are less regulations. They do not reveal most of the informations publicly. So it is a high risk but kind of a high return. Cash fund is more or less like a liquid scheme. It's more or less a liquid scheme which invests in low risk, ensure better liquidity. This is mostly for institutional, there are a lot of institutions which may want to invest in. They may earn returns of 3-4%, very less kind of a returns which are earned. Exchange traded funds is basically a type of an index fund. It's a type of an index funds which are listed on the stock exchange and it is sold and bought. Index ETFs, commodity ETFs is there, commodity exchange traded funds. This is on the commodity, on the bond, on the currencies. So exchange traded funds are basically those which are bought and sold in the stock market. They are bought and sold in the stock market just like a normal sale. This is very critical in case of close-ended. For close-ended you will need that trading to happen. What are the advantages and limitations of mutual fund? There are multiple advantages of mutual funds because you are now getting the strong research done through a professional management. So these are managed by people who are skilled and professionally experienced. They have the ability to do the research. So because they are able to do extensive research, they'll be able to make proper investments. Diversification can be done. They can generate higher returns over a longer period of time. Low cost of management. There are limitations on the expense ratio. Some limitations are fixed by the AMFI, Association of Mutual Funds of India. Liquidity is there, transparency is there because a lot of regulations are there which are going to impact. But there are disadvantages also. There's not going to be any guarantee of performance and all. There can be losses as well. There are some extra expenses which needs to be incurred. There are other benefits which they're talking about. That is like you can have a regular withdrawal and you can have a systematic withdrawal plan, systematic investment plan. Economies of scale benefits are there. Systematic investment, systematic withdrawal plans can be there. No guarantee of return. It is not going to give any guarantee of return. It can lead to losses. Investors, mutual funds sometimes may depreciate in value. They can depreciate in value. The principal itself can get eroded. Diversification helps, but it minimizes risk. It cannot give you maximum returns. The selection of the fund itself can be sometimes a risky thing. Easier to select the right share because there are multiple funds which are available in the market. So selecting that can be a difficult thing. Carry a price tag, that is your expense ratio. Unethical practices can be there because people who are trying to sell the mutual fund, they may do some unethical practices and sell a fund which is not in line with your financial goals. Taxes side, when a mutual fund sells it, there are taxes which they need to incur. So one, I have my personal taxation which is there. The fund is also going to pay tax on top of that, which can lead to reduction in return. If the MF is not managing and I manage my funds directly, then that tax which the MF pays will not be there, and I can manage it and I can directly pay tax on it. So now there is going to be double taxation. When the MF will pay tax, I will also have to pay tax. Earlier the taxation was very good because there was no taxation on LTCG. Because of the taxation being brought on LTCG, it is another difficulty. Next, concept of side pocketing in mutual funds. Now, side pocketing as a concept came into picture. I think in the India's context also a lot of discussion came in because of ILFS default. When the default happened, a lot of mutual funds had a huge erosion in their NAV. Lot of mutual funds had a huge erosion in the NAV because you had to write them off because the credit rating of your investments came down. So you had to write it off. What side pocketing says is these risky assets those assets which are not doing well, you separate them from other investments and cash holding. So there will be two types of assets. One is your normal asset, for which there will be an NAV calculated, and there will be another pool which is risky assets, for which there's a, whenever you buy a mutual fund, you'll obviously get access to those assets also, but in the NAV calculation they are not considered. Purpose is to make sure that money invested in mutual fund which is linked to stressed assets gets locked. You keep it separately until the fund recovers the money or could avoid distress selling of illiquid securities. So unless that money is collected, if you are able to realize that money, this money will not be paid back to the end investor in a mutual fund. Invest in security which normally enjoys high credit rating. When the rating decreases, there are certain illiquid assets which are there, which are into a side pocket. Current unit holders can only be benefited from the liquid assets. So the NAV of the fund will reflect only the actual value of the liquid assets. These illiquid assets will be transferred. Beneficial who wish to hold on ensures that liquidity is not in the problem, even in the cases of frequent allotment and redemptions. This is quite common in the international market. I have not seen much happening in the local markets, but this is quite common there. You keep it separate. Whenever the return is earned, whenever that money is come back, this money is paid back to the mutual fund investors. Okay, direct plan in a mutual fund. See, there are two types of a plan. One is called a direct plan and a regular plan. What is regular plan is, you will invest in a mutual fund through an agent. An agent will come, he will explain to you the fund and you make the investment. Earlier when you were doing, you had to pay some commission and all. Now those things have been removed. So what happens is, this agent will be getting some income from the mutual fund. The agent will be getting some income from the mutual fund. So the agent will tell the investor to invest and the agent will get income for this, which is technically called as commission. So the MF will earn expenses. Okay, can be two categories: commission, others. Commission will be an expense only for regular plan. Others will be an expense for regular plan as well as direct plan. Direct plan means you are directly investing in a mutual fund without using the help of an agent. So when you don't use the help of an agent and directly invest in a mutual fund, the expense ratio, because you are not bearing any commission, the expense ratio will be lesser for you, which can lead to better returns. To make direct investments, but there were no separate plans. These investments were made in distributor plan, were tracked with single NAV. Was forced to buy mutual funds based on the distributor plan. Are those plans where asset management companies or mutual fund do not charge distributor expenses, trial fees and transaction charge. NAV are generally higher and they will obviously give better performance because the expense ratio is on the lesser side. But if you want to do a direct plan investing, you should be very clear as to which fund is to be investment made, because if you are not very clear and you make a wrong investment, that can lead to erosion of net worth. So you may need a help of an agent. Quant fund. What is quant fund is? In fact, I am seeing this quant fund now in multiple AMCs, multiple asset management companies are coming out with a quant fund. Quant fund is making investments without any human intervention. It's a data-driven approach. Or stock selection based on predetermined rules or parameters using statistics. Some mathematical model will be there on risk, return, price history, growth of a company. So you look at that, and based on that, an automated program will tell when to invest. Contrary to an active fund manager who selects the quantum, this fund completely relies on an automatic program for quantum as well as its timing. You cannot say that there is full human intervention, but those emotions and all don't play a part. The fund manager will be testing the robustness of the model. He will only keep tracking this model. Index fund is different and quant fund is different. In an index fund, the investment happens on the bouquet of the securities which form part of the index. May entirely hands off the investment purely based on index. Quant fund is going to design a model based on the mathematical model. It will decide which securities to invest in. The basic need is, I don't want emotions to affect my investment decision. Eliminate the human biasness and subjectivity. It is going to ensure consistency across the market condition. It follows passive strategy, because of which the expense ratio will turn out to be lesser. Expense ratio will turn out to be lesser. And I've also seen historically that these funds have generated better returns. Their funds have generated better returns, but you cannot blindly take this to be a good indicator. Are tested on the, and past trends though cannot altogether be ignored, but cannot, because in the past they have generated healthy returns, but it is not necessary that they'll continue to generate better returns. So mutual fund is basically a trust which is going to collect money from like-minded investors and make investments. The objective is to earn returns and create long-term wealth for the investors. There's a functional classification which is open, close-ended, portfolio level classification which is equity funds, debt funds and special funds, and ownership classification where you have public funds, private funds and your government related funds are there. Multiple schemes are there. Balance fund scheme is there, ETF is there, equity linked savings scheme is there, security funds is there, equity diversified funds are there, arbitrage funds, hedge funds, thematic funds. So multiple categories of funds are there. They invest in, this is also types of funds only. They are asking about different schemes. In exam they can ask what is thematic fund, or what is a sector fund, or what is a fund of fund, what is a money market fund. So be aware of each of the different categories of funds. Benefits of mutual fund is a professional management who does a well research, creates long-term wealth, higher returns, diversification benefit is there, transparency is there, liquidity is there. Disadvantages is there is no guarantee of performance. Selection of the fund can be a very difficult area because multiple funds are there. Diversification though generates lesser risk, but it cannot give you high returns. Unethical practices can also be there. Side pocketing is separation of risky assets, those assets which are likely to default from the other assets. So the NAV of the mutual fund will only reflect the value of the liquid assets in the mutual fund. The illiquid ones are transferred to something else. Direct plan is basically something which does not consider expenses like your commission, your commission or the distributor discounts which are given. These are not forming part of the expense, so the expense ratio is less, so automatically the returns are higher. Quant fund is basically those funds where the investments are done on the basis of mathematical model, statistical model, predetermined rule. On the basis of those rules you try to decide the investments to be done. They have historically shown better returns and they follow passive strategy. Hi friends, so let's now start recording of chapter 8, which is on derivatives analysis and valuation. Just maybe a little bit of discussion on what is derivative. That's the first question. As you would have learned when we did the theory part of it, there are basically 4 types of derivatives which we had seen, or we had classified them into 4 categories: futures, options, forwards and swaps. Basic rule is a derivative is basically an instrument whose value is going to be derived from one of the underlying assets. Any underlying asset which can be, in India's context, you can have underlying asset as equity, forex, precious metals, commodities, interest rates, indices. So anything can be an underlying asset. A derivative is basically one which is going to derive its value from the underlying asset. So whenever there is a change in the value of the underlying asset, you will see a change in the value of the option contract or the future contract or the forwards or the swaps. So all derivatives value, all derivative instruments are dependent on the underlying to have value. For example, TCS futures or options will have its value derived from the underlying price of the share of TCS. So dependent on the underlying, any changes in the value of the underlying asset will lead to a change in the value of the forward contract or the futures contract or the options contract. If there is no underlying asset, technically the derivative instrument will have no value. So the valuation of a derivative instrument can happen only because it is called as derivative instrument, because it derives its value. It derives its value from one of the underlying assets. So if there is no underlying asset, technically there cannot be a value for a derivative instrument. On the maturity, the profit or loss is computed. You kind of do a net settlement, and that net settlement is adjusted, is determined by the price of the underlying instruments. If the price of the underlying is higher than the contract price, buyer makes a profit, and if it is lesser, the buyer suffers a loss. We used to do it as date, position, action, reference date and rate, and we used to calculate how much is the profit or loss out of the derivative instrument which the person is making. What are the who are the main users of derivatives? Now this derivative can be used for hedging purpose, can also be used for speculation purpose. These are the two main purpose of this. Hedging means you have an underlying contract, and for example, if you are an exporter, you may want to hedge a receivable or a payable. If you are an exporter, you want to hedge a receivable. If you are an importer, you may want to hedge a payable. If you don't have any underlying transaction, then you are trying to speculate. So corporation are basically the corporates. They want to hedge against currency risk and inventory risk. You want to hedge against forex payable or a forex receivable. You may also do a hedging of some commodities. For example, you hold 1 lakh kgs of copper, you want to hedge against that. That is also possible through a derivative instrument. Individual investors for speculation purpose, so they may try to do speculative transaction or hedging. Both are possible, speculative or hedging. Yield enhancement is increasing the yield or increasing the return. That is possible if there is some arbitrage opportunity which is there. If there are arbitrage opportunity, that's a possibility of enhancing the yield. Institutional investor, again hedging, yield enhancement and avoid arbitrage opportunity. Dealers are basically for hedging purposes. The main two purposes, hedging and speculation. This can also indirectly lead to some arbitrage opportunities which are possible. Differentiate between cash market and derivatives market. Cash market is basically the normal market. For example, today you go to you have a demat account with some of the broker. You buy and sell your shares either through BSE or NSE. That is the cash market, when you buy and sell the shares, or you're buying and selling gold in the normal market. Derivatives market is basically which is going to derive its value from the cash market. In the cash market, all the underlying assets are bought and sold. In the derivative market, the futures or the options or the forwards or the swaps of the underlying assets is going to be bought and sold. So in cash market, tangible assets are traded, whereas in derivative market, tangible or intangible assets like index or rates are traded. They derive their value from these assets which are traded in the cash market. You can purchase one share. In futures and options, we have a lot size. So the lot size can be 200, 1000, 2000. This point I don't agree to it, but your material has this. Cash market is considered more risky because in futures limited up to 20%. That's not logical, because in a futures and options market, what happens is you give a margin and based on that you do buying and selling. In fact, practically futures and options are more riskier than the cash market. They are considered to be more risky, so this point may not be logical. Cash assets. In the cash market, you cannot do the speculation kind of a stuff. You'll be either buying for the purpose of consumption or for the purpose of investment. You may buy it and consume it immediately, or you may buy it and use it for the purpose of investment. In derivatives contract, you can do hedging. Hedging is you enter into a buy transaction today, you wait for some days, square off the transaction. Sorry, not hedging, speculation. Speculation, you buy and square off the transaction. Hedging purposes, you may have an underlying asset in the spot market or in the cash market, and you want to protect yourself from movements. For example, budget is going to be announced. During budget announcement, I am little worried that there could be a lot of changes in my share price. There can be a significant fall or a significant rise, and I want to protect myself from this. That protection is possible through a derivative contract. The value of the derivative contract is always linked to the underlying security. That is, the whatever is happening in the underlying asset, the value is going to be derived from this. This is okay. In the cash market, a customer must open securities trading account with the security depository. Here you have to open a trading account with a derivative broker. When you want to buy and sell in the cash market, you need to make upfront payment. If you are wanting to buy something, you need to make upfront payment. The good part about derivatives market is you can just pay a margin money. If you want to buy shares worth 10 lakh rupees, you can buy by paying a margin of 1 lakh. By paying a margin of 1 lakh. When you are in the cash market, you buy that asset, so you become a part owner of the company. When you become a part owner of the company, you are eligible to get dividends and all. Here you do not become a part owner of the company. With the purchase of shares, the holder becomes a part owner, so you are eligible to get dividends, you can vote, all that comes to you. While in future, you do not become a owner, you are not becoming a owner of the company. Explain cash settlement and physical settlement in derivative contract and the relative advantages and disadvantages. See, cash settlement and physical settlement are the two forms of settlement of derivative contract. All problems which we would have solved, we have gone with a cash settlement. Physical settlement means you are going to do delivery of that underlying asset. If you are buying TCS futures, you will have to deliver TCS share or get the delivery of the TCS share. So physical settlement is means underlying assets are actually delivered at the specified delivery date. Cash settlement means you are not going to do the delivery of the underlying asset. You are going to square off the position by paying the difference between the purchase price and the selling price. A net settlement would be done. The seller does not deliver but transfers the cash. It is similar to index futures, where the purchaser who wants to settle will have to pay or receive the difference between the spot price of the contract on the settlement and the futures price decided beforehand. So cash settlement is basically net settlement which happens. Physical settlement is basically delivery of the underlying asset which happens. Cash settlement, the advantage is good amount of liquidity will be there. Lot of people would want to enter into such contracts. It enhances the liquidity. It enhances the liquidity. The reason for enhancement of liquidity is simple, because there could be a lot of buyers and sellers now, because you are not required to actually deliver this contract. High liquidity because of more derivative volume in cash segment. You are going to have a significant volumes being there, because volumes happen significantly. Reason is I need not deliver the underlying asset, so I need not worry about the physical delivery, and I also need not worry about receipt of physical delivery. So I don't need to receive the physical delivery. I also need not give the physical delivery. So it can enhance liquidity. It can help you in hedging of an adverse move, because you have already an underlying asset. So you want to cover yourself against this. If you want to cover yourself against this, you can do it through an adverse, so you can cover it through a derivative transaction. Similarly, for example, if you have covered short derivative position by selling the future while holding the underlying security. I currently have the underlying security with me. The problem is I believe the prices can crash now, but I don't want to sell the share. I believe the prices can crash now. I don't want to sell the share. So what I can do is I go for a short position in the derivatives market. I wait for 1 month, 1.5 months, whatever is the time period I wanted to wait, and then square off the transaction. So the share continues to be there. Whatever loss I would have faced because the prices have fallen, I would have got us profit on the short position. Similarly, you can do trading in stock at a lower cost. Lower impact cost is basically lower transaction cost will be there. Disadvantages is it leads to a lot of speculation activity. It will lead to a lot of speculation activity. Facilitates the traders to do speculation. They're going to do a lot of speculation. Physical settlement is the speculation or manipulation cannot be there, because if you have an underlying asset only, you will do, see, there could be only 1 lakh shares in TCS, but in the futures market even 10 lakh shares can get traded, because you are not bothered about an underlying asset. So when you are not bothered about an underlying asset, you can end up doing speculation or manipulation of the prices. So advantage of physical settlement is no manipulation. Disadvantage is liquidity is not there. Liquidity is not there. You cannot do a short sell transaction. So physical settlement is good. It curbs manipulation, but it also takes away the liquidity. So you will have to see what is critical. In the India's context, a lot of transactions happen in the cash settlement. I think physical settlement is also started now, but what does predominantly happen is the cash settlement. Distinguish between forward and futures contract. We have seen extensively about forward contract when we did forex chapter. In the forex chapter, there's an extensive discussion which happens in the forward contract. Futures is predominantly learnt as part of derivatives. See, there's no big difference from the way of working, but the difference is there is an exchange which sits in between in case of futures, so default risk will not be there. Margin is required to be paid initially. It is a standardized kind of a contract. Here it will be customized kind of contract. Forward contracts are traded on personal basis. That is, you do a transaction between one person and the banker, or one person and another company. Futures contract are traded in a competitive arena. Here what happens is you don't even know who's the buyer, who's the seller. This can be customized. There is a standardized quantity. You cannot customize according to your requirements. You cannot say that I want exactly for 5,25,200 rupees. That is not possible. Whereas you can get it for 5,25,200, whatever is your exact requirement, that requirement can be fulfilled in the forward contract. There is no trade which happens was technically for forward contract. Basically no trade happens. If at all you want to square off the transactions, you do the over the counter. That is, you go to the bank and talk to the banker saying that you want to cancel the contract. Cancelling the contract is technically taking an opposite position, and your trade gets exhausted, or your trade gets cancelled. Here you can do trading in the market. There will be a lot of buyers and sellers which will happen. Settlement, forward contracts are normally settled one based on the date which has been agreed upon. There is no there's no settlement date per se here. The date is agreed on. In futures, normally in India's context is last Thursday of the month, and also there is a daily settlement which happens. Daily profit or loss would be calculated, which will be debited or credited to your margin account, and if you do not have sufficient money in the margin account, you are required to replenish that. If the sufficient money is not there in the margin account, that needs to be replenished. Another issue is delivery. Delivery is something which is done mostly as far as the forward contract is concerned. In futures contract, delivery does not really happen. Delivery does not really happen. Mostly it's a cash settlement which happens. Forward contracts may be delivered on the dates agreed upon in terms of the actual delivery. Future contracts delivery dates are fixed on cycle and hardly takes place. Hardly takes place. Very less. There is only a cash settlement which is done. You don't go through a system of physical settlement. Transaction cost is technically not there for forward contract. You look at the difference between the bid and ask, that is technically the cost. Here there are some brokerages which needs to be paid. No concept of MTM, no concept of margin to market. MTM is basically, it can lead to some profits or losses. So if there are profits, your margin balance goes up. If there are losses, the margin balance comes down. Futures contract are subject to MTM. When loss or profit is debited or credited in the margin account on daily basis, and if your margin account does not have adequate balance, if you fall below the maintenance margin, you'll have to replenish it back to the initial margin. Margins are not required. Here margins are required. The last important part, the default risk. This was the point I was saying about. When we did your forward contract, we saw that on the maturity date, the person may cancel the contract, the person may extend the contract, and also there's a possibility that the person does not appear on the due date. So credit risk is born. Therefore, every party has to be bothered for the credit worthiness. I have to ensure that the other party is going to fulfill its commitment. If the other party is not fulfilling its commitment, then there is a problem. Here I am not really bothered about the credit risk. The default risk or the credit risk is not there, because in futures market there is an exchange which sits in between. The exchange will ensure that both the parties fulfill their obligation, and for that purpose only that margin is taken. Margin will ensure that both the parties are fulfilling the obligations. What is marking to market? See, in a derivative contract, every day profit or loss would be calculated, and that amount would be debited or credited to your margin account. That process is technically called as MTM. Why is this done on a daily basis? Because I don't want the margin account to have a balance lower than the losses. Because if there's a significant loss, my margin account may not have the balance, and if balance is not there, the party may not fulfill their obligation, and because of that, the broker will have to suffer losses. So it implies the process of recording the investments in traded security at a value which reflects the market value of securities. In the context of derivatives trading, are marked to market on a periodic or daily basis. Essentially that at the end of all outstanding contracts are repriced. So once you do this repricing, the profit or loss is debited or credited to the margin account of the broker. So this will ensure that there are better risk management practices, and it will ensure that futures contract are settled by both the parties. Otherwise, what will happen is, on the maturity date, if money is not available, there is a possibility that one of the parties may not fulfill the obligation. What are the advantages of stock index futures over stock futures? What a stock index is? Nifty. Nifty consists of some broadly 50 stocks. Sensex consists of some 30 stocks. A stock index future is basically a future contract on Nifty or Sensex, as compared to a stock future which is on TCS or which is on HDFC, which is on ICICI. So on that specific stock, there can be a futures contract, or there can be a contract not only on this, there can be a contract on one on the index futures, one which is on the Nifty, and the second one can be on the specific stock. You can end up doing it on the specific stock of the company. See, index futures are always better than stock futures. The reason is, index futures consist of so many stocks, so it is not easy to manipulate them. It's not easy to manipulate them. Speculation can't be done that much. Second, even with a small margin money, you can take up a position of, for example, even with a small margin of 10%, if you want to buy or sell worth 10 lakh rupees of Nifty, you just need to pay maybe 5% or 10%. For a stock, the margin requirement is higher. The reason is simple. Index is considered to be lesser risky because it's a combination of so many shares. So some shares will do well, some shares will not do well. So because it's a combination of multiple stocks, the index futures are considered to be less riskier, as compared to the stock. It adds flexibility to one's investment portfolio. Flexibility, basically you can hedge it. Institutional investor and other large equity prefers most this instrument in terms of portfolio hedging purpose. Next, speculative gains using leverage. What is speculative gains using leverages? It is not that you are manipulating the prices. It's difficult to manipulate. But if you are thinking that prices are likely to go up, you can make a huge money using leverage. Leverages, if you pay a small amount of margin money, you can do a transaction in a large amount of capital. You can do with 50,000 rupees, you can buy or sell index worth 10 lakh rupees. Cost efficient hedging, cannot be easily manipulated. I said it cannot be easily manipulated. Speculation is you are trying to use smaller money. What is speculation is you are thinking it will go up, and because of that you are buying it. Consisting of many securities, so being an average stock, it is less volatile than the individual stock. A combination of 50 stocks will see in a single day TCS can go up or come down by 20% also, but you'll hardly see Nifty going up or coming down by 20% in a single day. So the standard deviation is also less. Because the standard deviation is less, you are required to maintain small margin. So because the margin is less, you can buy as well sell contract with the same amount of margin. Also, this point in your index, you can do a net settlement. Even in individual stocks, in India's context, you can do net settlement. It is possible to net settlement. Here they are talking about physical delivery, but mostly it can be done as a net settlement as well. Also, there is no major regulatory complexity. In case of your stock index futures, the SEBI or your NSE, BSE are not going to put in a lot of restrictions there. Whereas the stock futures, there can be multiple restrictions. Sometimes you may stop even the trading of a futures or an option because that stock is not doing well, or there are some issues with the stock. You can even stop the trading of that. But Nifty, normally you don't touch upon that. So the regulatory complexity or regulatory overview is also limited as far as your stock index futures is concerned. Distinguish between options and futures. I think nothing much for me to discuss as far as options and futures. Major difference is simple. In an option contract, you have a right to buy or sell an underlying asset, but not an obligation to buy or sell. There is no obligation to buy or sell. Futures, you have a right as well as an obligation. There's a right as well as an obligation. In option, the buyer has the right but not the obligation to purchase or sell the stock. In a futures position, you have obligated on or before the expiry date. Obligated as well as you have a right. Movement of the market. What is movement of the market is what happens to the change in the stock price. How is it going to affect the change in option price or futures price? Whatever is the change in stock price, mostly the same change will happen in the futures price. Futures contract will much more closely follow the price of the underlying stock. In option, we understood that there are in the money options, there are out the money options. So the delta of a deep in the money option is closer to 1. That is, if it's a deep in the money option, the movement of the underlying asset would be equal to broadly closer to the movement of the derivative contract also, or the option contract also. Whereas for a deep out the money option, the delta would be closer to 0. So the delta measures the relationship between the option premium and the price. Option value may fluctuate independently. It can vary significantly as compared to the underlying asset. Now, what is the price which you pay for investing? The price of investing. In case of an option contract, we are required to pay premium. We are required to pay an initial premium needs to be paid as far as the option contract is concerned. Takes a long position, he or she pays a premium. The premium is considered as a sunk cost. The premium is considered like a sunk cost. Whereas in case of an futures contract, you are required to pay an initial margin and there is a maintenance margin, and this is not an expenditure of yours. This money would be returned back to you. This money would be returned back to you, or your profits or losses would be debited there. So those profits or losses will increase the margin or will reduce the margin, and whatever amount is lying back there, that amount would be paid back to us. Okay, next question is, what are the factors which affect the value of an option? The important factor is what happens to your underlying asset. The value of the call and puts are affected by the changes in the underlying asset in a relatively straightforward manner. When the stock price goes up, the call value will also go up. When the stock price goes up, put value will come down. Put value will come down. So this is as far as your the movement of the underlying asset is there. Apart from that, time to expiry. If the time to expiry keeps coming down, see, the value of an option has two components. One is an intrinsic value and the time value. The time value will keep coming down with every day of expiry. So options future expiry at which time it may become worthless is an important key factor. Ultimately, time can determine whether your option trading decisions are profitable. So time to expiry is very critical. Volatility in stock prices, interest rates. If an option is highly volatile, if a highly volatile option will have higher premium. Statistical called a standard deviation. You can calculate standard deviation and calculate this, how volatile the stock has been there. If the stock is highly volatile, it will lead to higher price. Interest rates is also another factor which is going to impact. Another factor which affects the value of the option is the time value of money, which is basically the interest rates. If the interest rates are higher, the present value becomes lesser. So main factor is price of the underlying asset, but apart from that, time till expiry. Okay, these are the two major factors, standard deviation and interest rates. Write short notes on various Greeks: delta, gamma, theta, rho and vega. Delta is something you know. Delta basically measures how much is going to be the change in the value of an option contract as compared to the change in the underlying asset. Will move given a small change in the underlying asset. Delta can be positive, can be negative. Call options have positive delta, put options have negative delta. Gamma is how is the delta changing? Delta was 0.5, now it suddenly becomes 0.45. How fast the delta changes for a small change in the underlying stock price. Delta of the delta. We had something called as a dynamic hedging and a static hedging which we had done. So under a dynamic hedging, the moment delta changes, my hedge becomes inefficient. I'll have to re-hedge it. Using the delta hedge technique, then you will have to keep gamma as small as possible, because if the gamma changes, if the gamma is very high, the delta will keep changing significantly. And I need a delta neutral position. Theta basically explains what is going to be the fall in the option price. Change, basically it's a fall. The change in the option price given a 1 day decrease in time to expiry. Because today, if you have an April contract, May contract, June contract, July contract, the option premium for July, June would be higher as compared to April and May. So what happens is, as your time to expiry comes down, the option price does come down. So the change in option price given a 1 day change in the time to expiration. Rho is basically the change in option price, to the changes in interest rates. So sensitivity or volatility of option value to the changes in interest rates. Vega is also again changes in option value, but this is change in volatility. Volatility is technically like standard deviation. So your delta basically measures the change in option price to the change in underlying asset. Gamma measures change in delta to the change in underlying asset. Theta measures change in option price to the change in expiry period. Rho measures change in option price to the change in risk-free interest rate. And Vega measures change in option price to the change in volatility. Embedded derivatives have been removed from your syllabus, so I am not discussing this. Discuss the type of commodity swaps. So in interest rates, so we had forwards, futures, options and swaps. Swaps is something we discussed extensively in the chapter on interest rates. In the interest rates we have discussed. So there are two types of commodity swaps. One is your fixed floating swaps, which is what we learnt in the interest rate chapter, and the second part is commodity for interest rate swaps. What is fixed floating swap is, one, you give a fixed interest rate, and second, you receive a floating interest. You give fixed interest rate, receive floating, or you pay floating and receive fixed. They are just like the fixed floating swaps in the interest rate swap market. Only thing is your both indices, there the indices would be, the fixed interest rate could be 6%, the floating interest rate could be on MIBOR, could be on LIBOR. Here the indices are the base would be based on commodity based indices. In the practical world, there are two indices which are popular as far as the commodities market are concerned. One is S&P Goldman Sachs Commodity Index and second is Commodity Research Board Index. These are the two commonly used indices. These two indices will have multiple commodities in them with different weights. Place different weights on the various commodities, so they'll be used according to the swap agent's requirement. The next is commodity for interest rate swap is, for example, we had done one problem where you are paying a fixed interest and in return you are receiving the return on the Sensex. So you are paying fixed interest and receiving the variable return which is based on what is happening to Sensex. So it is similar to the equity swap in which a total return on the commodity, like total return on the interest which you are paying, the fixed interest, total return on the commodity is exchanged for some money market rate plus or minus a spread. Money market rate is basically your interest rate. So there we did a problem where interest rates was exchanged with Sensex return. Here the interest rates is going to be exchanged with commodities return. With this, I think we are kind of covered this chapter. I'll quickly browse through this. From a theory point of view, it's not very critical, but sometimes a question can come. That's why we are reading all of this. First, we understood what is a derivative instrument. A derivative is one which derives its value from an underlying asset. The value of the asset will keep changing with the changes in the underlying asset, like your equity, forex, commodity, precious metal. Main users of derivatives: corporation, companies, individual investors, institutional investors, dealers. Main purpose is hedging and speculation. Cash market and derivatives market, the main differences: in cash market you'll have to do delivery of the transaction. In the derivatives market, mostly it's a net settlement which happens. Physical settlement is delivery needs to be done. Cash settlement means delivery is not. So physical settlement is delivery to be done. Cash settlement, delivery is not required to be done. Physical settlement can lead to lower manipulation but lesser liquidity. Whereas in the other side you will have, more manipulation. Just give me a minute. Okay, in the other side you will have more manipulation. There is a manipulation which is possible when you do a cash settlement, but it will also have better liquidity. Forwards versus futures, the main difference is in a forward contract, it is a over the counter market transaction. It is not something which happens in the market. I don't know, there's some issue. It's a over the counter transaction. It is not something which is settled within an exchange. So there's no default risk as far as futures is concerned. There's a default risk in the forward contract. Marking to market is recording daily profit and loss. Stock index futures are preferred over stock futures because lesser risk, lesser manipulation, lesser margin requirement, easily hedging can be done. Options versus futures: in an option you have a right but not an obligation. In futures you have a right as well as an obligation. Prices of an option are dependent on underlying asset, time period till expiry, volatility of the stock prices and interest rates. Delta basically represents the change in option price to the change in underlying asset. Gamma represents the change in delta to the change in the underlying asset. Theta represents the change in option price to the change in period of expiry. Rho represents the change in option price to the changes in risk-free interest rate, and Vega represents the change in option price to the change in volatility. And last part is commodity swaps. Two types of commodity swaps is there: fixed floating swap. In a fixed floating swap, what happens is you use one a commodity index which is having a fixed rate and another commodity index which will have a floating rate, and you exchange that together. Or the second is commodity for interest rate swap. One, you have a commodity return, and second, you exchange it with some money market instrument plus or minus a spread. It could be on MIBOR, it could be on LIBOR, it could be on anything. With this, we are done with this chapter. Hi friends, so let's now start with chapter 9, which is on your foreign exchange exposure and risk management. Now coming to this chapter, the focus of this chapter is more on problem solving, where we have learnt about multiple concepts. We learnt about multiple theories like purchasing power parity theory, interest rate parity theory. Also we learnt about multiple hedging strategies like forward contract, futures contract, option contract, netting, money market hedge, currency invoicing. Some of those areas is what is there in the theory part. So theory is not technically different here. Whatever is there in those areas is what is coming as part of theory as far as this chapter is concerned. So first question, write short note on nostro, vostro and loro account. This we had done when we were doing an area called as exchange position versus cash position. Nostro account basically means our account with you. For example, ICICI Bank India can open an USD account in USA. Can open an USD account in USA. So nostro means our account with you. Vostro means your account with us. Your account with us. It's exactly the opposite. Citibank USA will maintain an INR account in India. What looks like a nostro account for us will be the vostro account from other side. So what is nostro for us is basically the vostro account from the other side. So then loro account is basically an intermediate account which is used to remit foreign currency, to remit funds in foreign currency to another bank for credit to an account of the third bank. So it's an intermediate account which is going to be maintained. If ICICI Bank India maintains an account in USA, it is called as nostro account for us. And the same thing is called as a vostro account for USA, because they will say your account is maintained with us. We will say our account is maintained with you. Then we have something called as merchant rate and interbank rate. This is also used for problem solving. Your interbank rate is the rate which is quoted between two banks in the interbank market. This is the rate at which a transaction happened between ICICI Bank and Citibank. When ICICI Bank is dealing with the end customer like us, they will deal at the merchant rate. So what you do is you use the interbank rate on top of the interbank rate plus or minus exchange margin, you will add the exchange margin to the ask rate, subtract it from the bid rate and then get to the merchant rate. Merchant rate is the rate at which the transactions are likely to happen. Next, what are the techniques for exchange rate forecasting? What is exchange rate forecasting is? What is the likely exchange rate by end of the year? If I don't want all this headache, I can hedge my transaction, but still I would like to estimate what are the likely rates. For that, whatever you learnt as part of your stock analysis, when we are doing stock analysis, there's a technical analysis, there's a fundamental analysis. So you can do a technical forecasting as well as a fundamental forecasting. There's also another type of mixed forecasting which can also be done. Technical forecasting is basically you are looking at the past data, past movement of exchange rate, and it is basically said that the history is likely to repeat itself. Use of historical data to predict future values for predicting day-to-day movements. Fundamental forecasting is the next type of forecasting, is fundamental forecasting, which is based on certain economic variables, certain factors which are going to impact the exchange rates. It is based on the fundamental relationship between economic variables and exchange rates. Some of the factors which are likely to impact your exchange rates like interest rates, currency inflow. So all those factors you consider, you do maybe a correlation analysis or a regression analysis and then try to find out what is the likely exchange rate. Fundamental relationship between economic variables, and interest rate is one good factor which has a good relationship with the exchange rate. Subjective assessments based on regression model and sensitivity analysis. Also what you can do is a mixed forecasting or also a market based forecasting. What is market based forecasting is? It uses the market based indicators to develop forecasts. The current spot or forward rates. The current spot or forward rates are used to understand what is the likely expectation of the future exchange rate. Mixed forecasting is trying to do forecasting using multiple approaches. You try to get a forecast using maybe a technical forecast, one through a fundamental forecast, one through a market based forecast, and then try to take a weighted average to understand where the exchange rate is likely to end with. Then, who are the various participants in the foreign exchange market? See, in a forex market, there are multiple people who are going to participate. One, there are multinational companies who are going to buy and sell foreign currency. The reason for that is they could be importing or having export commitments. instead of, other than import export commitments, they can also have a foreign currency loan or a foreign currency investment. So they deal with in the foreign exchange market. They may do hedge using your forward market, money market hedge. All those transactions can be undertaken by them. Banks are an important party because they are the buyers and sellers. They are the buyers and sellers of the foreign exchange. So companies will come and buy and sell from the bank. Then there are two set of parties called as speculators and arbitrageurs. Speculators do not have any underlying transactions. So they are trying to earn money because of the movement, because of the fluctuations in the exchange rates. So because of the fluctuations in the exchange rates, they are trying to make some money. Arbitrager are basically the set of people who are likely to earn money without taking any risk. We learnt about multiple type of arbitrage, time arbitrage, space arbitrage. So these are the guys who are earning money without taking any risk. Apart from that, I think government can also be there. So the government participates in the foreign exchange market through the central bank. The Reserve Bank of India tries to control exchange rate because it becomes very critical for RBI to ensure that the exchange rates are stable. If there's a significant movement in the exchange rate, it can lead to huge volatility, and huge volatility can significantly impact either the exporter or the importer or the foreign currency inflow, or it can lead to huge foreign currency outflows as well. Next, what are the types of exposure in a foreign exchange market? Now there are multiple types of exposure in a foreign exchange market. One is a transaction exposure, then I think there is a translation exposure, then there is also an economic exposure. First is the transaction exposure. What is the transaction exposure is? It basically measures the effect of the exchange rate on the outstanding obligations, that existed before the exchange rates changed but were settled after the exchange rate. For example, we used to do a problem where profit or loss due to transaction exposure is equal to profit or loss as per the current exchange rate minus profit or loss as per the future exchange rate, because the settlement will happen later. You will compare these two and then understand what is the profit or loss due to the transaction exposure. Today you have booked the sale at 60 rupees per dollar, whereas the realization happened at 64 or 65. So that difference is called as transaction exposure. Then there is also translation exposure. Translation exposure is basically your accounting exposure. Because of your accounting standards, on the balance sheet date, you are required to convert all your foreign currency asset and the foreign currency liability into the local currency. When you do that translation, there is a possibility of profit or loss, changes in owner's equity due to the translation of foreign currency financial statements to the single reporting currency, which is basically Indian currency. Economic currency is basically impact on the value of the company, due to changes in the exchange rate. See, exchange rates going up or coming down can have significant impact on the value. If exchange rates go up, for example, if INR appreciates, exporters will be unhappy. If INR depreciates, importer will be unhappy. So exchange rates can have impact on the value of the company. Because of that impact on the value of the company, what you will end up seeing is there is a significant impact on the valuation of the company in the end. So how much is the fall in the value of the company due to the changes in exchange rate? The value of the company can also go up, but economic exposure, we are looking at the fall in the value of the company due to the changes in the exchange rate. What is a non-deliverable forward contract? Now listen, whatever problems we have done, a forward contract is normally settled by the delivery of the foreign currency. Either I buy the foreign currency from the bank, or I give the foreign currency to the bank and get the INR. Mostly it is settled by the delivery of the foreign currency. Whereas a non-deliverable forward contract goes through a net settlement. We saw physical settlement versus net settlement in the context of derivatives. So here it is going to be cash settled. A cash settled short-term forward contract on a thinly traded non-convertible foreign currency. The difference between the agreed upon the exchange rate and the spot rate at the date of settlement. So basically you are going to do a net settlement. And you are not going to do a delivery. NDFs are commonly quoted for a time period of 1 month and are normally quoted and settled in US dollar. Next, Distinguish between options and futures. I think we have seen more of this in the derivatives. The major difference is options you have a right but not an obligation. In futures you have both right as well as an obligation. Both right as well as an obligation. Only the seller is obliged to perform. The buyer is not obliged to perform. He only has a right. And for getting that right, he has to pay a premium. There's no concept of a premium here. There's no concept of a premium here. For the buyer, limited loss. For the seller, there is an unlimited loss. There's an unlimited loss. Here, both the parties have unlimited gain or loss. Next question which we are going to see is, what is currency swap? Now, a currency swap is basically entered by mostly a person who has a foreign currency loan. So, he will be having a series of outflow, or he could be also having a series of foreign currency inflow if he has made an investment. But I don't want to be exposed to this foreign currency risk. So, I can swap my foreign currency asset inflows or outflows to the local currency at an agreed rate. Involves an exchange of liabilities between currencies, a spot exchange of principal, spot exchange today. A similar effect can be obtained. Continuing exchange of interest payments during the term of the swap. Continuing exchange of interest payments during the term of the swap. Re-exchange of principal on maturity. Now, a currency swap is mostly undertaken for the purpose of hedging your currency risk. When we did interest rate swap and currency swap, we also understood that there is a possibility of saving some money. So, it can also provide cost savings. Because we understand that what is the ideal scenario and what is the actual scenario. If the actual scenario is away from the ideal scenario, we will tell them to follow the ideal scenario, do a swapping, and based on the swapping, it's going to bring in some saving. A strong borrower in the Japanese yen market may be interested in borrowing USD. Credit rating may not be as good. He could get a better US dollar by raising fund first in the Tokyo and then swapping it. Also, if you have a currency swap, it helps me in raising funds, diversification of borrowings. I will be able to borrow from multiple locations. The swap market permits funds to be accessed in currencies which may otherwise command a higher premium. It is very difficult for me to take a US currency loan, so take an Indian currency loan and swap it. Diversification of borrowing. Now, so we have broadly seen, one we saw in futures versus options. We also seen non-deliverable forward contract. We also seen currency swaps. What are the strategies for exposure management? We had seen this, I think, in one of the question. There were 4 strategies for exposure management. The low risk, low reward strategies, you hedge every exposure. Automatic hedging of all exposure. You are not trying to be selective here. You want protection from currency movement. So, you are covering all the transaction. When you cover all the transaction, what happens is you are not exposed to any currency risk. Then other scenario is, instead of doing all hedging, I may go for selective hedging. Low risk, reasonable reward. Which is going through a selective hedging strategy. Where you see based on the exchange rate, does it make sense or not. Some of the exposures you keep it open. Some of the exposures you don't keep it open. Some of the exposures are kept open. Low risk, reasonable reward, which is a selective hedging strategy. Then there is a high risk strategy. What you do in a high risk strategy, there are 2 types of high risk. One, you keep all exposures unhedged. You are not at all bothered about, which is a high risk, but a low reward kind of a strategy. High risk and a low reward kind of a strategy is to leave all exposures unhedged. And the last part is doing active trading. High risk and high reward strategy, you will keep buying, selling, doing a trading of foreign currency. Involves active trading in the currency market through continuous cancellation, rebooking of forward contract. So, 4 types of strategy. Either it's a low risk strategy or a high risk strategy. Low risk, all exposure hedged. Low risk, selective hedging. High risk, all exposure unhedged. High risk, active hedging. If you keep all exposure hedged, it's a low risk, low reward strategy. If you do a selective hedging, it's a low risk but a high reward or a reasonable reward strategy. High reward or a reasonable reward strategy. High risk and a low reward strategy is keeping everything open. High risk, high reward strategy is doing trading. Next, concept of purchasing power parity theory. Your purchasing power parity theory can be used to forecast exchange rate. You will use the inflation of home country, compare with the inflation of foreign country, and using this comparison you will be able to forecast the exchange rate. It is also similar to your interest rate parity theory. Under interest rate parity theory, you use interest rates to forecast exchange rate. Here you use inflation rates. Focus on inflation exchange rate relationship. There are two forms of triple P theory. One is law of one price. Absolute form is law of one price. Here what you say is you compare the price of a product in India, you also compare the price of a product in USA, and when you equate both, because law of one price basically says the price is going to be same across everywhere, which is not really true, because there are other expenses, there are transportation costs, there are duties. Prices of similar products should be equal when measured in common currency. If discrepancy is there, the demand will shift to, so that the prices should converge, which is not logical. Next is relative form. Relative form basically says that because of the market imperfections, prices of similar product will not necessarily be the same. And there is a way to forecast your exchange rate, which is 1 plus inflation of home country divided by 1 plus inflation of foreign country equal to F1 by E0. So this is the way to forecast your exchange rates. This is a very simple chapter, nothing much is there. In fact, most of the questions are what we have learnt as part of problem solving. Purchasing power parity theory you have done as part of problem solving. Maybe this also was done as part of problem solving, but you may have to remember the 4 theories. You know what is currency swap, what is options versus futures, what is non-deliverable forward contract. Maybe the types of exposure could be a slightly theory based area, various participants. So in this, what we saw is first is Nostro, Vostro and Loro account. Nostro account said our account with you, Vostro account said your account with us, and Loro account is basically, Loro means there, it's an intermediate account which is being maintained by the bank. Then we saw merchant rate and interbank rate. Interbank rate is the rate at which two banks deal with each other. Merchant rate is interbank rate plus or minus exchange margin. There are multiple techniques for exchange rate forecasting. We have a technical forecasting technique, then we have a fundamental forecasting technique. We also go by a market based forecasting technique, and then we have a mixed forecasting technique. Who are the various participants in the foreign exchange market? There are multiple participants in the foreign exchange market. One, the exporters and importers, which are the companies. Then banks deal with it. You have speculators, arbitrageurs and government. Types of exposure in foreign exchange market. There is a transaction exposure, which is basically the change in profit or loss due to your settlement will happen at a different rate as compared to the booking rate. Translation exposure, which is the accounting exposure, and economic exposure is the impact on the value of the company. Non-deliverable forward contract, which is a cash settled, no physical settlement. Options and futures. Option, there is a right but not an obligation. Futures, you have a right as well as an obligation. Currency swap is mostly for covering your foreign exchange borrowing or foreign exchange investment, where you will have a spot exchange of principal. There is a series of interest exchange which will happen, and then there is a re-exchange of principal on maturity. What are the strategies for exposure management? There are multiple strategies for exposure management. One is a low risk and a low reward, which is keeping all exposures hedged. Then a low risk and a reasonable reward strategy, which is a selective hedging strategy. Then there is a high risk and a low reward kind of a strategy, which is keeping all exposures unhedged. High risk and high reward, which is an actively trading strategy, which we have. Discuss the concept of purchasing power parity theory. Under purchasing power parity theory, what you do is basically you are using the inflation rates to forecast the exchange rate. There's an absolute form, which is law of one price, which says the price should be the same across everywhere in the world. Then there's a relative form which recognizes the imperfections and uses inflation to forecast the exchange rate. Okay, let's now shift to an area called as international financial management, which is basically combination of your foreign exchange exposure chapter, which we learnt in chapter 9, along with your capital budgeting, which you could have learnt as part of CA Inter. Along with capital budgeting, there could be few problems even on the financing side of it. When I say financing side of it, we have something called as GDRs or Euro convertible bonds. So that can also come into picture in this chapter. What are the complexities in multinational capital budgeting? See, along with the complexities which are there in a normal capital budgeting problem, in a multinational capital budgeting factor, you also need to take care of exchange risk. Has to take into consideration the different factors and variables which affect a foreign project and are mostly complex in nature as compared to the domestic project. Also, there can be difference between the project cash flows and the parent cash flows or the host country or the home country's cash flow. The project could be a viable one, but still I cannot do this project because of certain restriction like repatriation restriction or appreciation or depreciation of the foreign currency. Cash flows from foreign projects have to be converted into the currencies of the parent organization. So in order to do this conversion, I may have to forecast the exchange rate, which I can do it through purchasing power parity theory or interest rate parity theory, but that adds to the complexity of the analysis. Parent cash flows are different from the project cash flows, could be because of one, exchange rates, second could also be because of repatriation restrictions, and also taxation angle can come into picture. Profits are subject to tax in the home country as well as the host country. So multiple taxation can be there, because of which the project could be viable in USA, but when I convert the cash flows into Indian currency, it is not a viable project. Foreign exchange risk on the parent company's cash flow. Foreign exchange risk is conversion. When you convert your cash flows from a foreign currency to a local currency, there will be a variation in the cash flow. Inflation. Changes in rates of inflation causing a shift in the competitive environment and thereby impacting the cash flows over a specific time period. Simple. Inflation is going to impact indirectly your exchange rate. Inflation and interest rates are indirectly going to impact your exchange rates, which will indirectly have an impact on the project's cash flow. Restrictions imposed on cash flow distribution, which is your repatriation restriction. Repatriation restrictions can be brought in. If there are repatriation restrictions, so my project is doing well in USA, but I'm not able to transfer this money back to the Indian entity, transfer it back to the parent entity because of the restrictions which are there. Political risk. We did saw this as part of, I think, in your chapter 2 risk management. We saw that there can be some counterparty risk, and also we saw that there is a political risk which can be which can come in. So in a multinational capital budgeting problem, the issues which are there in the domestic market, along with that you need to worry about exchange rates, you need to worry about inflation, you need to worry about double taxation, you need to worry about repatriation restriction, you need to worry about the terminal flow. The terminal flow which is there, estimation is difficult because you may not be able to arrive at a fair value, because the buyers in the parent company can have divergent view on the acquisition of the project. So you may not be in a position to arrive at a fair value, and also the cash flows can change. The cash flows can change because of the concession or benefits which are provided by the host country. If there are some concession or benefits are there, so all this is going to impact the cash flows under evaluation, and that is why we used to have two approaches. There used to be a home currency approach and a host currency approach, and we used to alter the discount rate. Because the home currency discount rate could be different, the host currency discount rate is likely to be different, and we used to convert it through finding out what is the risk premium of the project, find out the risk free rate of the home country, risk free rate of the host country, and then get to know what the discount rate to be used. Explain the problems that are faced in international capital budgeting decision and how these can be overcome. So some of the problems I've already discussed it. The same problems we are going to discuss here also. The problems are the complexities which are there in an international capital budgeting problem was discussed some time back. Multinational company are subject to foreign exchange risk. You can protect yourself from the foreign exchange risk by identifying how much the appreciation or depreciation going to be there through purchasing power parity theory or interest rate parity theory, and make adjustment to the exchange rates when you do your estimation, in the sense that currency can appreciate or depreciate over a span of time. To include foreign exchange, it is necessary to forecast the inflation or the interest rate, and the cash flow can be converted using purchasing power parity theory. This is one issue. The second issue is the repatriation restriction. Due to restriction imposed on the transfer of profit, depreciation charges and technical differences exist between project cash flows and the cash flows obtained by the parent organization. The project could be a viable one, but the parent country cash flows could be different. Another issue which I have is on the taxation side. There could be two regimes of taxation. So when I do my evaluation, maybe I take the higher rate of taxation. There could be some double taxation avoidance agreement which will ensure that two taxes are not applied, but the home country could have a tax of 20%, the host country could have taxation of 15%. Take the higher rate of taxation for doing your evaluation. In multinational capital budgeting, the after tax cash flows need to be considered for project evaluation. The presence of two tax regime also, along with other factors such as remittances in the form of royalty, can make it complicated. For computation, higher of the home country or host country taxation can be used. Next, explain project cash flows and parent cash flows in the context of international capital budgeting. Project cash flows means, please ignore what the parent is doing. Please ignore, just analyze the project on a standalone basis in the currency in which you are planning to do the project. On the basis of own cash flow should compete favorably with the domestic firm and earn a return which is higher than the local competitors. So you evaluate the project on a standalone basis. Don't bring in this exchange risk, all of this. When you do it from a parent firm's angle, both the operating and the financial cash flows will have to be considered. What the parent is bringing in, what goes back to the parent, considering the foreign exchange risk, considering the repatriation restriction. So an investment has to be evaluated on the basis of net after operating tax cash flows generated by the project, which goes to the parent. Operating and finance are clubbed together. You need to ensure that it is viable from the parent point of view as well. The project has to be viable not only on a standalone basis, it has to be viable from the parent point of view as well. The next part is, what are the main objectives of international cash management? When you have international cash management, one thing which you need to take care is the currency risk is taken care of, because some cash flows could be in the form of INR, some could be dollars, some could be euros, some could be in pounds. So you will have to ensure that you are minimizing the currency exposure risk. To minimize transaction cost, to take care of the political risk, because certain economies could be politically exposed. For example, at this point of time, if you have any cash flows in Russia or Ukraine, it can have a significant impact because of the war-like situation which is there. And also minimize the overall cash requirements of the company as a whole. You will have to minimize the overall cash requirements of the company as a whole. Right? Short note on foreign currency convertible bond. What is FCCB is? Bond in a foreign currency, obviously, with an option to convert into equity. Bond plus equity with an option to convert itself into an equity at a future point of time. A type of convertible bond issued in a currency different than the issuer's domestic currency. That's why I said a foreign currency. Mix of a debt and equity instrument. It acts like a bond because you get regular coupon and principal payment, but also gives an option to convert this into stock. This is beneficial both for the company as well as to the investor. It's both for them, because investor will get a fixed income on the bond, and he will also be able to convert this into equity if there is a good appreciation in the price of the stock. If the stock is appreciating, maybe I'd like to convert. Because I give this extra benefit, from an issuer point of view, I can issue this at a lower rate of interest. The coupon payments are generally lower. So there are advantages both for the investor as well as the company. Gives the investor the flexibility to convert the bond into equity or redeem the bond. So I get this flexibility. From a company point of view, I will prefer, rather than directly issuing equity, I prefer this because this leads to delayed dilution of equity, and also the rate of interest is on the lower side. FCCBs are easy to market, are easy to issue, because from an investor point of view, what the investor thinks is he can get fixed income. Also, he will be able to enjoy the benefit of capital appreciation. The disadvantage is it is issued in a foreign currency, so there is an exchange risk. There is an exchange risk. So this exchange risk because would be payable in a foreign currency, and it also leads to creation of more debt. If it's converted into equity, it is fine, but if it's not converted into equity, then it has to be repaid. It has to be repaid. So there is a repayment of bond on which I have an exchange risk, interest which has to be regularly paid. There also an exchange risk, and this also adds up to my debt. So ability to repay can also be under question. American depository receipt. So I have seen this when we did a problem. There's a ADR. There's also GDR, American Depository Receipt. ADR is basically in USA and in US dollar. GDR is non-USA and can be in maybe Euro or in GBP. For example, ICICI Bank India can deposit some shares. On the deposit of the shares, or on the security of the shares, I can issue ADRs in USA. The same thing would be called as GDR if it's from other market. ADR will have absolutely almost the same thing. It will work in the same manner as of an equity share, but it's going to be traded in American market in line with the US. I think US has a SEC Securities Commission. So based on that, depository receipts issued by a company in the United States of America is known as ADR. Such receipts must be issued in accordance with SEC, US Securities and Exchange Commission, which is very stringent. What you do is you deposit securities, deposit of equity shares with a custodian bank. The custodian banks informs the depository so that ADRs can be issued. One ADR can have 3 shares, 5 shares, 10 shares, and it would be traded in the same manner as that of the other securities. He will also get dividend. Same rights and advantages as owners of the underlying securities in the home company. One variation of the ADR is GDR, which is identical. The only difference is it's allotted in more than one currency and it's outside the United States. So global depository receipt is basically a negotiable certificate denominated in a currency non-native, and most GDRs are normally in USD denominated. If it's USD denominated, it's called as ADR. If it's non-USD denominated, it is called as GDR. We also did a problem where we calculated cost of GDR, which is cost of equity, dividend plus price minus flotation cost plus the growth rate. Impact of GDRs on the Indian capital markets. So because you are issuing GDR, you are now exposed yourself to the movements which is happening in the foreign exchange market, in the US market or in the UK market. So you get yourself exposed to those markets. You are not insulated from what is happening in those markets. Indian stock market is shifting from Bombay to Luxembourg. Arbitrage possibility. What is arbitrage possibilities? If the same ICICI bank share is quoted at a different rate in USA and in India. In USA it will be quoted in a foreign exchange in US dollar. In India it will be quoted in INR. So in India if it's quoted at 200. In USA if one ADR is equal to 3 shares, it should ideally quoted equivalent to 600 rupees. If it's quoting at a higher price or at a lower price, it can lead to arbitrage possibility and is no longer independent. You will have to now keep track of what's happening in those markets. You cannot be saying that I am least bothered about what's happening in those markets, because those markets are likely to impact here. And also the retail investors are those set of people who are large in number, but they do not hold a significant proportion of holding, because their holding is on the lower side. So if you look at, there were earlier IPO issues which were made where these guys were able to make easy money on heavily discounted this in the IPO. Now because the companies also have ability to raise money from foreign exchange market through foreign institutional investor placement, so the Indian retail investors would not be in a position to earn such healthy returns just by doing an IPO, just by applying for IPO and getting the shares allotted in the IPO market. What are the characteristics of GDR issue? See, GDR is same like an equity share. So they will get equity dividend, they will enjoy in case any liquidation is happening, they will, whatever price is going to the equity shareholder, they will get. So they get the same economic benefits of an ordinary shareholder, just that there are no voting rights. There are no voting rights. These guys normally stay outside India, so there are no voting rights as far as a GDR holder is concerned. He is going to get fixed dividend income, which will be paid finally to him in US dollar. Also, a GDR can be cancelled. There is some cooling off period. After the cooling off period, it can be cancelled. There is going to be trading. It will be listed and trading will be happen. GDRs are listed on the Luxembourg Stock Exchange. Trading takes place. They are freely traded. Investors can earn dividend income which are paid in issuer currency converted into dollars. As far as the case of liquidation of GDR is concerned, an investor may get the GDR cancelled anytime after cooling off period of 45 days. So you can get this cancelled. Euro convertible bonds. FCCB or Euro convertible bonds is technically same. Euro convertible bond is basically a bond which is issued where you have an option to convert the bond into predetermined number of equity share. You have an option, you will get a fixed rate of interest and you can convert this into equity share. You can convert this into equity share if the person who has invested in the share, if the person who has invested in this security or in this Euro convertible bonds, if he wishes to, he can convert this into an equity share. So in this chapter, we first found out what are the complexities in multinational capital budgeting, understood the difference between the major complexities. One is exchange risk, repatriation restrictions are there, inflation risk is there. You are also exposed to some political risks which can come. How are you protecting yourself? How are you taking care of these risks which are there? One, for foreign exchange risk, you may use the interest rate parity theory and purchasing power parity theory and to find out the exchange rate. On the taxation side, what you can do is you can use the higher of the home currency taxation and the host currency taxation. Project cash flows and parent cash flows. Project cash flows are the base cash flows of a project. You are not bothered about the exchange risk. You are not bothered about the funding of the project. You are not bothered about the inflows and the outflows from the parent company. Parent cash flows is what inflow or outflow the parent company is going to get out of the project. Objectives of international cash management is I want to protect myself against the exchange risk. Currency risk needs to be minimized. Also, the cash requirements needs to be minimized and ensure that the parent, the subsidiary operations are happening smoothly. Minimize the transaction risk. Political risk also needs to be eliminated. FCCB is equal to bond plus an option of conversion. Beneficial for the investor because he gets a fixed interest as well as an option to convert into equity. Beneficial for the issuer because he is able to issue it at a lower rate of interest. ADR is basically an equity share. It's like an equity share which is issued in USD in line with the principles, in line with the rules and regulations of Security and Exchange Commission of USA. GDR is like an ADR, but it is issued in non-USA market, could be denominated in euro or pounds. Impact of GDRs. Now you are no longer insulated from what is happening in the foreign currency market, from the market which is your USA market or UK market. You are going to be impacted with what is happening there. And also the retail investors are now completely sidelined. These guys were earlier getting good amount of returns through IPO issues. So those attractive IPO issues or heavily discounted IPO issues may not happen. Characteristics of GDR issues is these GDRs have almost the same rights, or they enjoy the same economic benefits of an ordinary shareholder. They may not have voting rights. That's the only difference. The GDR can be cancelled after some cooling off period. They'll get dividend income. They are listed. There's a trading which is happening. There's a free trade which will be there. And Euro convertible bonds is basically again like a FCCB, a Euro convertible bond where you get a fixed interest income with an option to convert the bond into predetermined number of equity share. If the equity shares are at a premium, I'll do the conversion. Otherwise, I'm not going to do this conversion. With this, we end this chapter. Okay, let's move to the next chapter, which is on interest rate risk management. Now, this chapter is more critical from a bank's point of view because banks are earning their income predominantly through interest. Their major expenditure is also interest. So, they would want to have protection against changes in interest rate. So it is predominantly from bank's point of view, but we would also look at from a corporate point of view also because they may have some interest expenditure. Rarely there could be an interest income, but majorly there could be an interest expenditure. So the first thing we want to know is how are interest rates determined in a country? How are interest rates determined in a country? Major factor is supply and demand of money. That is, how is the gap between the supply and demand of money, which is predominantly dependent on growth. If you have high growth, demand for money will increase because there is more capital expenditure to be done, more working capital requirement is there. So demand for money will increase, which will increase the interest rates, The second factor is inflation. You could have learned this as part of economics, that RBI tries to control inflation through interest rates. So if inflation is going up, that is linked with the interest rate part. So if there is an increase in inflation, we'll see increase in interest rates, and there is a decrease in inflation, we'll see decrease in interest rates being there. The another factor is the government action. So that is government action, because government is one majorly a biggest borrower, and government through RBI can control the interest rates in a country, because RBI keeps changing repo rates, reverse repo rates, your SLR, bank rates, all this is under the control of RBI. So government through RBI can also control the interest rates or influence the interest rates. Now, what are the different types of interest rate risk? See, what is interest rate risk? Is variation in my cash flow due to changes in interest rate. From a corporate point of view, they may have some borrowing or investment. Major chunk of my discussion is going to happen from a bank's point of view. What does a bank earn? Bank earns something called as net interest income. Bank earns something called as net interest income, NII. Bank earns something called as net interest income, which is NII. Variation in net interest income, which is NII. Variation in NII due to changes in interest rate is what this area is going to be all about. And what is net interest income? Is interest income minus interest expenditure. Interest income minus interest expenditure. So how is the variation in this element? How is the variation in this? There are multiple risks. There is a basis risk, there is a price risk, there is an embedded option risk. So multiple types of risks are there. There are reinvestment risk. So multiple types of risks are there which can impact the non-interest income. The first thing is gap exposure. Gap exposure is what you have is in the asset side. In the asset side, I have debtors, I have fixed assets, I have investments, I can have current investments, I can have equity investments, I can have debt investments. On the liability side, you can have equity share capital, you can have reserves, you can have long-term loans, you can short-term loans. So what is gap exposure is, you have something called as interest rate sensitive assets, and you also have interest rate sensitive liability. If both are matching, the interest rate sensitive assets matches the interest rate sensitive liability, then I don't have a problem, because if interest rates go up, both asset and liability will get impacted. If interest rates come down, both asset and liability will get impacted. But a gap risk can come. A gap or a mismatch risk arises from holding assets and liabilities or off balance sheet item with different principal amount maturity, thereby creating exposure to unexpected changes in the level of market interest rate assets. More from a bank point of view, a positive gap gets created if you have more interest rate sensitive assets as compared to interest rate sensitive liability. Bank has a lot of interest rate sensitive assets. What is interest rate sensitive? The loans extended by them. Some investments which they have made, they are interest rate sensitive asset. If they are more than interest rate sensitive liability, then it is a positive gap. Negative gap is the vice versa. Bank have more interest rate sensitive liability as compared to an interest rate sensitive asset. Next is basis risk. Now basis risk can lead to expansion on my net interest income. Expansion, basis risk, I'll explain what is basis risk, but it can lead to expansion on my net interest income. Then it is a favorable basis shift. And if it causes my net interest income to come down or contract, then the basis is negative basis, or it's not, it has moved against the bank. Now what does this basis risk? See, you have certain assets, you have certain liability. I would have made an investment where I will earn 6% per annum. Okay, I'll earn 6%. I would have made another investment where I will get floating rate of interest. I would have extended a loan where I'm going to get a fixed rate of interest. I would have extended a loan where I'm going to get a floating rate of interest. I would have taken a loan where I have to pay fixed rate of interest, where I have to pay floating rate of interest. So certain assets can be benchmarked to fixed rate of interest. This is the example. It can be otherwise also. Some liabilities can be exposed to floating rate of interest if this is the scenario. In this case, if interest rate go up, then there's a problem for me, because on asset I'll receive the fixed rate, but on liability I'll have to pay the higher rate. I'll have to pay liability. So this will cause my NII to contract. If my assets are benchmarked to fixed, liabilities are benchmarked to floating, and interest rates go up. Interest rates come down, then my NII will expand. Sometimes your liabilities can be exposed to fixed rate risk and assets can be exposed to a floating rate of interest. So this is another risk which a bank, mostly from a bank point of view. Embedded option risk. What is embedded option risk? Is as a customer, I take a loan from bank. The loan could be in the form of a fixed loan, or that is a term loan. I can take a cash credit, I can take a bank overdraft, I can take multiple types of loan. But if interest rates start going up, then there is trouble for me. Because if interest rates go up, it will lead to unnecessary impact on my cash flow. Which may encourage me to make prepayment. Significant changes in interest rates can create another source of risk for a bank's profitability by encouraging prepayment. So if prepayments are done, bank interest income will come down. Sometimes there can be some penalties, but mostly government has said that penalties cannot be charged. RBI has its own rules. So prepayment penalties are not there in most of the loans, because of which what will happen is, if the customer prepays, I need to put this money, invest somewhere else now. So this can also cause my NII to change. And if interest rates go up significantly, this risk will be higher, because if interest rates are going up significantly, people will now think there is no point in keeping this loan. Let me start prepaying the loan. I don't want to keep this money with me. Yield curve risk is, see, I have taken both on floating. The asset is also on floating. The liability is also on floating. Great. Asset is on floating, liability is also on floating. So maybe you do not have a basis risk, you will think, because asset is on your floating rate, liability is also on a floating rate. You have also ensured that interest rate sensitive asset is equal to interest rate sensitive liability, so you don't have a gap exposure. Your embedded option risk is also very limited, because the interest rates have not changed significantly. But the problem is your floating rate. Some of the assets are on 1 month MIBOR. Some of the assets are on 3 month MIBOR. Some of the assets are on money market rate. Some of the assets are on call money rate. Some of the assets are on treasury bill. Some of the assets are on. The benchmark is different. So if there is movement in one benchmark, for example, if government yield goes up, automatically everything else will also go up. If there is change in one benchmark, everything else should change. But if there is any non-parallel movement, then again my NII will get impacted. If these are not moving in the same direction. If assets have a shift in NII, or if assets have an increase in interest rate, liability should also see an increase in interest rate. Assets have a decrease in interest rate, liability, because it's a floating rate, floating is on a benchmark. Price risk is, you have taken some security from your customer for a loan which you have given. Now what happens is, you need to sell this asset before the stated maturity. This one, you could have invested in the asset, or second, it could be a security which you could have taken from them. If you are selling this before the maturity, what happens is, on the maturity you can get the redemption price. But if you are selling before the maturity, we learnt in bond valuation that asset price and interest rate are inversely related. There is an inverse relationship between the asset price and the yield. So if yields are going up significantly in the market, I will have a significant fall in the asset price, and that is going to impact me. Reinvestment risk is basically the risk which I have on reinvesting the interest earned, because whatever money I earn, I need to reinvest them for future earnings. So if the future cash inflows which have come, I am not able to reinvest it at a good rate. That is called as a reinvestment risk. We learnt this as a concept of a duration, where we said duration is basically the time period for which you need to do an investment, so that you are able to balance the reinvestment risk and the price risk. Price risk is the variation in the bond price. Reinvestment risk is the extra income or the lesser income due to the changes in the interest rate. net interest position risk. What is net interest position risk? Is from a bank point of view, the NII which I earn is also dependent on one major element called a certain liabilities which a bank has on which it does not pay any interest. For example, current accounts. On current account, the bank is not going to pay. The size of non-paying liability, non-interest paying liability is one of the significant factor. When banks have more earning assets than paying liability, interest rate risk arises when the market rates. So in this scenario, what happens is if the interest rates shift downwards on the liability, I will not have any impact because a lot of things are non-interest paying. So when interest rates come down on my liability, my expense is not coming down significantly, but my income is going to come down significantly. So the variation in NII, non-interest income. What are the methods to hedge interest rate risk? Again, mostly from a bank's point of view. We have traditional method, we have modern method. I think under traditional method, we have asset and liability management, which is the first method which we are going to discuss. What is asset and liability management? Is from a bank point of view, it will have short-term assets, it will have long-term assets, it will have short-term liabilities, it will have long-term liabilities. So what the bank needs to do is it needs to ensure that it has adequate assets for taking care of the liabilities. A depositor comes to the bank asking he needs 5 lakh rupees. You should be in a position to pay your savings account depositor that 5 lakh rupees. So you need to have short-term assets to pay. But if you have short-term assets, you earn lesser interest. So what you need to do is you need to ensure that matching asset and liability are there, as well as ensure that you earn maximum NII. ALM is one of the important tool for risk management, comprehensive for measuring, monitoring and managing the market risk, structuring the balance sheet in such a way that net earnings is maximized, whereas you also ensure that liquidity is always there, liquidity is taken care of. Forward rate agreement, that is you are not sure what is going to happen to the future interest rate. So we had a tool called as forward rate agreement, which we in fact solved the question where even a customer can take an FRA. FRA is tool basically where there's a borrower and a lender who want to protect themselves against the unfavorable changes to the interest rate. So a bank can also do it. They can convert a floating rate into a fixed rate. Also, it is used by banks to fix interest rates on anticipated future deposits or interest revenues on variable rate indexed to a LIBOR. This is more of a notional amount and a net settlement will happen. These are your traditional methods. We also have modern methods, which are I think interest rate futures, interest rate options and interest rate swaps. Interest rate future is also a tool which is mostly net settled. In this tool, what you do is you are trying to fix a notional principle. You are fixing a future interest rate. There can be a trade which can also happen as far as an interest rate future is concerned. It's a contract between the buyer and seller agreeing to future delivery of an interest bearing asset. Allows the buyer and seller to lock in the interest rate. Interest rate options, you have a right but not an obligation. So you may want to protection if you want. So you can get an interest rate cap, interest rate floor, interest rate collar, or technically it's an interest rate guarantee. Interest rate swap is basically used to convert a floating rate loan into a fixed rate loan into a floating rate loan, depending on your expectation on the interest rates. In an interest rate swap, the parties to the agreement term the swap contract agree to exchange payments indexed to two different interest rates, mostly fixed versus floating. There are others also. This is where what are the different types of interest rates. So fixed versus floating is the normally used one. The fixed versus floating is the normally one. Plain vanilla swap are the generic swap, where fixed rate loan is exchanged with a floating rate loan. The floating can be on the basis of LIBOR, MIBOR, primary lending rate, MCLR. It can be on any of the basis. Basis rate swap is where one variable is exchanged with another variable. This is called as non-generic swap. For example, one loan could be on 1 month LIBOR, another loan could be on 3 month LIBOR. So you are exchanging 1 month LIBOR interest rate with a 3 month LIBOR interest rate. You can also do a swap. Where a fixed rate of interest can be swapped with the return which you get from maybe gold or maybe from Sensex or Nifty. I think this is called as an asset swap. Like plain vanilla swap, it exchanges fixed rate investments such as bond which pay a guaranteed coupon with floating such as an index. Indexes Nifty, Sensex, or you can also take the example of commodities, gold, precious metals, anything can be taken. Amortizing swap is Notional principal you agree on initially, and that principal will keep coming down because there will also be an principal payment which can happen. You can keep paying principal, so the notional principal will keep coming down, in which the notional principal declines during the life of the swap. What are swaptions, and explain its types? Swaptions are basically an option on an interest rate swap. An option on an interest rate swap. That is, you want to enter into an interest rate swap after 6 months. But in a swaption, what you will get is, you will get a right but not an obligation. Basically, for hedging and speculation purpose, you may want to do it. An interest rate swaption is simply an option on an interest rate swap. It gives the holder the right but not an obligation to enter into this at a specific date in the future for a particular rate under a specified term. There are two types of this. One is a fixed rate payer swaption, and there is a floating rate payer swaption, or technically fixed rate receiver swaption. In a fixed rate payer swaption, you get the right but not an obligation to pay the fixed rate and receive the floating. In a fixed rate receiver, you get the right but not an obligation to receive the fixed leg and pay the floating leg. Major reasons for doing this is speculation and hedging purpose. Swap traders can use them for speculation purpose or to hedge. Swaptions have become useful tools for hedging. A lot of banks may want to do it, or some active traders or corporate treasurers may also want to do this. Basically, you want to protect yourself from a future. You may take a loan, and after taking a loan, you may want to convert a floating loan into a fixed rate loan. You may decide not to convert also. That's your wish. If you are planning to convert, an interest rate swaption will help you, because this is an option on an interest rate swap. This is an option on an interest rate swap. Next is cheapest to deliver fund in the context of interest rate futures. See, whatever problem we have solved under interest rate futures, the problems we have solved, we have done through a net settlement route. But in case you want to deliver, you may not have the exact security in the spot market. So there are some conversion factors which are applied on, and based on those conversion factors, you can do a delivery of a bond. A cheapest to deliver bond is one which will maximize the return or the profit, and that bond is the lowest cost to deliver. Is the bond that minimizes the difference between the quoted spot price of a bond and the future settlement price. It's the least expensive bond in the basket of deliverable bonds. So your CTD bond is determined by the profit or loss for the bond person. If you are a seller of the future settlement price into conversion factor. This is your cost minus the quoted spot price. So whichever gives you the maximum, the quoted spot price will be the same. Future settlement into conversion factor will be different for different bonds. Is the difference between the cost of acquiring the bond for delivery and the price received by delivering the acquired bond. The difference is the profit or loss for the seller. Future settlement price into the conversion factor. I can decide which bond to deliver. Future settlement price into the conversion. I think there is a problem on this which we had done. Maybe I'll just show that problem also. So XYZ sold some 7.5% interest rate futures. This the exchange rate provides following things. These are the list of deliverable bonds. I can decide which of the bonds do I deliver. So I can decide to deliver either the 7.96 GOI 2023 or 6.55 GOI 2025, 2029, 2026, 2027, 2028. You can, because you took an interest rate future of 7%. You do not have an exactly 7%. You have 7.96, 6.55, 6.8. So your inflow is spot price into the conversion factor, which is this future settlement price into the conversion factor, subtracted by the quoted price of the bond. You subtract. In this case, I think this was giving the maximum profit. So this is the cheapest to deliver bond. With the one which will maximize the profit for the bond seller. From a bond seller point of view, he can decide which bond to deliver. Future settlement price into the conversion factor minus the quoted spot price of the deliverable bond. Default risk and reinvestment risk. Default risk, reinvestment risk I've already discussed. Reinvestment risk is basically you will keep getting a series of inflow, you need to reinvest them. When you reinvest them, the interest rates in the economy can come down. If interest rates in the economy come down, your reinvestment income will come down, and that leads to the reduction in the cash flow. You will try to protect this. The reinvestment risk is balanced with something called as a price risk. Whatever is the fall in the reinvestment income, that could be the rise in the asset value, and you try to balance that through a concept called as duration also. This risk is again akin which generates intermittent cash flow in the form of periodic payment. The YTM calculation assumes that it is reinvested at the rate of YTM. If you are not able to reinvest at that rate, then there is going to be a fall in the income for you. Default risk. What is default risk is you have bought a security and the other party is not paying it. The event in which companies or individuals will be unable to make the required payments. It could be interest payment or principal payment. It could be interest payment or principal payment. Almost this is there. Almost it is there in all forms of security. Even government security, which is considered to be risk free, but there are certain governments which can fail also. For example, Sri Lankan government at this point of time, they are going through a little bit of a tough phase. So it is possible that even money which is lent to the government, you may not get it back. You may not get it back. So you may try to take some security and all, but there are risks which are even there with the government. Technically it is considered to be closer to zero, but practically it's still possible that there are some risks there. The higher the risk, the higher the required return, and vice versa. So in this chapter we learnt about one, how interest rates are determined, which is based on supply and demand of money, or on the government intervention, or on the inflation factor. What are the different types of interest rate risk? Mostly what leads to variation in NII, net interest income of a bank. Gap exposure. Gap exposure is if you have more interest rate sensitive asset or less interest rate sensitive, if interest rate sensitive asset is not matching with interest rate sensitive liability. Basis risk is basically something which leads to expansion in NII or contraction of NII, because some of the assets could be benchmarked to a fixed rate, some of the liability could be benchmarked to a floating rate, or vice versa, and because of the variation in interest rate, your NII expands. Positive shift. NII contracts, it's a negative shift or an unfavorable shift. Embedded option is any prepayments made by the customer. Yield curve risk is you are having different benchmarks for different assets and liabilities, and there is non-parallel movement. Price risk is you need to sell your asset before the maturity. When you do this before the maturity, you may get a lower income if there is a significant movement in the interest rate. Reinvestment risk is not able to reinvest the interest income which are coming down. Net interest position risk is some of the liabilities you don't pay any interest. So if interest rates come down, your interest expense will not come down, but interest income can come down significantly. Methods to hedge your interest rate. Traditional method, which is your ALM method and your forward rate agreements. Your modern methods where you have interest rate options, interest rate futures, and interest rate swaps. Then we learnt about different types of swaps, which is a plain vanilla swap or a generic swap. Basis rate swap, where one floating is compared with another floating. Asset swap, where a fixed rate could be compared with or could be exchanged with the return on an index like Sensex, Nifty, or gold or silver. Amortizing swap, where the principal value will keep coming down. Swaptions, different types of swaptions. A swaption is basically an option on an interest rate swap. So this gives you a right but not an obligation to enter into an interest rate swap. There can be a fixed rate payer swaption or a floating rate payer swaption. In a fixed rate payer swaption, you have the right but not the obligation. In a right but not an obligation to receive fixed rate, to pay fixed rate, and here to receive fixed rate. Cheapest to deliver bond is one which will lead to maximum profit for the seller of the bond. So what you need to do is, normally we do a net settlement, but in case you need to deliver, there are host of securities which can be available in the market which can be delivered. So the profit or loss for the seller of the futures is futures settlement price into an conversion factor minus the quoted spot price. This difference should be maximum. That is called as the cheapest to deliver bond. Default risk is basically the party is not paying. You are the customer, you have lent a loan to someone and that counterparty is not making the payment. That's called as a default risk. Reinvestment risk is not able to reinvest the interim income at the required rate. You would have decided some rate for reinvestment purpose. You are not able to reinvest at that rate. That will lead to contraction in your return, or your final realized YTM could be lower than the initial YTM which you have decided on. With this, we end this chapter. Hi friends, let's now shift to chapter 12, which is on corporate valuation. as far as this chapter is concerned, you will not see much of theory question. It's a very simple discussion which is there, and even the questions which are there in this chapter, they are predominantly what you would have done as part of problem solving. First step is, what are the steps in valuation of unlisted company? Now, when it's a listed company, we do have market information, we do have lot of comparisons which can be made. For unlisted company, the first major difficulty is finding out what is the beta. Because beta will give you the cost of equity, which will finally help you in calculating the weighted average cost of capital. Using the weighted average cost of capital and the cash flows, you can calculate the company value. You can also use the cost of equity under different models also to calculate the value of the company. So first what you do is you take the industry beta. For example, if you are analyzing an IT company, what you will do, you can take the industry beta, which comprises of TCS, Infosys, Wipro, Cognizant. So many companies are there. So take the beta of similar listed companies. In that, remove the effect of leverage. You would have learned this, removing the effect of leverage, in the chapter on portfolio management. So unlevered beta is equal to whatever is your levered beta, you adjust with this. You need not even remember the formula. We had a format. Using that format, we'll be able to remove this leverage part. This unlevered beta can be used to calculate the cost of equity, RF plus beta into RM minus RF. You can use this unlevered beta and calculate the cost of equity. Now, after calculating the beta, I also need to ensure that the financial statements are having right numbers. So we may have to do some due diligence of the number. We may have to make certain adjustments. In a practical world, there are companies which will do due diligence. The investment bankers will do due diligence and get to know what are the right numbers for the company. You need to be accurately aware that unlike listed companies, the financial statements of privately held companies can have some gaps in accounting policies and accounting estimates. Find out the cost of equity. This is, you get the cost of equity using the beta which you have calculated here. After that, you decide what is the debt equity mix you want to do, and then calculate the WACC, because the industry beta will have a different debt equity mix. You can have a different debt equity mix. So what you need to do is, you need to consider what is the debt equity mix at which you want to operate, and then get the WACC. Apart from that, the promoters can demand a return towards goodwill. The promoters, because this is held by them, or sometimes the promoters may continue to run the company. When I say run the company, they can be given some managerial role also, but you need to give some extra consideration to the promoters. Then get the cash flows, discount them. Some of the cash flows will give you the value of the firm. This is based on the cash flow based approach. You can also do it in other approaches. The important part is getting to know what is the cost of equity or what is the discount rate. Relative valuation method. What is relative valuation method is, you can compare your company's valuation with others in the industry. You can do P multiple approach. This is also relative valuation. EV by EBITDA approach. Capitalization per employee. Capitalization by sales. Capitalization by assets. So multiple approaches can be used, where you will use your own multiple and compare with others in the industry to get to know whether you are calculating the right value for your company. Relative valuation is a method to arrive at a relative value using a comparative analysis to its peers or similar enterprises. Increasingly, this has been used by the financial analyst to validate, because you may arrive at an intrinsic value using the question number 1, you understood approach. You may arrive at the intrinsic value using Gordon value approach, or using Walters value approach, Walters model, Gordon's model. So different models can be used, and then after you arrive at the different models value, you can use the relative valuation method to see whether the value which you arrived is right or not. It should be broadly in some range. Also referred to as valuation, use financial ratios to arrive at the desired metric and then compare the same to that of comparable firms. Comparable firms will have similar asset and risk disposition, can have similar. So what you need to do is you need to decide what multiple you want to use. You can use sales by capitalization by sales, capitalization by earnings, you can use capitalization by assets. So arrive at what drivers you want to use. Find out the drivers that will be the best representative for deriving at the multiple. Determine the results through the financial ratios, get the average for the industry, find out the comparable firms and perform comparative analysis, and then see whether the approach, whether the value which you have arrived for our company is in line with others in the industry, or arrive at the value of our company in line with what the multiples others have in the industry. Find out, explain how cash flow based approach is different from income based approach, and also explain the steps involved in this approach. I think whatever we have done in question number 1, in cash flow based approach we arrive at the free cash flow to the firm, the future cash flows, FCFF, which is discounted at WACC, and then you arrive at the value of the firm. You don't go by income based approach, because under income based approach you do not consider items like working capital blockage, certain adjustments, because your income can be easily influenced by changes in accounting policies. Whether you follow an SLM method or a WDV method, the income based approach can have an impact, whereas your cash flow based approach is superior, that doesn't get impacted by the accounting policies adjustment. Asset based or income based approach, cash flow takes into account the quantum of free cash flow that is available for future periods. So arrive at the free cash flows, forecast of the future cash flows, discount them, arrive at a terminal value, club them together, and that's called as the value of the firm. Differentiate between economic value added and market value added. EVA is basically the excess return. EVA is the excess return which a firm generates. So EVA was EBIT into 1 minus tax rate. This is the return which the firm generates, and the cost of capital employed is your WACC into capital employed, WACC into capital employed. So we are trying to find how much excess return the firm is generating, the excess return the firm is generating on its economic capital, So EVA is the excess return generated by. Market value added is the market value of the firm minus the book value of the firm. This basically reflects the final effect of the EVA, because EVA is the excess return you generate. This reflects the effect of the excess returns which are generated on the value of the firm. EVA is a holistic method of evaluating financial performance, is that company generates value only after creation of wealth in terms of in excess. So EVA is EBIT into 1 minus tax rate minus WACC into capital employed. MVA is current value of the firm minus the invested capital. Hence MVA is a true value added that is perceived by the market. This is what is perceived by the market, whereas value is only, EVA is only for, in short I used to tell this, MVA is basically the discounted value of all future EVAs. Because whatever future EVAs you are going to generate and the current EVA you generate, that is going to finally reflected in the market value added of the company. It's a very simple chapter, nothing much is there. We first understood what are the steps in valuation of an unlisted company. You go through the industry beta. After the industry beta, you arrive at your beta. Then you do cost of equity, you do cost of capital, arrive at the cash flows, discount them, add some extra premium for return on goodwill and all. Relative valuation method is you arrive at the value of your company based on certain multiples of the industry or the comparable firms. The multiples which you can use is capitalization by sales, capitalization by assets, capitalization by profit. Then we understood how cash flow based approach is different from income based approach. In cash flow based approach, you arrive at the free cash flows, even your future cash flows, discount them at the cost of capital, arrive at a terminal value, and then club them together. EVA is the excess return generated every year. EVA is equal to EBIT into 1 minus tax rate minus cost of capital into the capital employed. Market value added is basically the excess value of the firm as compared to its book value. So market value added is market value of firm minus book value of firm. With this we'll end this chapter. Okay, let's now start with the area on mergers and acquisitions and corporate restructuring. Now coming to this area, see, in the practical world there is a lot of M&A activity which keeps happening. Many companies will acquire smaller companies, or there would be a merger which will happen where two bigger companies would join together, or two similarly placed companies would join together to become a bigger corporate. Example, your Idea and Vodafone got merged. multiple banks under the State Bank nomenclature got merged. For example, your State Bank of India got merged with State Bank of Travancore, and multiple banks got merged in that manner. So merger and acquisition or corporate restructuring is something which is frequently happening. The first question is, what is the reason for mergers and acquisition? The major reason is valuation gain. The combined value, the merged value, the value of the merged entity is likely to be better than the sum of its parts. For example, the merged entity could have a value of 1000 crore. The individual could have 400 plus maybe 400. So it's only 800. The merged entity has a better value. There could be multiple reasons for this. The major reason is your economies of scale benefits. The economies of scale benefits which comes when a merger exercise happens. So the value of the merged entity, the combined firm, is going to be better than the sum of its parts. The other reason for that also is diversification, or the taxation, or the growth aspects, or the consolidation. This consolidation is basically your operating synergies, consolidation of production capacities, or increasing your market power. What is diversification? Two unrelated companies would merge themselves together. When a diversification happens, it leads to reduction in risk. Reduction in risk will lead to reduction in discount rate. When there is a reduction in discount rate, automatically the value of the firm goes up, because you are going to now discount it at a lower rate. So when there is a reduction in discount rate, there is an automatic increase in the value of the firm. From a taxation angle also, a merger can happen. What happens from a taxation angle is that two entities, one could be a loss making entity which has past losses which it wants to set off. Another is a profitable company, so they'll merge together so that this past losses can be set off. This is also one of the major reason for mergers happening. Growth, if I try to grow organically, that is without any merger and acquisition, the growth could be lesser. So if I acquire a competitor, or if I acquire either my supplier or customer, it will enable me to grow at a healthier rate. It will enable me to shorten the time to market. Consolidation of production capacity and increasing the market power. Consolidation of production capacity, let me not use the word production capacity, but the Idea and Vodafone merger was done to that. They wanted to increase the market share. So you can increase your market share, and that provides you better pricing power. You'll be able to negotiate it better with your customers as well as with the suppliers. What are the various forms of merger? So now there are 4-5 types of merger. Let's talk about the horizontal merger. Just give me a minute. Okay, the first one is horizontal merger. In a horizontal merger, two competitors will merge together. Example was the Idea one. Two competitors will merge together. The benefit of a horizontal merger is you will have better pricing power now. Normally the market share of the new consolidated company would be larger, and it may move closer to being a monopoly or a near monopoly. It can become closer to being a monopoly or a near monopoly. Vertical merger is where you merge yourself with your customer or supplier. For example, Maruti Suzuki sells its products through multiple auto dealers. If Maruti Suzuki acquires any auto dealer, then it will become a vertical merger when there is a buyer-seller relationship or a potential buyer-seller relationship. Conglomerate merger is, there could be a group which can have multiple businesses, there could be another group which can have multiple businesses, or there could be a single company with one business, another company with another business. There is no linkage at all. There is zero linkage between them. There is no linkage. They are not linked either through your horizontal way or through your vertical way. There is no linkage at all, and still a merger happens. Then that's called as a conglomerate merger. Congeneric merger is, these guys are not competitors, they are not buyers and sellers, but they could be part of the same industry. And selling similar products, but they are not competing with each other. There could be relationship like basic same technology or same production process or same markets. For example, a mobile phone is being sold. Along with the mobile phone, let's assume there's another company which is selling a smartwatch. There's a mobile phone and a smartwatch being sold. They are not competing with each other, but they are into the similar product. So if you acquire the smartwatch company, you are able to expand your product line. You're able to expand your product line. So you can extend your product line, or you can even extend your market reach. That is what is called as a congeneric merger. In a reverse merger, a weaker entity will acquire a stronger entity. A weaker entity will acquire a stronger entity. The reason for that is this weaker entity could be a listed company. The weaker entity could be a listed company. The stronger company could be a privately owned company. This privately owned company wanted to go for listing, but the process is very lengthy, so they don't want to follow this lengthy and complex process. So what they'll do is they'll tell acquisition of a public shell company by a private company, as it helps the private company to go public. So weaker entity, which is a shell company, it's a listed company, will acquire. Reverse is it's a stronger company weaker company acquiring a stronger company. Technically, after the acquisition, the ownership will go to this the company which is getting acquired. There will be a change in management control and they will manage this. Acquisition is basically purchasing of a controlling interest. Acquisition is basically a purchasing of controlling interest in one company. So you acquire the controlling interest and then try to control this company or manage this company. Merger is where two companies come together. What are the various takeover strategies? So now you want to acquire another company. So in this part, we are going to learn about various takeover strategies. Later on, we are going to learn how can you defend yourself from a takeover. One of the way of doing a takeover is you will silently keep buying the shares of the other company. Till it reaches that open offer limit. There are some limitation on the open offer as per your regulations whenever it reaches the open offer limit. So you will keep acquiring street sweep, where you keep accumulate large number of shares in a target before making an open offer. So you have acquired good number of shares. Now what will happen is the target company, because this company has acquired good number of share, they'll also be making an attractive open offer. So mostly this company will agree to the proposal of the acquirer. For the takeover. Bear hug. What is bear hug? Is that acquiring company is now planning to threaten the target company, saying that I want to acquire you. So what it can happen is these two parties can enter into a stage where the acquiring company, the company which is acquiring, will provide a good lucrative offer, agrees to a settlement. So take on a good lucrative offer and ensure that this acquisition passes through. Strategic alliance, the word itself will explain what is a strategic alliance is. In a strategic alliance, rather than you acquiring the other company, you are trying to become a merged entity where both the parties will have control over the merged entity. Both the parties will try to have a control over the merged entity. You are basically forming a partnership rather than a buyout. I think example can be your Idea and Vodafone merger. Brand power is basically you are trying to have an alliance with powerful brands so that this your branding power. For example, Facebook acquired WhatsApp. WhatsApp was a strong brand. Facebook acquired this brand, and this has led to you becoming a bigger brand now. And the WhatsApp was in some other company. Post acquisition, that entity has now technically become a weakened company. Refers to an entering into an alliance with powerful brand to displace the target brand, and as a result buy out the weakened company. Now one company is planning to acquire the other company. Now you want to protect yourself from this takeover. Now what are the strategies available to protect yourself from this takeover? There's something called as poison pill, poison put, divestiture, demerger, division. So multiple strategies are there. What is divestiture is, in this you are going to divest one of the division of the company. This strategy, extension of the strategy, is called as a crown jewel strategy. In a divestiture strategy, what you are going to do is you are going to divest or spin off one of the business. When you divest or spin off one of the business, what can happen is, earlier this was a very attractive company. Now you have already spun off one division, so it will become now unattractive. Some of its business in the form of thus reducing the attractiveness, and what you will try to divest is basically a crown jewel. Crown jewel is basically you are going to divest mostly the most attractive businesses. The businesses which are doing really well, you want to divest them. You want to divest them. So when a target company uses the tactic of diversion, it is said to sell the crown jewel. Crown jewel. Mostly the attractive businesses would be sold off. You will sell off the attractive businesses. Okay, so the first two strategies are your diversion or crown jewel. See, basic thing what we are trying to do in removing ourselves from a hostile takeover is we are trying to make our business look unattractive. We are making our business look unattractive. There is something called as a Pac-Man defense also, where what you try to do is you try to fight it and make an offer for the other company. For example, A is trying to acquire B. B puts up a defense and tries to acquire A. So in this process, what will happen is A will move out of this acquisition process and leave this deal. So that's called as your Pac-Man defense. The strategy aims at the target company making a counter bid for the acquirer company. Counter bid for the acquirer company. This would force the acquirer to defend itself and consequently call off its proposal for takeover. Golden parachutes. What is golden parachutes is, I have some top management or the strategic management of my company. I have told them, or I have entered into an agreement with them, that if our company is getting acquired, you will get so much of compensation, or there would be so much of cash, hefty compensation would be paid. Now what will happen if this company gets acquired? There would be a huge outflow of cash. There would be a huge outflow of cash. When a company offers hefty compensation to its managers if they get ousted due to takeover, the company is offering golden parachute. The problem with this is, if company A is acquiring company B will have to pay this huge compensation to its manager, which will lead to huge outflow of cash. This huge outflow of cash will make the other company unattractive. White knight and white square. These are two strategies where what I am trying to do is, see, company A is trying to acquire company B. It's a hostile takeover. Company B goes to company C, who is a friendly person, and tells them, please acquire me. You please acquire me. I don't want to be acquired by company A. In this, target company offers to be acquired by a friendly company to escape from a hostile takeover. White square is same as white knight, but in a white square, you go to a person, tell them, please acquire me. This guy is not interested in running the business and all. The company which acquires is not interested in running the business. So you tell them that please acquire me, and the same management continues to control the company. Essentially the same as white knight, involves sale out of shares to a company that is not interested. As a consequence, the management retains its control over the company. The management is retaining the control over the company. Poison pill and poison put, these are both the strategies to make ourselves unattractive. For example, company A is planning to acquire company B. What company B does is, it issues huge debt or huge convertible debt. Poison put and poison pill both are similar. It issues huge convertible debt. Because of huge convertible debt, what will happen is, this convertible debt will become equity, because of which the shareholding of the merged entity, or once the acquisition happens, the shareholding can even get allotted to these guys. So sometimes an acquiring company becomes a target when it's bidding. The tactics used by the acquiring company to make itself unattractive. Example, in case the target company issues bonds that encourage holders to cash in it at higher prices, resultant cash drainage would make the company unattractive. The last part is green mail. Green mail is, I am offering an incentive. Green mail refers to an incentive offered by the management of the target company to the potential bidder. So I am offering some incentive, telling them not to acquire myself. An example, the acquiring company, let me explain all of this in a simple example better. Let me take the example, company A is planning to acquire company B. Company A is planning to acquire company B. In a green mail, what will happen is company B is saying, I will give you something. I'll give you something. Please don't acquire me. Maybe you give them a business order, or maybe you enter into a strategic relationship. You do, or another way is company B is acquiring the shares of company A. Company B is acquiring the shares of a company at a premium pricing. Some benefit you want to pass on. Some benefit you want to pass on. That's called as a green mail. Basic strategies. I want to make myself unattractive. I want to make myself unattractive. So one of the ways doing divesting. You may try to divest your crown jewel, or you may do a golden parachute, which will lead to a huge outflow of cash, or a poison pill or a poison put, where you are trying to issue huge debt. Because of the huge debt, there could be a huge outflow of cash later on. So again, you don't want to acquire, because you are now seeing this company as unattractive. White knight and white square are basically two strategies where you are going to a friendly company and telling yourself to be acquired by a friendly company. If you get yourself acquired by a company which is not interested in the management, then it's a white square. Green mail is you are providing some incentive. Pac-Man defenses, you are now fighting and saying that I'll acquire you. You don't try to acquire me. I am going to acquire you. Reverse merger, we did talk about this. Maybe I'll explain now with an example. Company A, listed, loss making. Company B, private, profitable. Company A will acquire company B. Company A will acquire company B. Normally a stronger, this is a weaker company. This is a stronger company. Normally a stronger company will acquire a weaker company. Here company A will acquire company B. After acquisition, there will be a change in management. Who will manage the business? It will be managed by company B's management only, because they are the stronger company. They would obviously be having more holding and all. So there will be a change in management also, and indirectly company B has done a public listing of itself. Company B has done a public listing of itself. In a reverse takeover, a smaller company gains control of a larger one, is also known as backdoor listing. Backdoor listing is this a usual case where normally a sick company is acquired by a stronger company. Now some of the test for your reverse merger, the assets of the transferor company are greater than the transferee company. The company which is getting acquired, that has more assets. Equity capital issued is also more than the original issued capital, and there is a change in control. There is a change in control. What is divestiture and the various reasons for the same? What is divestiture is selling of one of the division or undertaking. Selling of one of the division or undertaking. There are multiple forms of divestiture. There is something called as a spin-off which can be done, or there is a demerger which can be done. So there are multiple ways in which a divestiture would be done. Why should I do a divestiture? See, I am a bigger company. I am not able to manage one of the division. It's not core to my operations. So I want to divest it. One of the division of the company has become a very big division. And this can be a standalone business now. You may also do a divestiture for the purpose of, I think, if there is some dispute within the family, you may want to do a divestiture because of that. To pay attention on core areas. It has become a too bigger a company, so you don't want to handle this, so you want to divest it. You may be in need of some money, so you may want to sell a business, and division or business which are not sufficiently contributing. So this and this is more or less interlinked. You want to focus on the core areas and sell off the businesses which are not sufficiently contributing, or it has become a bigger division. Finally, a divestiture can lead to something called as wealth enhancement. It can lead to value creation for the shareholders of the company. Wealth creation or value creation can happen. What are the various forms of divestiture or demerger? Sell-off or partial sell-off. Sell-off means you are selling off either an asset or a factory or a division or a product or a subsidiary to another company, in which you will get a cash consideration or a equity consideration. There can be a consideration or consideration other than cash. Partial sell-off is where you sell only one business, you do not sell all the businesses, or you are trying to sell a business which is unfit with your company's core business strategy. In a sell-off, you will get inflow of money. In a spin-off, in a sell-off, there will be inflow of money either in the form of cash or consideration other than cash. In a spin-off, what will happen is you will not get any cash. Company A will divest a business and call it as company B and allot the shares of this to the original shareholder. This is technically called as like a demerger. Part of the business is separated and created as a separate firm. Existing shareholders will get proportionate ownership. Management is however parted off. It does not bring any fresh cash. In a split up, what you will do is company A will become 4 separate companies. Company B, company C, company D, company E, and company A will be closed. Company A. This involves breaking of the entire firm into series of spin-off. The parent firm no longer really exists. A corporate firm has 4 divisions, so you all make all this 4 divisions. There's also something called as equity carve-outs. Equity carve-outs is you will spin off a business. After spinning off a business, you may issue fresh shares in that business, or you may sell some shares to someone else. Because you may be holding this business partly, so you may sell some shares and get some inflow of money. This is like a spin-off. However, some shares of the new company are sold in the market by making a public offer. So you bring in some cash. Sale of a division is basically like your sell-off. It's basically selling your business. Demerger or division of family managed business, because increasingly what is happening in the practical world is people want professional management. Under extraordinary pressure to yield control to professional management. So what you may want to do is you want to split your businesses into multiple businesses. Some of the unprofitable business you give it to some professional management, they kind of take care. And for your succession scenario, you want to give some businesses to your son. So some of the unprofitable business you may hive off also, or you may divest. The profitable business you may give one business to son 1, son 2, son 3, or daughter 1, daughter 2, daughter 3, and then tell them to manage, and you may also bring in a professional management there. What are the various ways of doing ownership restructuring? What is ownership restructuring? Is changing technically the shareholding pattern. You can do ownership restructuring through buyback also. Buyback is also one of the way of doing a ownership restructuring. One is going private. Going private is delisting. You are unlisting yourself. After delisting, what will happen is your shareholding will be entirely held by the family and the close associates of the family, or some strategic partners can be there in the business. This refers to a situation where a listed company is converted by buying back all the outstanding shares from the market. The other way is doing a equity buyback. In an equity buyback, the company buys its own share. There will be reduction in the equity capital, and this can lead to increase in the promoter holding. There's also something called as management buyout and leveraged buyout. Management buyout and leveraged buyout, which is also the next question I'll be discussing there. Under a management buyout means acquiring a company. Under a management buyout, the company is bought by its own management team. They are going to buy, they were anyway owning this, they were anyway managing this business, so they are going to give a part of the businesses, to the management team and tell them, you please manage this business. You buy this business and manage. You give us some cash for that. So you may try to hive off those business which are not core to the business of the entity. Leveraged buyout means one company is acquiring another company where the purchase consideration, more than 50% of the purchase consideration, you acquire a division or another company where more than 50% is being taken in the form of debt. You use borrowed money. To buy the other business. Under a management buyout, you want the same management to continue. Initiated by the management team are known as management buyout. These are useful for exiting those businesses which do not form core operations of the company. Under a leveraged buyout, you use debt. See, the purpose of doing a leveraged buyout is you want to improve the efficiency of the company which is getting acquired. After improving the efficiency, you will improve the cash flow. The improved cash flow can be used to repay the debt. Is to improve the operational efficiency and increase the volume of sales, increasing the cash flow. This cash flow can be used to repay the debt. Repay the debt. I think one of the example which is mentioned in your material is Tata Steel acquiring Chorus. Tata Steel acquiring Chorus. Example of LBO. In India, the first LBO took place when Tata Tea acquired Tetley in the United Kingdom. It was a consideration of some 2135 crores, in which 77% was financed through debt. But why did Tatas do it? They wanted to have access to the international market. Similarly, Tata Steel acquisition of Chorus, the debt ended up increasing 7.6 billion. The debt ended up increasing, but once the operations improve, you can use that to repay the debt. If the operational efficiency of that acquired company increases, then you will be able to earn better returns, better cash flows, and using this you can repay the debt. So you are also not bothered about arranging a huge consideration at this point of time. So what you do is you try to acquire the company through debt funding. That's called as leverage buyout. Management buyout means the management team buys out the shares. Buyouts initiated by the management team. The company is bought out by its own management team. The board of directors or the main management, the CFO, CEO, wants to acquire this company. Various steps in an M&A program. See, various steps remain similar. First, you find out a candidate, screen the candidate, do a due diligence, structure the deal, also do the post-deal arrangements properly. Manage the pre-acquisition phase, screen candidates, eliminate those who do not, negotiate, and do a post-merger integration. Why do some of the M&A fail? If you overpay, if you end up overpaying, you overestimated the synergy gains, and because of which you ended up overpaying. Or post-merger integration does not happen properly. Acquirer generally overpay. The value of synergy is overestimated. Poor post-merger integration. The integration did not happen. Psychological barriers. One company, if a private limited company and a public limited, if you acquire, for example, Air India acquisition which has happened, this can lead to some psychological barriers because the Air India employees, they have a different way of working, and the private carriers have a different way of working. So there can be some psychological barriers because of which the employees are not working properly. What are cross-border M&A? Cross-border M&A is one entity from India is acquiring another business. Tata's acquiring Chorus, or I think this Tata Tea acquisition of Tetley. Even I think Tata's did one more acquisition where your Jaguar and Land Rover acquisition. All these are cross-border M&A activity. They are cross-border M&A activity for global growth and overseas expansion. Global growth and overseas expansion are based out of different countries. Reasons will remain same. You want to reach out to a different market. Globalization of production and distribution of production, integration of global economies, expansion of trade. Also, there could be some tax benefits which can be there. Many countries are reforming their economic, are providing generous investment and tax incentives. Are privatization and consolidation. Privatization of state-owned enterprises, that is companies which are owned by the government, you want to privatize them, because of which you may tell an entity to be acquired by, for example, if at all Air India was acquired by a foreign entity, then it would have become privatization of state-owned enterprises. Or you want to strengthen your banking industry, consolidation of your banking industry. So under M&A, we first understood why did a M&A activity happen. Main benefit is economies of scale benefits, valuation gain, diversification benefit, lower discount rate, taxation benefit, growth can be better, or you want to consolidation. Various types of merger: horizontal merger, two competitors merging themselves together; vertical merger, where buyer and seller are merging them together; conglomerate merger, where there is no linkage; congeneric merger, there could be linkage in form of technology, production process, or market; reverse merger, where a weaker entity is acquiring a stronger entity. The purpose is to list yourself. And acquisition, in an acquisition what happens is you are acquiring a part of the business so that you get a management control. Various takeover strategies. Takeover is you want to acquire the other company. Street sweep, where you keep acquiring the company. Barrig, where the acquiring company and the target company join together and say that let's do this. Strategic alliance, where they join together and manage the business together. Brand power. Brand power is you are trying to acquire the stronger brand so that that entity becomes weaker. How can you protect yourself? You can divest your crown jewel. You can make yourself unattractive by doing a poison pill or a poison put. Green mail is you're trying to give some consideration or going to give some incentive to the target company. White knight is you are getting yourself acquired by a friendly company. White square by a company which is not interested in the merger exercise. Pac-Man defense, you fight it and now you put an acquisition on that entity. You try to acquire that other entity so that the deal is called off. They are also not trying to pursue you, acquiring you. You are also not acquiring the other entity. Also, there can be something called as golden parachutes, where what happens is you are trying to say your top management that in case there is a merger happens, I'll give you a huge cash flow. So if there is a huge drain of cash outflow, this can make the company unattractive. Reverse merger is acquisition of a stronger entity by a weaker entity. Normally there are 3 tests for doing that. The assets of the acquiring company would be lesser than the assets of the, basically the assets of the target company would be more. The consideration, the shareholding would be, the shares issued would be more than the pre-merger number of shares in the entity. And also I think there could be a change in control. Change in control can be there. What are the various form of divestiture? Divestiture is basically you are trying to, what is divestiture is you are trying to sell off one of the business or your undertaking. You may want to pay attention on the core areas. Some of the businesses are not sufficiently contributing. Some of the businesses are too big. So you want to give it to someone else to be managed, or you want a cash. Cash can come if you do a sell off or a partial sell off. If you do a spin off, cash will not come. No cash will come, but basically another entity will be there. Another entity will be there, and that entity would control the business. That entity is going to, you will spin off into a separate entity. You will give shareholding to your existing owners. So proportionate ownership will be there. There can be same management, or you can create a different management, and then mostly you may try to give it to a different management, but ownership would be the same owners will maintain it. Split up is one company, a bigger company split into 4 smaller companies, and these 4 smaller companies would be managed by different management. They would be managed by different managements. Equity carve-outs is where you do a spin-off, and you also do some public issue of shares. You do public issue of share. Sale of a division is where you sell off part of the division. It's more like your partial sell off. And demerger or division of family owned businesses. This could be for the purpose of your succession problems. You want to sort out some succession problem. Ownership restructuring can happen through going private. Management buyouts, where the management of the company buys the business. Leverage buyout is where the acquisition has happened and the consideration is funded more than 50% through debt. And you can also do an equity buyback. In an equity buyback, what will happen is the buyback is going to happen, because of which there is going to be decrease in the holding, and that can lead to a change in the shareholding. MBOs versus LBO example we have seen. Different steps of a successful M&A program. You'll have to manage the pre-acquisition phase, screen the candidates, remove the candidates which are not fitting in, negotiate and manage the post-merger. If you end up overpaying, or there is a poor post-merger integration, or if you have overestimated the synergy gain, that can lead to a failure of M&A. Cross-border M&A is also becoming popular. Under a cross-border M&A, the acquiring company and the target company are based out of different countries. You want to enter into global market. You want to have a global production facility, global marketing facility. So globalization of your production and distribution, integration of global economies. You want to expand your trade. You want to get some tax benefits, or there is a privatization of state-owned enterprises, or consolidation of banking industry. These are the reasons why a cross-border M&A activity can happen. With this, we are kind of done with this.
Okay, let's now move to the last chapter, which is on startup finance. This is also one of the chapter which is purely theory based, so become extremely important from exam point of view. I think for theory I had said chapter 1, chapter 2, chapter 3, chapter 6 and chapter 14. These are the most important chapters from theory point of view as far as the exams are concerned. Now let's understand what is there here. What is a startup to avail government scheme? So I think with the Shark Tank which was telecast few months back, I think a lot of people do talk about this term startup now. So what is a startup is, there's a definition for startup, simple definition: less than 10 years from incorporation, and turnover should be less than 100 crores in all the years. Moment you reach 10 crores
or you attain 100 crores of turnover, you are no more a startup. Startup definition is it should have been less than incorporated. Okay, you should either be a private limited company or a partnership firm or an LLP, not prior to 10 years. Turnover for any year should not exceed 100 crores. Also, what is very critical is, see, a company is doing well, it exceeds 100 crores. What it does is it splits itself. We learned in the previous chapter that there are multiple ways of restructuring it. So you may split or reconstruct the business which is already in existence. That should not happen. If you are trying to split your existing business in order to continue as a startup, because there are certain benefits available to a startup. So if you want to enjoy those benefits and you try to do this, then it's not a startup. Entity should not have been formed by splitting up or reconstruction of business already in existence. And obviously this should try to work towards some new product, process or service. So working towards innovation, development, deployment or commercialization of a new product, process or service. And what it further says is, the moment you exceed 100 crore or you complete 10 years, you will cease to be a startup. You will not be a startup moment you exceed this limit of 100 crores or you exceed 10 years from your incorporation. You attain that 10 years. Also, there are certain benefits that a startup has. Startup shall be eligible for these tax benefits, only after you get a certification from the ministerial board. There is a board which has been set up for this purpose, so you will have to get a certificate from them. So basic definition of a startup is less than 10 years from incorporation. You are a private limited company or a partnership firm or an LLP, and you should not attain 100 crores of turnover. You should not attain 100 crores of turnover. It should not be formed by splitting up or reconstruction of business already in existence, and it should work towards innovation, deployment, commercialization of a new product, technology or a service. Explain some of the sources for funding a startup, innovative ways of financing a startup. Non-bank financial sources are becoming popular to finance a startup. See, because it's a startup, getting a bank loan can be slightly difficult. Getting a bank loan could be slightly difficult because it could be an innovative idea which you are coming out with. Normally, banks ask for some collaterals, some security to be given. Also, they normally invest in business which are doing well. There's an established share of a business which is there. They do also fund startup, but normally the banking sources will not fund that much. So what are the sources you have? First thing is, the person who is forming the startup, the innovator or the promoter, he has to bring money from his own sources. He has to bring some money. Unless the promoter is bringing in money, if I am a person who wants to fund the startup, I will not get any confidence. So the first thing is personal financing. Most of the investors will not put money into a deal if they see that the entrepreneur, the person who is setting up the startup, has not contributed money from his personal source. So first thing is personal financing. Second is personal credit line. Again, it is a credit line which he can have at his personal end because of his own collateral or security which he could give. An example is a credit card. It is based on one's personal credit effort. Bank will provide this facility when business has enough cash flows to repay the line of credit. Apart from this, I can maybe go through some factoring arrangements, or I can do something called as peer-to-peer lending, or a crowdfunding can come into picture. What is peer-to-peer funding lending? Okay, family and friends. Again, this is from the promoter's own end, from the owners or the innovators end. The good part about this, these guys will fund whether the idea is working or not. Because there is a personal touch which is there. The rate of interest can be low, sometimes it can be very high also because of the risk which is perceived in the project. Peer-to-peer lending is, there are set of people, a set of entities who keep funding. So sometime I will fund some other startup, I would have got funding from some other startup at some point of time. So group of people come together and lend money to each other. Small and ethnic business groups having similar faith and interest generally support each other. Crowdfunding is, I have got a very good idea, but I need funding for this. So I am going to create a crowdfunding initiative where I will tell this is an idea I have and I want funding to come from lot of people. So maybe thousands of investors can be there and the investment can be as low as even 1,000 rupee or some 10,000 rupee. It uses small amount of capital from a large number of individuals. Vast network of people through social media and crowdfunding websites to bring investors and entrepreneurs together. We do crowdfunding sometimes for some social cause also. That's not technically for funding a startup, but just to give an example, if somebody is going through a health issue and he is not able to fund the health expenditure, the hospital expenditure, there are tools where they run an initiative and a lot of people contribute to it. In this, you are contributing, maybe you will also get an equity stake in the company. Micro loans are small loans which are given by small loan given by a single individual are aggregated at a lower interest. Apart from this, I can also depend on my supplier. The supplier, I am going to buy a product from someone, so I can depend on my supplier, which is through vendor financing. In this, company lends money to its own customer. For example, Maruti Suzuki can provide funding to its dealers, or it can extend the credit period from 30 days to 45 days. Purchase order financing is, in this what will happen is, there is a purchase order which is placed. Based on the purchase order, you go to a bank or you go to some entity which wants to fund. Purchase order financing company often advance the required funds directly. They'll give it to the supplier. The supplier is not ready to give credit. So you use the purchase order financing route to get the money, and then give it to this. Factoring, which I was talking about, factoring is selling your receivables. You sell your receivables and so that you get money from the factor. So for a startup, somewhere it is critical that he brings money from his own sources. So personal financing, then we have personal credit lines, family and friends. These all three are personal sources. Then peer-to-peer lending versus crowdfunding. Peer-to-peer lending is set of individuals, a set of business companies or entities which lend money to each other. Crowdfunding is you are dependent on small amount of money from large number of individuals. Micro loans is a small loan given by a single individual or aggregated at a lower interest. Vendor financing is money from your supplier. If your supplier is not ready to give money, you do purchase order financing or you sell your receivables because you need to give credit to your customer. What do you mean by pitch presentation in the context of a startup business? Explain the methods to approach a pitch presentation. Great, that becomes very simpler because for me now to explain what is a pitch presentation, if you have gone through or if you have just watched even one episode of the television show which had come in. So if you had seen that Shark Tank, you would have seen that everybody makes a pitch presentation. What you see there is a compressed version of a pitch presentation. Normally the pitch presentation will go for a little longer period of time, and there are a lot of things which you need to put in a pitch presentation. Normally it's for less than around 20 minutes of pitch presentation. Pitch deck is a short and brief presentation explaining about the prospects of the company and why should the investor invest in this business. You may start with an introduction which is basically explaining what the startup does, short introduction. Next, you may want to explain the team which is there, is to introduce the team members because these are the guys who are going to work on the project finally. Somewhere the investor needs to have the confidence on the team because they are going to make the product or the service successful. Then you may have to talk about the problems and the solutions which are there. Promoter should be able to explain the problem he is going to solve and the solutions emerging from it. So what kind of solutions they are going to give for the problem which are there. One of the example, this example I liked it. Flipkart started its business in 2007. It brought e-commerce in India. They introduced cash on delivery because in the Indian context, it's not that everybody will have net banking. At this point of time, a lot of net banking is there, but this is 2007. At that time, many people may not have net banking. So cash on delivery became a good tool to expand the sale. Today also, a lot of people opt for cash on delivery basis for purchase of the product. They normally don't want to pay the money online. One, there are trust issues which can be there, which is for the newer set of companies, not for the established one like the Flipkart or the Amazon. There you don't worry about the trust factor. But for some newer companies which are trying to get into this, you may have some trust issues, so the cash on delivery works there. So initially when Flipkart came into business, they would have wanted people to buy product in the online mode, and somewhere COD would have helped. Apart from this, I think somewhere I would want a financial projections also. That is what the company is likely to achieve. Projected financial statements, which includes income statement, cash flow statement, and balance sheet. Marketing, the investors would like to know what is the size of the market and how are we going to reach the target customer, because I would want the size to be a bigger size. If the size is small, it would mean that there is difficulty in growing. So if the size and the market data is given, it will give us a sense as to how the company is likely to grow. Competition, understanding who are the major competitors. In fact, many a times, in fact, when I used to work in a credit rating agency, when we used to discuss with the company, we used to ask them who are their major competitors, because I want to know what is the core competency of this company. The core competency, how are they going to compete with others in the industry. So how are you going to compete with others in the industry is very critical. For that, somewhere an understanding of the competition is critical. Understanding the business model. Business model, how are you going to make your product available to the end customer? It is wide term indicating core aspects of business purpose, business process, target customer. How are you going to make the product available to the end customer? Discuss the lifetime value and what should be the strategy to keep him glued to the customer. Next is financing. Financing is, if you have raised money in the past, you need to explain how have you used that money, who has invested the money, and if you have not raised money, why do you want to raise money at this point of time. If the money has been, no money has been, an explanation can be made regarding how much work has been accomplished, and you can also talk about what are you going to do with the money which is going to be raised now. So in a pitch presentation is basically a simple document which you will have. You should try to make your pitch presentation mostly around 20 minutes of a pitch presentation can be done. You'll explain about the company, about the team, about the problem which you are trying to solve, about the solution, about your product offering, about your service offering, about the financials which are likely to come, what are the past financing which you have taken, about the business model of the company, on the marketing aspect. So all this would be covered as part of the pitch presentation. Okay, next, explain the basic documents that are required to make financial presentation during pitch presentation. Financial presentation is, we talked about the financials aspect, the projections aspect. So basically, I want to have an understanding on the income statement, cash flow statement, and the balance sheet of the company. Income statement initially can be monthly, then you may do a quarterly income statement, and then maybe you can give an annual income statement. This projects how much money the business will generate by projecting income and expenses. Initially, you can do monthly income statement, then you can do a quarterly income statement, and then you can prepare an annual income statement. Cash flow statement is going to basically explain how much inflows are going to come, how much outflows are going to be. It will also help you in understanding when there is a need for money. When there is a need for money, will depict how much cash will be coming to the business, how much cash will be utilized. At the end of each period, one can tally it up to show either a profit or loss. Basically, you are trying to understand the sources of inflows and outflows and how much cash would be needed. Balance sheet is basically going to show the assets, liabilities, and the equity of the company. Somewhere the income statement and the cash flow statement, the information on that would be used to prepare a balance sheet of the company. What are the modes for financing for startups? Explain angel investor. So modes of financing, say listen, we had earlier seen a question which is called as innovative ways of funding a startup. Innovative ways of funding a startup are non-banking financial sources. Then we have something called as mode of financing. In that, I think there is an angel investor who is there. There is a bootstrapping method and there is a venture capital fund. What is bootstrapping method is, you are trying to run the startup. You are trying to run the startup using the cash flows from your own personal finances or from the operating revenues of the company. She attempts to found and build a company from the operating revenues of the company. The problem with this method is you cannot grow at a very rapid pace, because if you want to grow significantly, you need money. So investment by startups from their own savings lead to a cautious approach. Angel investors, these are the set of people who invest in a lot of startups or entrepreneurs. In the Shark Tank show, you saw many entrepreneurs were sitting there. They were basically angel investors. They were basically the angel investors. They invest in small startups or entrepreneurs. They can be among the family and friends. They can also be outsider. For example, in that show, you saw people investing even in the businesses which are not even known. provide maybe a one-time investor to help the business propel, or an ongoing injection of money. So in the show you would have seen that there is an initial funding which they would be doing, and there could be a series of funding which if needed they were ready to fund, or they said we can arrange that funding in laterally. Can be informal investor. One of the example I can give is Ratan Tata. He is also an angel investor. He would have invested in multiple businesses. Some angel investors also invest through crowdfunding platforms online, or build angel investor networks to pool in capital. You basically need to know where is the need for money. Venture capital is basically money provided by the professionals. They are the professionals who invest in, who also take part in the management most of the time, who alongside management invest in young, rapidly growing companies that have the potential to develop into significant economic contributions, and they sometimes may even take part in the management of the company. We also saw about venture capital funding, I think earlier in one of the chapter, I think on security analysis or security valuation. The same points we are going to see here. Explain venture capital financing and their characteristics. See, venture capital financing is a very risky kind of a funding, because you are going to invest money mostly at the initial stage, at the startup stage. Venture capital means funds made available for startups and small businesses with exceptional growth potential. This is money provided by professionals who would who alongside management invest in young, rapidly growing companies that have the potential to develop. They also take part in the equity. Mostly they'll take part in the equity. They're willing to take high risk. Finance new and rapidly growing companies. Purchase equity securities. Assist in the development of new products or service. Add value. Characteristics of venture capital financing. The investment would be for a longer period, minimum of 3 years and maximum of 10 years. Normally these guys, when they make investments, they are basically making high risk kind of investments. So it works on the principle of high risk and high return. Lack of liquidity, because they would be taking a sizable stake. They'll normally take a sizable stake. So when you take a sizable stake, it will not be easy for you to sell the stake. It will not be easy. So most of the times there could be an IPO which will happen after 3 years or after 10 years. The IPO will happen and you will try to move out of the company. Lack of liquidity also increases the risk of the investment. And you obviously participate in the equity. Advantages of bringing venture capital in the company. Advantages is, one is they provide that initial capital. They're also able to provide regular source of money. They will also have a network of contacts which can give me some business relationship. Could be a customer relationship or could be a supplier relationship. They can also help in bringing professionalism. They can help us in doing an IPO in the end. Long-term equity finance, solid base. Venture capitalist is a business partner, so he shares both the risk and reward. Practical advice and assistance to the company. Network of contacts. He has a network of contacts. Additional source of funding can be provided by this guy. He is also experienced in doing an IPO. So he can also help the company helping an exit route for the VC partner as well as some other strategic partner who could have entered into the company. Stages of funding venture capital. Now, there are multiple stages of funding venture capital. So when you invest at the initial stage, it is obviously a high risk. Basically, there is an idea which is dead and you want somebody to work on that idea. So that's called a seed money. 7 to 10 years kind of an investment. Extremely risky because you are trying to do it at the R&D stage. There is not even a prototype. Or basically a product which is there. The next is startup, then the first stage, second stage, third stage, fourth stage. The risk will keep coming down. From extreme, it becomes very high, then high, sufficiently high, medium and low. The risk will keep coming down. The period of investments will also keep coming down. Earlier seed money is some 7 to 10 years, then 5 to 10, then 3 to 7, 3 to 5, 1 to 3. The risk will keep coming down. This is when a prototype is done. You start doing commercialization. You want to further expand and finally do a public issue. So seed money, then there's a startup stage, first stage, second stage, third stage and fourth stage. Seed money is extremely risky. Then there's a very high risk, then there's high risk, then sufficiently high, medium and low kind of a risk. There's a lock-in period which is 7 to 10 years, then it becomes 5 to 9, 3 to 7, 3 to 5 and then 1 to 3. Explain venture capital investment process. I think this is more like your M&A process also. Basically, you will first find out a deal is there, then you will do a screening of the deal, then you will do some due diligence of the deal, then you will maybe enter into a negotiation, then the deal goes through, then there's a post a deal, you will have to do a lot of activity. So deal organization, then screening of the deal, due diligence, deal structuring, post investment you'll have to monitor it, and then finally an exit. Deal organization is you will have to first find out a deal is there. You may directly find a deal, or you through an intermediary. You can tell your intermediary that I want a deal in pharma sector. I want a deal in pharma sector. I want a deal in Tata Group because these promoters are very good. I want a deal with a turnover of 100 to 500 crores. This is my turnover focus. Our stages of business focus, I want a deal at the seed money stage, or at the startup stage, or at the first stage, or at the second stage, third stage, fourth stage. Once you say that, the employee or the intermediary may bring a deal. Now this deal would be initially screened by a screening committee who would consider the top management. The screening is carried out by a committee consisting of senior level people of the venture capital. Once the screening happens, you will now take it to the next stage, which is a due diligence. You may appoint an external investment banker to do the due diligence. VC try to verify the documents taken. This is generally done by an external bodies, renowned consultants. The big fours are into due diligence, so you may use the services of a big four. After this, you will structure the deal. You will say how much equity you want, how much borrowing you want to give. In that show, you would have seen that they want to give some 50 lakh for a 1% stake, 100 lakh for a 2% stake. So the deal is structured in such a way that both parties win. If there is a convertible structure, promoter retains the right to buy back the share. Facilitate the exit. VC may put a condition. See, VC would want to exit at some stage. When you are trying to exit, if you are not able to find a person, you may say that the promoter has to buy back the stake. The promoter has to buy back this stake. After the deal has been structured, you will also have to monitor the post-investment activity through regular MIS. VC nominates in nominee in the board of the company. Certain guidelines like strong MIS, strong budgeting system, strong corporate governance. Every month you will keep monitoring it, and then finally you will exit it. Exit can be through an IPO route. Exit can be through a sale to another party. So you can sell to a third party. You can do it through an IPO route. You can also sell it to a promoter if he has given a commitment saying that he will buy it back. Structure of venture capital fund in India. There are two types of basic structures which we are going to talk about. Three types of structure. One is domestic fund and offshore fund. Offshore fund will be broadly split into two types of structure. So there's a domestic fund and there's an offshore fund. Domestic fund is basically, it's a domestic vehicle. It's a domestic vehicle. Pooling of funds from the investor. You will have a lot of investors who would invest in, and there is a separate investor advisor who will carry the duties of the asset manager. What is asset managers? Doing those 6 activities: finding out a company or deal organization, then screening, then you have to do due diligence, then you'll have to structure the deal, post activity, and then do an exit. It is usually structured as a domestic vehicle for the pooling of the funds and a separate investor advisor that carries those duties for the asset manager. This can be created as a trust or as a company or as an LLP. Then offshore structure. Offshore structure is an investment vehicle makes investments directly into Indian portfolio companies. This is basically managed by an offshore manager. Offshore manager is basically a person outside India. So the investment vehicle could be outside India. The investments could be made into India. The investments could be made into the Indian companies, and the due diligence, all those activity could be done by a person who is sitting out of India. Under the structure, an investment vehicle, LLC or a limited partnership firm organized in jurisdiction outside India makes investments directly. So this is an offshore structure. This is an offshore structure where the investment vehicle is sitting outside India. The investment vehicle is sitting outside India. Then there is an unified structure where the overseas investor, in the venture capital fund, somebody has to invest it. The overseas investors will pool their assets in an offshore vehicle, that is vehicle which is sitting outside India, that invests in a locally managed trust. There could be something which is there in India. They'll invest in this trust where you will then start making investments in the Indian company. So domestic funds is basically a domestic vehicle. the investors are from India. They invest the money in the venture capital, and there's a separate investor advisor who will invest this money, the pooled money, into different companies. In an offshore fund, the money is going to come from outside India. The investment vehicle can be sitting outside India. They'll invest directly into the Indian portfolio companies. The investment vehicle could be sitting outside India, but they'll invest in a locally managed trust, and this trust will then invest in Indian companies. So domestic fund, under a domestic fund, money will come from Indian investors and they'll invest in Indian companies. Offshore fund, you can have an offshore structure or a unified structure. In an offshore structure, overseas investor will invest in an overseas company and they will invest in Indian companies. Overseas investors will invest in an overseas VC. They'll invest in an Indian trust, and this Indian trust will invest in Indian companies. So you will have in between an Indian trust. Pool their assets in an overseas vehicle that invest in a locally managed trust. What is bootstrapping? Explain some of the methods in which a startup firm can bootstrap. Bootstrapping, I had told you, bootstrapping is basically a method where the promoter is raising money from his personal sources or from the operating revenues of the company and runs the business. An individual is said to be bootstrapping when he or she attempts to found and build a company from personal finances or from the operating revenues. This can lead to a cautious approach. There are multiple ways of doing bootstrapping. One is trade credit. Trade credit is if your supplier can give you money. When a person is starting his business, suppliers are reluctant to give trade credit. They will not be ready to give it. But if you can make your supplier to give you credit, that can help you in expanding the business. They'll insist on payment of their goods are supplied either by cash or by credit card. But if you can give a well-crafted financial plan, explain him this, then it is possible that you can get a credit from your supplier. So this is supplier side credit. Second is your receivable side credit, because you have to give credit to your customer. You can sell this to a factor where the accounts receivable are sold to a factor. This can be on with recourse or without recourse. It can be on with recourse, it can be on without recourse. It can also be on non-notification basis. What is non-notification is customers are not aware that there's a factoring agency which is going to take care of the collection and I have sold your receivables to them. So trade credit is supplier side credit. Factoring is selling of your receivables. Leasing is if you are not able to buy some assets, you can take those assets on a lease. Lease versus buy is something which you could have learnt as part of, in Inter you had that chapter, but now it got removed. So there was a chapter on leasing, so where you were doing an analysis whether you want to lease an asset or buy an asset. So if you don't have adequate money, you can go through leasing. This will reduce your capital cost. So leasing is also an approach which can be done, but obviously leasing can sometimes become costlier also, because it is a regular sum of money which you need to spend. You need to take a call whether you want to regularly spend money or you want to take money. If you are not able to regularly spend money, what you can do is you can take the asset by purchasing it. When you're trying to purchase, if you can get a bank loan, great, but getting a bank loan can also be difficult. That is why instead of buying the asset, you can go through a leasing route. So one, you can look at your supplier side credit. Second, you can look at your receivable side credit, and third, you can go through your asset side, which is through leasing. Okay, next question is compare and contrast startup with entrepreneurship. Entrepreneurship is basically, it's a broader term. Basically, an entrepreneur is a person who runs a business. He ensures it could be an established business. So startup is basically a part of entrepreneurship. Startup is mostly focusing on a new idea. Entrepreneurship could be an established kind of a business. Startup is a part of entrepreneurship. Entrepreneurship is a broader concept and it includes a startup firm. Is to build a concern, conceptualize an idea which is developed into reality. Established entrepreneurship is to attain opportunities with regard to resources. A startup generally will not have any financial goal because they just want to have that idea successful at that point of time. Entrepreneurship mostly have a financial goal. They want to give some IRR to its investor because it's a well established kind of a company. Priorities and startups. See, priorities is bringing more and more startups, more and more idea, is bringing more and more smaller firms into existence. So instead of opportunity, more of the trend is to encourage self-employment. So bringing more and more kind of firms and bringing more and more idea. The major challenge is employees, talent. The main challenge is getting the right talent because you do not have a skilled workforce. Also, there are a lot of compliances which are to be done. In fact, government is trying to give some relaxation there, because if you have so many compliances, that pushes up your cost. Had to comply with numerous regulation, it leads to further delaying the chances of a break even. Explain the term business model. See, business model is basically the way you earn money. For example, the Bharadwaj Institute business model was conducting physical classes and earning revenue. Suddenly a second business model came into picture. We have started online classes, live online classes, and we started earning money. Suddenly a third business model came into picture. We have started giving recorded classes and earning money. Suddenly a fourth business model came into picture where we have started selling books and earning money. So business model is basically going to tell how are you going to earn money. It's a wider term denoting core aspects of a business. A business model is a way in which a company generates revenues and makes profits from the company's operations. How are you going to make money? In order to ensure or in order to analyze the success or a failure of a business model, normally you look at the gross profit. Is the way to compare the efficiency and effectiveness of a business model. If the gross profit is high, it's a good business model. If the profitability is low, it is a weaker business model. For that, they gave an example. There are two companies, company A and company B. Both are engaged in the business of renting movies. So they were renting movies. People will come, get the movies. So before, what used to happen is, before the prior to the advent of internet, they were making 5 crores as revenues, COG, so 1 crore was gross profit. After the introduction of internet, company A felt that instead of doing this physical thing, they started doing online, instead of movies online, instead of renting. This has positively affected their business, because what has happened is, revenue is still 5 crores, but the costs have come down to 2 crores. Because there is a reduction in your storage and distribution cost. So now this change, because the internet happened, you started offering your movies online. This has positively impacted the company, because your GP margin has moved from 20 to 60%, whereas the other company may not have. It is good that you show the investor list of various revenue streams. Again, I go back to that Shark Tank show. If you have not seen it, I would suggest you to see at least one pitch. Most of the times they'll ask, how are you going to earn revenues? Because I want to know how the revenues are going to be earned. So the list of various revenue streams and the timeline for each of them, and how are you going to price your product, how the competition is going to come in. So you would want to know what is the lifetime value of the product, and how are you going to, what strategy do you have so that the customer continue to be there with you. Peer-to-peer lending and crowdfunding are same and traditional methods of funding. Do you agree? No, both are not same. They are totally different. Peer-to-peer lending is basically, there are set of entities who fund each other, I do not agree, because peer-to-peer is in existence for a lot of years. Crowdfunding is something which is a contemporary source of finance. A group of people come together and lend money to each other. Whereas in a crowdfunding, you use small amount of capital from a large number of individuals to finance a new business initiative. So small number of money, small amount of capital, but large number of people. 1,000 rupees from maybe 10,000 people or 1 lakh people. So when you are bringing money from a lot of people, 1,000 is not the right money. In a practical, maybe 1 lakh or 10,000 depending on the business. Can a company with no commercial operations raise capital via an IPO? This is more from your SEBI regulations point of view. See, normally you would want, when you are doing an IPO, you would want that company to have some business, earning some revenues. It could be even loss making, that's okay, but some commercial operation should be there. But according to the regulations, you are still allowed to do an IPO even without commercial operation. The purpose of this kind of a IPO is, you are planning to acquire some company. A company can launch an IPO appears to be absurd, but this is a fact that even if a company does not have any business, it can. In recent times, special purpose acquisition companies, they come into existence where the entity is set up with the objective to raise funds to finance a merger or an acquisition of an unidentified target within that specific time period. If you are not able to do that acquisition within the time period, you'll have to return the money. Blank check company is to raise money despite not having any operations. Money raised is kept in an escrow account which can be accessed only for making the acquisition. If you are not able to make the acquisition, your SPAC is delisted and the money is returned to the investor. The money is returned to the investor. So shareholders will get the money in this. Also, you may have to give an option to the shareholder because you don't know which company you are going to acquire. When this the IPO came into picture, you said that you are going to acquire a company. Shareholders should have the option to redeem the shares if they are not interested in the proposed merger. If they are not interested in the proposed merger. And for the proposed merger to pass through, the shareholders will have to obviously approve it. That is from your regulations point of view. Current regulatory framework in India does not support the SPAC transactions. The registrar is authorized to strike off the name of the companies that do not commence operation within 1 year of incorporation. Within 1 year of incorporation, you will have to do this. If you are not able to start the operation, the ROC will remove it. This is from a regulatory point of view. They normally say that SPAC generally takes 2 to 3 years to identify a target, perform due diligence. Hence, this provision it could be operationalized, can be striken off. Hence, enabling provisions need to be inserted in the Companies Act. See, Companies Act says that within 1 year, if you start the operations, fine, else we will strike off your name. Generally, it takes around 2 to 3 years. Generally, it takes 2 to 3 years. So that is why there should be some provisions in the Companies Act that for SPACs, special purpose acquisition companies, it can take more than a year. And they are saying SEBI may come out with some criteria, some rules in order to monitor them. So coming to this chapter, I'll just quickly revise it. So we initially understood what is a startup, less than 10 years or less than 100 crore of turnover, both the condition. You should have been not reconstruction, not splitting up of an already business in existence, and the objective is to innovate, deploy new product, new service or a new process. Modes of funding a startup: personal financing, personal credit lines, friends and family. I'll have to bring from my own sources. I can also go for crowdfunding, or a peer-to-peer lending can also be brought in. Crowdfunding is basically a lot of people are going to bring in money. Peer-to-peer lending is you fund some other company, at some point of time the other company may fund some other company. So set of companies which fund each other. You can also go through vendor financing, supplier financing. If supplier is not ready to do, you take a purchase order and take purchase order financing, factoring and micro loans. Pitch presentation is basically a document which is going to talk about the company. Normally it's for less than 20 minutes. You will do a presentation. You will explain, you introduce the company, introduce the team, explain what is the problem, what is the solution you want to give, on the marketing, on the financials which are likely to come, the business model of the company, the competition, the past financing if you have done, what did you do with that money, basic documents that are required to make financial presentations, income statement which could be monthly initially, then quarterly, then annual, cash flow statement which could be quarterly, half yearly, annual or a monthly also, and then a balance sheet needs to be prepared. Modes of financing for a startup. Modes of financing is different from the various innovative ways of financing a startup. In modes of financing, you have an angel investor, you have a venture capital fund, you also have a bootstrapping method. Bootstrapping is you are funding from your own sources. Angel investor is set of people who invest in multiple startups. Venture capital fund is basically they are the professionals who invest in rapidly growing companies. Their characteristics is they are professionals. They will provide that initial capital. They provide their objective is to invest in small businesses with exceptional growth, new and rapidly purchase. They take into equity participation. They take extreme risk. They are invested for a long period of time. Advantages of bringing venture capital: they will provide that initial finance, long-term finance. They're also ready to provide regular finances. He's going to share the risk and rewards. He will have a network of contacts. He can help you in providing an IPO exit of he will facilitate an IPO, or he can facilitate extra funding. Stages of venture capital: there's a seed money which is an extreme risk, then there's a startup stage which is a very high risk, then first stage which is high risk, second stage sufficiently high, third stage medium risk, fourth stage low risk. Explain venture capital investment process. First, you will have your employees or an intermediary who you will tell them that what kind of deals you want, so deal organization. Then you will screen the deal through the committee. Due diligence will be done by an external professional. You will structure the deal, post investment activity, and then you will exit. In the exit clause, you will also tell maybe the promoters to so you may do an exit through an IPO, or you may do an exit through by selling it to the promoters themselves. Structure of venture capital fund in India, there are three types of structure. One, it can be a domestic fund. Second, it can be an offshore fund. The offshore fund can invest directly in India, which is an offshore structure. It can invest in a trust in India, and then the trust invest in the company, which is a unified structure. Bootstrapping is basically a method where the promoter, or where the startup entrepreneur, he tries to fund the business from his own sources or from the operating revenues of the company. There are multiple ways of doing a startup. You can take money from your supplier, which is trade credit. You can sell your receivables, which is a factoring kind of an arrangement, or you can go through a leasing route. In a leasing route, what you do is, instead of buying the asset, you take the asset on lease. Startup is a sub part of entrepreneurship. Entrepreneurship is a broader concept. The objective of startup is to build a concern, get an idea, then commercialize it. Normally what happens in an entrepreneurship, it's a well established business. Startup may not have any financial objective initially. An entrepreneurship concern will have a financial objective. The priority is to bring more and more companies, smaller companies into. The trend is that self-employment is becoming more and more viable as compared to the self-employment is what is becoming more viable at this point of time. People are trying to get into that. The main challenge is, one, they do not get the right talent, and they have to comply with a lot of regulations which can push up their cost, and that will delay the break-even. Business model is basically understanding how are you going to earn money. Business, in the way in which a company generates revenues and make profits from its company's operation. You can assess the efficiency of your business model through the gross margin. Gross margin can help you in assessing the efficiency of the business model. Peer-to-peer lending and crowdfunding are not similar. Peer-to-peer lending is there in existence for many years. Crowdfunding is a contemporary resource. Here, companies lend to each other, whereas in a crowdfunding, you raise money, small amount of money from large number of individuals. A company with no commercial operations can also do business. Special purpose acquisition companies, they can raise an IPO. What will happen here is, your objective is to acquire a company. So that is the objective you have. You need to raise the money, and after that you need to find a target, do a due diligence, and acquire that company within the set time period. If you are not able to do that within the set time period, you will have to return the money to your investor. With this, we are kind of done with this chapter. I've covered all the chapters. Again, I had told you initially also, theory is very, very critical for SFM. So please focus on theory. Ensure that you do multiple stages of revision, because this can easily help you in scoring 16 out of 20 marks in exam. So do multiple stages of revision as far as SFM theory is concerned. With this, I end this video. In case you have any doubts, you can obviously comment in the video, or you can send me a message in WhatsApp. There I'll clarify your doubts.